What was my ambition when I was starting out? Survival.
I love the word ambition.
Ambition is passion.
It's a key ingredient of greatness.
To me, ambition is being undaunted by the impossible.
I'm ambitious for the nation. I'm ambitious for its people. I'm ambitious for my people.
My ambition has always been to seek the truth.
To learn as much as I possibly could.
To make an impact.
I believe in dreaming big. I always have.
My ambition is to show gratitude. Yes.
Ambition. It's got America written all over it.
Ambition really is the foundation of capitalism.
I wanted to do great things in this country.
My ambition is to do very well in business and to take those profits and recycle back in society to try to make the world a better place.
Everything can be a reality.
I see ambition everywhere.
In many ways, ambition, human ambition, is what drives the world.
And that ambition has to start somewhere. And ambition has to start somewhere. How about your global briefing? We begin with shares of Chinese online gaming giants Tencent and NetEase rebounding in the overnight trade after the country's top gaming regulators said it would, quote, carefully study concerns on new rules aimed at curbing excessive gaming and related spending. This comes one day after nearly a dozen other smaller gaming companies announced a series of new share buybacks in an effort to reassure investors pending the new regulations. All right, shares of SoftBank also surging overnight after disclosing it will receive a new batch of T-Mobile shares worth about $7.6 billion at no additional cost as part of the merger agreement between Sprint and T-Mobile. The move essentially doubles SoftBank's stake in U.S.-listed shares of T-Mobile to more than 7.6%. And following a similar move by Maersk, French shipping giant CMA says it is increasing the number of ships bound for the Red Sea through the Suez Canal. This is the U.S. and its allies. They step up their military campaign in the region, including an exchange yesterday that saw a U.S. Navy destroyer and an F-18 fighter shoot down 17 drones and missiles launched by Iranian-backed rebels. The latest counterstrike comes after Houthi rebels successfully attacked yet another container ship in the Red Sea yesterday, one owned by MSC, as it was making its way south past the Suez Canal. The company says all crew are safe and no injuries were reported. MSC says it will avoid using the Red Sea following that attack and opt for the longer and the costlier route around Africa's Cape of Good Hope. All right, coming up here in Worldwide Exchange, the one word that every investor needs to know today, plus Goldman Sachs out with a new contrarian call for the U.S. economy in 2024. Much more Worldwide Exchange coming up after this.
Feel the magic.
All right, welcome back to Worldwide Exchange. Time now for your WEX wrap-up. We begin with Tesla, reportedly planning to launch an updated version of its popular Model Y from its plant in Shanghai with significant interior and exterior changes that's expected as soon as mid-2024. Sticking with EVs, Berkshire-backed BYD obtaining a conditional testing license for Level 3 autonomous driving on high-speed roads. The license allows drivers to temporarily take their attention off the road due to the system's environmental detection abilities. A new note from Goldman Sachs forecasting 2% GDP growth during Q4 of 2024. That's well above the consensus of 0.9%. Goldman cites strong consumer spending, an increase to real income, and record household net worth in the call. AI integration and device upgrades could drive a rebound in PC sales in 2024. That's according to market research firm Canalys. Shipments have seen consecutive quarterly declines since 2022 due to weak demand, macro headwinds, and a shift in IT budgets. Tan Tang, Apple's outgoing vice president of iPhone and watch product design, reportedly set to join legendary Apple designer Johnny Ive and OpenAI CEO Sam Altman on a project to create new cutting-edge AI devices with software provided by Altman. This after OpenAI reportedly opened talks for a fresh round of funding, valuing the company at or above $100 billion. And Intel coming off its biggest daily percentage gain in 2 months after receiving $3.2 billion from Israel to build a new $25 billion chip plant in the country's southern region. That marks the biggest investment into a company by Israel. All right, turning to the day ahead as we close out the final trading days of 2023, we have our Dom Chu taking a look at some high-flying sectors from a valuation perspective heading into the new year. Dom, good morning, and thanks for joining us for this month's Sectornomics.
All right, so Frank, what we have is a setup going to 2024 where the S&P 500 currently trades at just around a share below 20 times next year's expected forward earnings. So analysts' take on what earnings are going to be next year, what's the S&P trading at right now? That kind of gives you the benchmark. And by the way, that's sitting right about where it is on average over the last 5 years, which that forward PE on average is about 19.2. So keep that in mind as we talk about some of the more overvalued sectors, the ones trading at a premium to that S&P 500 19, 20 sometimes valuation. If you look at those, technology, maybe no surprise there, trading at close to 26.5 times next year's expected earnings, one of the more high-flying, if you will, sectors out there, but growth is a big part of that story. Consumer discretionary up about 26 times forward earnings. Remember, that's the big sector that has Tesla and Amazon in it, so we'll keep an eye on that. And industrial is trading at just about the market multiple, so you can see the premium valuations in the market really being dragged up by technology and consumer discretionary. Meanwhile, on the other side of the spectrum, check out what's happening with some of the more value-oriented ones trading at a discount to that market multiple. We've got utilities at just around 15.5 times forward earnings, financials trading at about 14.5 times forward earnings, and then energy lagging behind, trading at just about 11 times next year's expected earnings. So as you take a look at the setup, Frank, we always want to talk about that magnificent seven, those big stocks that are driving a lot of that valuation upside. It's still going to be the case heading into 2024, but energy is one of those sectors that could be poised for a bit of a bounce if investors start to see it as a more value-oriented sector out there, Frank.
Yeah, investors are always looking for more value. Dom Chu with this month's Sectornomics. Dom, thank you very much. All right, joining me now with his expectations for the trading day ahead and what this all could spell for 2024, we have Ivory Johnson, founder of Delancey Wealth Management and a member of the CNBC Financial Advisor Council. Ivory, happy holidays. Thanks for being here.
Holidays to you too, Frank.
All right, so you just heard Dom kind of spell out some of the undervalued parts of the market. Anything there that you're seeing that you might want to make a move on as we see these final trading days of the year and maybe even into next year?
Yeah, absolutely. I put a position on for the utilities, not just because of the valuation, but they do well in this environment. The bond market seems to believe that we're going to have a slowing economy. So when rates go down, that's really good for utility stocks. So that's a place I would definitely participate in, especially as the economy starts to slow.
All right, so everybody knows right now we're in the period where historically we see a Santa Claus rally. It's also generally a low liquidity period. But right now you're actually advising people to make some moves. It's not about buying the dip or buying the winners. You're saying sell the losers.
Right. It's just a function of taxes, right? There are 4 ways to lose wealth. There's lawsuits, divorce, taxes, and doing something stupid. I can help with 2 of those things. And so to the extent that you have positions you're not enamored with, that you're not going to hold on to in the next year because your position has changed on the direction of these companies, sell those and then balance that against some gains you might have had, because if you have mutual funds in an after-tax account, well, then obviously they have to pass down those capital gains to you. So you want to balance those out so you don't have a big tax bill come April 15th.
All right, so you're really focused on taxes right now as we close out the year. I don't think you're the only one, in all fairness. We were talking about real estate earlier in the show. We had the CEO of Brown Harris Stevens on saying right now is the time to buy, that you should marry the house and buy the rate. You're also advocating buying real estate and doing something else that we don't often talk about here on the show, buying life insurance. Why is that important right now for investors?
Well, it's important because you can try and save taxes now or try and save taxes later. So if you're a high wage earning W-2 employee, they took away their employee reimbursement deduction. So all you have is the 401k deduction. So when you buy real estate, the cash surrender value grows tax deferred, and then you can borrow against the cash surrender value and pay no taxes on it. In fact, you pay it back with the death benefit when you pass away. So it's sort of like a Roth IRA with no income limits. And even if you do pass away prematurely, those death benefits come tax-free. And don't forget, the cash surrender value can grow with the market if it's a type of policy that allows mutual funds or sometimes they have indexes that it's attached to.
You know, Ivory, I usually ask what your WEX word of the day. I think it's pretty obvious. It's taxes.
Taxes.
You're really focused on the tax impact of your investments and other things right now.
Yeah.
You know, this is all about moves for today. So one other move that you say that investors really need to do today and in these last trading days of the year is look at your risk tolerance. What do you mean by that?
Well, I think that when you have a move that like we've had where the market's up pretty big, review what your risk tolerance is because it may be skewed by the fact that you just made a lot of money, right? So your risk tolerance, your time horizon, at the end of the year, reevaluate what you're trying to do, and that'll give you some sense of how you rebalance the portfolio going forward. Because if you're getting closer to retirement, now is not the time when you want a lot of volatility in your portfolio.
All right, fair point there. Ivory Johnson, it's always great to see you. Happy holidays.
Happy holidays to you too.
All right, quick look at the futures before we let you guys go. Taking a look right now, we're seeing the Dow actually hit its highs of the morning right now, looking like it would open up almost 30 points higher. The S&P still basically flat. Remember, it's very close to a record close. The NASDAQ solidly in the green. We'll be watching the NASDAQ 100 trading at its highest level since 1999. Again, there's a Prince joke in there. I'll let the team on Squawk Box coming up make that joke. Squawk Box is up next. Thank you for watching. Have a great day.
Pro.
Good morning. Another record-breaking day for the Dow and the Nasdaq. Will the S&P 500 join the party before the year end? Judging by the futures, it's going to be a nail-biter. Rising tensions in the Red Sea. Another round of attacks in the key shipping lane in the Middle East has the energy markets on alert. And Apple will not back down in its watch battle. A key designer is about to join forces with an AI upstart. It is Wednesday, December 27th, 2023, and Squawk Box begins right now.
Good morning and welcome to Squawk Box right here on CNBC Live from the NASDAQ market site in Times Square. I'm Steve Leisman. We have Contessa Brewer and Leslie Picker, Joe, Becky, and Andrew all off enjoying the holiday today. U.S. equity futures at this hour. Contessa, help me out here. What's the record that we're looking for on the S&P?
We need what, about 0.5% higher?
4,800, is it? Something like that. Not too much to do here. The Dow kicked off the final trading week of 2023, closing at a record high, currently up 13% this year. And check out the NASDAQ, also at record levels, up a whopping 44% this year. Did you guys all have all your money in NASDAQ stocks this year?
As you know, we are not allowed to hold individual stocks.
But you can hold NASDAQ.
Yes.
You can hold the QQQs.
It's on pace to have the best yearly performance since 2003.
I'm looking at the way you said that, like you didn't have it.
I mean, I have a 401k.
Yeah.
I have some exposure, but yeah. Not index funds.
Did you at home have all your money in?
How about you? What you want to be asked? Where do you keep your money, Steve?
In a variety
in
of
a boat. In a couple boats, maybe.
Yes, that's right. And we also have one record-breaking holdout, the S&P, now 0.5%. That's right, Contessa.
There you go.
From its all-time high. That index is up just 24% this year. And of course, you made some money in treasuries as well if you invested at the right time. Take a look at treasury yields. They are, there we go, 4.01% on the 30-year, 3.87 on the 10, 3.87, same thing on the 5, and 4.29. I don't know. You think this is the year, next year, 2024 is the year when we disinvert? That's a question we have to be watching.
Definitely, absolutely.
You think so? It happens? We disinvert?
Well, why has it been inverted for so long is the key question.
I think it's because the Fed remains high and the Fed controls the short end. And if the Fed does its thing, as many expect, you would expect a disinversion of the yield curve.
Eventually.
May not happen too slowly. You know, somebody said, I think it was Paul Samuelson, it's in the 60s, things happen really slowly in economics, slower than you think, and then they happen much more quickly than you think.
Well, that's why we keep you on your toes,
Right.
Leisman. Let's move to the energy sector. The price of crude giving back some of yesterday's gains. Worries about a fresh round of attacks in the Red Sea rattled the market. The U.S. and its allies stepping up their military campaign in the region, including an exchange yesterday that saw a U.S. Navy destroyer and F-18 fighter group shoot down 17 drones and missiles launched by Iranian-backed Houthi rebels. This is the latest sign the war between Israel and Hamas risks expanding into a wider conflict. WTI has been heading higher in the last couple of weeks, but still down since the start of the Israel-Hamas war, which began on October 7th. And while all this is happening, the Biden administration is adding crude to the Strategic Petroleum Reserve, the government purchasing 3 million barrels. That brings the total buyback to 14 million barrels following last year's sales. And if you were with us yesterday, we were talking about the slump in natural gas prices as the weather remains mostly mild across the nation. But check out home heating oil dipping more than 5% on forecasts of warmer weather for the East Coast. I was also reading headlines about Minnesota. People were walking around over Christmas without coats on. And I mean, I think there is some blizzard activity expected in the North Midwest.
I think, after the first of the year. But there's also this El Nino thing that says it's supposed to be relatively warmer through March.
I do think that the interesting thing about home heating prices, whether it comes from oil or from natural gas or, quite frankly, from electricity, is that this is one of the areas where you can make people feel poor because of what they're spending on winter heating. And we've seen this before. It has a similar impact in the winter as summer gas prices when people want to drive and go on vacation. So what you may get is consumers feeling like they have more money in their pocket because they're not paying out $1,000 bills every time the guy comes to fill up the tank at home to heat their home. So whether the weather lasts, whether this is just, you know, a freak late fall sort of warmer period is to be seen. But
I think that's an important insight into the whole inflation dynamic. It's the prices in front of you that shape your beliefs about what's going on both in your life and in prices, whether or not they represent a substantial portion of your expenditures. You do go to the gas station every day or every week, and you do fill up your house and pay that bill when it comes. A lot of other service prices are fairly constant, you know, your cable bill, your telephone bill, even your car payment and your house payment remain constant, but it's those fluctuating prices that are right in front of you that tend to shape your inflation expectations.
Yeah, there was that piece in the Journal this morning about the misery index and how it's diverged from consumer sentiment in a way that, you know, you don't historically see. Usually you've got the inverse of the misery index, which they say is a factor of unemployment and inflation, and it usually moves inversely with, you know, consumer sentiment, which makes sense. But this year, things have gotten better in the economy, but people still aren't feeling good. And they attribute that to, you know, Republicans not being happy that President Biden is in the White House, as well as some after effects of the pandemic. But it is kind of an interesting
they're not happy,
trend.
but they're still spending.
They're not happy, they're still spending. So does it matter? If
Because
people are
spending
unhappy?
makes us
I guess
feel
it matters
better.
for the election.
I know
but-
a little bit about this. I wrote that story last week when we did our CNBC All-America survey showing high holiday spending intentions but low sentiment. I also wrote that story for the front page of the Wall Street Journal in 2002 when after 9/11, consumer sentiment numbers plunged, spending remained robust, people found themselves extremely depressed and buying automobiles. Why? Because prices had sunk, and they were incentives from the government to go buy autos. So the connection between sentiment and consumption, I think, is tenuous at best. I think if you ask economists, well, at turning points it matters a lot, but sentiment can go up and down, even be down, but spending can be high, because the most important question when it comes to spending are incomes and the price you're spending, right, that you're paying. So what I've always said is, don't say somebody won't spend until you know the price they're not going to spend at, right? So if a car is X and I'm feeling bad, I'm not going to buy the car. But if the car is X minus or is 10% off, I may go buy that car no matter how depressed I am.
It's retail therapy.
Exactly. Exactly.
Let's dive into this Wednesday with some corporate news now. We're leading with Apple. The tech giant is appealing the decision to ban imports of its Ultra 2 and Series 9 smartwatches after the White House declined to veto a federal agency's order stopping their sale in the U.S. According to the Wall Street Journal, Apple's asking the court to allow it to begin selling the watches once again. While that appeal is being considered, it adds, if the ban remains in place, Apple will suffer, quote, irreparable harm. And Bloomberg reports Apple's outgoing iPhone design chief, Tang Tan, is joining forces with Apple's famed former chief design officer, Jony Ive, and OpenAI's Sam Altman. Tan will start work at Ive's design firm on an AI hardware project focusing on devices that integrate the latest capabilities in AI tech. Apple shares have been on a losing streak, but right now we are seeing that Apple shares are, well, you know, in the pre-market, still down 0.1%. But look at year to date, up almost 50%. Not chump change.
Shares of SoftBank moving higher in Japan. Overnight, the tech conglomerate said it would receive shares in T-Mobile worth some $7.6 billion at no additional cost. This is part of the merger agreement between Sprint and T-Mobile. The transaction bolsters SoftBank's stake in T-Mobile to 7.6 from 3.75%.
And Tesla is reportedly planning to launch an updated version of its popular Model Y from its plant in Shanghai. According to Bloomberg, the revamped crossover will feature significant interior and exterior changes and should reach mass production as soon as mid-2024. The report adds the Shanghai plant will pause production for about a week in preparation for the changes. The plant will need another upgrade before peak production begins, but that Model Y is about 75% of sales
Is that what we
from
get
China.
here in the States? That's the one we drive here?
I think people do drive it here, but I know that it's very, very popular
In China.
So an upgrade.
More news from the wonderful world of streaming. Amazon Prime Video will start to show ads starting January 9th. And if you want the ad-free tier, you gotta pay more. It will be an additional $2.99 a month. To avoid the ads, Amazon says this move will allow it to continue investing in compelling content. The move was announced earlier this year, but now the date is set. Amazon shares right now, mostly flat, up this year, 83%. We talked a little bit yesterday about this idea that you're paying, I don't even know what Prime costs now. I just know that the prices for Prime keep going up. And mostly people may opt for Prime for the free shipping. But you get the Amazon Prime on your device without the ads, and already the freebie comes with ads. You know, showing ads for a streaming service that you're paying for seems like, you know, well, I guess we pay for cable and we see ads on.
I mean, I feel, and this is like a curmudgeon-y thing to say, but I have a 4-year-old who watches TV. You know, he's used to only watching streaming his whole life, and then all of a sudden we start introducing ads, and he's like, "What is this?" And I'm like, "Welcome to life, sweetie."
And also, that's how you introduce consumerism early.
Well, that's the flip
I don't
side.
know. Here's what I'm thinking. I remember how to talk with a mall developer once, and he said, well, let's see. They have this thing where you order it online and they send it in 5 days. And then you have a thing you order online and you send it in 3 days. Then you have a thing where you order it online and you go pick it up at the store. Sounds like they invented the mall.
It's full circle.
Now it feels like with all these ads on streaming, why aren't they driving me back to my cable?
Well, the ads are shorter on streaming.
They're
Usually
shorter,
they're 30
okay.
seconds, they're targeted,
But at the end of the
you can
day,
pick them.
there's a convenience to cable. And I know we're wrapping up here, but that strikes me as, you know, maybe I'm buying cable companies with all these ads going on. I don't know.
I'm very pro cable.
Well, of course we're for cable, but but if the thing becomes the same, then what's the difference? $11.99 here, $9.99. Do you have any idea, Contessa, what you're paying for all these streaming things?
No, I do not. I honestly do not. I know that I've cut a few in the last year, but no.
All right, we're going to continue this discussion. Coming up, a sector investors need to watch heading into the new year. We're going to reveal that after the break. Plus, will the S&P join the Dow in record territory? We tap into the markets, plus former Fed Vice Chair Roger Ferguson on the path of interest rates and the economy. Squawk Box coming right back. We have some ads coming up.
What are you waiting for?
Welcome back with Squawk Box. As 2023 comes to a close, what's one key sector to watch in the year ahead? Dom Chu joins us now with this month's Sectornomics. Mr. Chu.
Well, Steve, you're going to appreciate this, along with Contessa and Leslie as well, because interest rates are going to play a big part of that story. As we know, there's a lot of focus on whether the Fed will cut rates as early as sometime in March. Now, with the S&P 500 outperforming in 2023 to the tune of just around perhaps 24-25% for the overall S&P 500, what could be that one driving force and key sector to watch? It's going to be financials. We asked a couple of our CNBC contributors why. From a fundamental basis, Tom Lee over at Fundstrat is looking at financials for one key reason here, and that's because of the rate story. He says that interest rates are falling and mortgage rates will fall, and that will improve asset quality for the banks and also unlock demand for loans and reignite lending. So they should help regional banks and financials. Financials are under-owned by hedge funds right now. They are like the energy trade of 2021. So if that's the case, then maybe there's some outperformance there to be had. And we also asked CNBC contributor Katie Stockton from a technical perspective which sector she likes, and lo and behold, she said financials as well. I think it'll be financials in 2024. The sector is second behind technology in the S&P 500 weighting, and it has a base breakout in absolute and relative terms versus the S&P. It's contributing to recent improvement in breadth and has the potential to continue doing so with the breakouts ahead. That's something to watch. And speaking of that outperformance, just since those October lows, we have seen, again, outperformance in both the S&P and the sector overall for financials. But that Sector Spider XLF ETF, you can see from the lows here, up roughly 19% higher from those low levels versus a roughly 16% gain for the broader S&P 500 overall. So we'll see whether or not, Leslie, we see any of that continuing performance heading into 2024. I'll send things back over to you.
Really interesting stuff. I think financials are also the least shorted sector right now as well, according to the S&P data. So definitely one to watch in 2024. I know I for sure will be watching it. Thank you, Dom. Joining us now for more on the market, Zachary Hill, Head of Portfolio Management at Horizon Investments. Zachary, we're half a percentage point from another record in the S&P 500. Do you think we get there before the end of the year?
Good morning, and great to be with you. Yeah, I really do. I mean, there's nothing that's kind of stand in the way of the market right now. We've got positive momentum. We've got seasonality, which has worked very, very well this year. So I do think we're going to be hitting all-time highs, if not the end of the year, very early in January.
There's, some would say that the recent rally is leaving the market vulnerable to disappointment, maybe not in this kind of setup at the end of the year with little news, little in the way of economic data coming, but you've got earnings to look forward to in the next 3 weeks or so. Do you think that the market is currently priced to perfection at these levels?
Well, I think it's good that you brought up earnings, because I do think that's a catalyst that we're looking for, in the coming weeks. And so, a lot of, ink has been spilled about the Mag 7 and, how top heavy the market is. But I think what that kind of misses is those companies have really out-earned the rest of the market. Equal weight S&P or small caps lags behind really substantially in terms of earnings power. And so, we've seen kind of some breadth increase over the last few weeks. That's been very, I think, healthy. Especially for the areas of the market that haven't participated, like financials, like you were just talking about. But really, to kind of see that in a more durable way, we need earnings to validate that. And so, I think we have this window right now where we don't have a lot of new information. And so I think that's kind of dominating markets. But, come the end of January, I think we're going to be doing a lot of work looking at what the projections for 2024 look like.
Perhaps a bit more dispersion in 2024. I see that you think stocks next year won't beat 2023 gains, but you think they'll do better than cash and better than bonds. So how would you be allocating your portfolio given that thesis?
Yeah, that's kind of a great point. It's a conversation we're having with our clients every day. I think the last kind of 18 months has just been a shock in terms of, what interest rates can do and what they can do to bond portfolios and what they can do to overall diversified portfolios. And so you've seen a lot of people move into cash, move into T-bills, money market funds and the like. And I really do think 2024 is going to be, that kind of year about getting reinvested again. Now, it's a little ironic that it's happening at all-time highs, but, that's sort of the way that these things tend to go. go. But I do think that it's going to be a good year for the stock market. We don't see a recession coming. We see the Fed kind of delivering cuts in Q1 of this year and continuing hopefully to do that throughout the rest of the year. And so you've got policy that was a headwind. It becomes now a tailwind. You still got good, strong earnings coming from the consumer. We do think AI is very early innings as well from a theme. And so all those things kind of together tell us that, you do want to be exposed to stocks here in a material way. And then on the fixed income side, look, 5.5% is great. But what about if the Fed cuts the 6+ cuts that are in the curve next year? That's going to look a little bit different. And so we do think kind of extending duration and fixed income, kind of going from cash to fixed income is a thing that investors are going to be doing really all of 2024.
Hey, Zach, you have like a double reverse psychology program here, which is that you say everybody's going away from the big seven into the broader index, but you're going to stick with the big seven. Am I reading the notes right?
Well, not exactly. I mean, we look for opportunities, over kind of a 1 to 3 month time horizon, and we've seen some, in that kind of broadening out of the market. And so, we've been adding small caps in our portfolios, not across the board, but in ones where it makes the most sense. Really since kind of mid-November. And we do think that that's the window that's going to continue to work for that part of the market as we catch up. We've just materially underperformed. Investors tended to be very short that sector and very, very long the top of the market. And these things can take a pause, and that's just a kind of a healthy development. And so, I do think we're in one of those pause cycles. As we look forward to next year, we still do think that kind of technology, the very top of the market that's driving, innovation and AI adoption across the economy is going to be where you want to be. But the last thing I would say is the history of these the kind of you call them the Mag 7 or you call them FANG or whatever. The names the names within those change, and so I do think we'll see some change within that next year, and that's something certainly that we're looking out for.
Yeah, maybe we won't be saying Magnificent Seven. We'll be saying something else. We'll see.
Sure.
Zach, thank you.
Coming up, the next round is on the House. A potential tax on whiskey gets delayed as part of an ongoing tariff battle between the U.S. and the EU. We have those details up next. Squawk Box will be right back.
CNBC.
Whiskey distillers are toasting the new year after a potential tax threat gets punted. Emily Wilkins joins us from Washington, D.C. now with more. Good morning, Emily.
Good morning, Contessa. Well, it has been a little easier for American bourbon distillers to get into the spirit this Christmas after the EU announced that they would extend a suspension of tariffs on U.S. whiskey. The liquor faced a potential 50% tariff at the start of the next year. It's the result of a larger dispute on steel and aluminum tariffs put in place under the Trump administration. Now, distillers in Kentucky, Virginia, and beyond can breathe easy, at least until the end of March 2025. The U.S. and EU have been negotiating the tariffs for 2 years so far, and U.S. Trade Representative Catherine Tai said the goal is to, quote, forge a forward-looking arrangement that will allow us to join forces economically to incentivize fair and clean production and trade in the steel and aluminum sectors. Kentucky Republican Congressman Andy Barr, who pushed for an extension of the halting of the tariffs, told me that the EU has become a critical market for distillers from his home state. In the years after the tariffs were initially lifted in 2021, Barr said there was a 32% increase in U.S. exports.
Europe really matters. Europe is the biggest market outside of the United States for American bourbon exports. We're still trying to crack the code in Asia and in other parts of the world, but Europe really understands aged distilled spirits. And so this is the place where we really need a level playing field, zero taxes, zero tariffs, to really continue to grow this industry.
U.S. whiskey distillers aren't the only ones benefiting from the continuation of suspended tariffs. Europeans looking to get a Harley-Davidson motorcycle next year also won't have to deal with high tariffs being reinstated. Guys, it sounds like it's going to be a bit of a happier new year for a couple sectors here.
You know, Emily, I went to Kentucky when those tariffs were first introduced, and they were up in arms, but the bourbon distillers that I spoke with felt confident that the quality of their product would be the selling point as long as the price point could be overcome. So the fact that this just gets punted, does that mean that they are optimistic there will be no negative effect for them?
I think if you want to read the tea leaves here between the U.S. and EU, the fact that they've both punted on these retaliatory tariffs is a pretty good sign that they feel like they're making progress and could be coming to an agreement soon. Down in Kentucky, in Tennessee, and in other places, they did see a drop in exports during the times that the tariffs were in place, those retaliatory tariffs. But since they've been lifted again, they've seen it bounce back. And they've, like you heard from Congressman Barr, they have really been able to find a niche in Europe with folks who really do appreciate that age statement on bottles.
Break out the old pappy. Emily Wilkins, thank you.
Cheers. Coming up, former Fed Vice Chair Roger Ferguson. He's going to tell us where he sees the interest rate path leading the markets in the new year. And we'll find out how concerned he is about the nation's ballooning debt. And as we head to break, a look at yesterday's S&P 500 winners and losers.
washboardjim.com.
Good morning and welcome back to Squawk Box live from the NASDAQ market site in Times Square. Let's take a look at the futures at this hour. Currently pretty flat across the board. Dow indicated to open up about 17 points. NASDAQ indicated to open up about 12. S&P, we are on a record watch. It's about half a percentage point from those levels. Treasury complex mostly in the red this morning. Two-year yield at about 4.3% currently.
Now for a look at the Fed's rate path heading into 2024, let's welcome former Federal Reserve Vice Chair Roger Ferguson. He's former president and CEO of TIAA and now a CNBC contributor. Thanks for joining us, Roger. Good morning.
Good morning, Steve. Nice to be here.
You know, Roger, I was okay kind of not dismissing but leaning against the market pricing for deep rate cuts next year beginning in March. But then along comes, you know, Goldman Sachs, who I consider to be a little bit more considered about their forecasts and maybe not quite so ready to get swept up into the mania of it all. Here's what they wrote yesterday. We expect 3 consecutive 25 basis point cuts in March, May, and June, followed by 1 cut per quarter until the Fed funds rate reaches 3.25% to 3.5% in 2025 Q3. Now, if the unflappable Ferguson gets on board with this, I'm ready to bet everything on it. Where are you at, Roger? Is you think Goldman is now swept up in the mania, or is this a reasonable, considered position here?
I think it's a little bit feeding into the market excitement. So I think the fundamentals of the economy have to be the first thing you look at. So yes, inflation has come down, you know, quite nicely. Looks as though the 2% is well within range. That's very, very good news for those who are expecting a series of cuts. Having said that, the economy itself is still strong and is withstanding, you know, some of these interest rates as they stand today. We saw what looks like a very strong holiday selling season. The numbers are coming relatively strongly. The Atlanta Fed's GDP Now forecast is looking at a GDP of roughly 2.3%, you know, right now. And we already have a significant loosening in financial conditions, all of which I think are driving some forward momentum that might create a sense in the Fed that, well, let's go maybe a little bit more slowly. We don't need to add more fuel to the fire, so to speak, by having, you know, 6 rate cuts of the type they would have talked about. So it's a close call, I will admit that. I'm still in the view that the Fed has a preference, not a strong preference, but a preference towards initiating the cuts towards the second half of the year. But it is a strong call, so I will admit that there's a lot of noise and some arguments on the other side. Right now I'm still in the, well, let's see, I think June more likely, unless something surprising occurs.
Roger, you've been there in office when the Fed has been cutting interest rates. What does it take for you to be comfortable that this is the right call?
Look, I think for this Fed, the first thing is what they've said, is that inflation definitely down at the 2% target. If you look at the last annual numbers, you'd say, oh, it's slightly above that, maybe at a number that starts with 3 if you look at 12 months. But if you annualize the 6-month and the 3-month numbers, you might get to be a bit more comfortable. So I think they want to be highly confident of that. The last thing they want is to see this pick up again. You know, the second thing I think that is going to drive it is this question of financial conditions. You know, obviously the markets are ahead of them a little bit. You know, they've attempted to push back verbally. I think there's a little bit of concern, well, maybe if we actually start to validate, the financial conditions get easier and easier more quickly, and that's a risk as well. So I think at this stage, you know, they are within a hair's breadth of getting that much desired soft landing. And I think they have room to be maybe a little more cautious than the markets do right now, and some incentive to be more cautious so as not to feed, you know, the frenzy, so to speak, and get things moving even further.
How much do you think they're haunted by this story of the 70s? That if you look at the inflation in the 70s, it went up, the Fed came back down, inflation came back down, then it went right back up again. How much is that a concern that, you know, when you basically turn your attention away from it, it can spark back up?
Look, I think it was a concern at the beginning of this cycle. At the same time, there are arguments that said, well, this time is different, you know, supply chain, et cetera. Still, it doesn't go away, I think. And so I think there's always a concern. No chairman wants to be, the Arthur Burns, so to speak. The stop-start is the dilemma, and that I think continues to weigh a bit, which may be another thing that slows them down just a little bit. So I think you've got to recognize as you do that these are very serious policymakers. At the same time, they're human beings, and there are kinds of mistakes they want to avoid.
Roger, thank you so much for joining us today. We really appreciate your insight.
Great, thank you.
Coming up, the countdown to shut down. Nothing is happening on Capitol Hill as Congress is in recess. Will there be enough time to strike a deal to keep the government's lights on? That discussion straight ahead. And a reminder here, you can get the best of Squawk Box in our daily podcast. Follow Squawk Pod on your favorite podcast app and listen anytime. We'll be right back.
Just to sit down for a few minutes.
Creating more organic compost, and then in the spring we'll go ahead and plant those. But the buckets that we did plant with seed, they are doing fantastic. Now the majority of the planting that we did is lettuce. Kevin and I absolutely love to have fresh lettuce salads through the winter. And then when we plant for spring and summer and stuff, our attention turns away from lettuce and onto the other things that we grow. All of the lettuce varieties are doing really well, and I think they're actually getting to the point where I could do a first small cutting of some of these. You can see how gorgeous these lettuces are, and now we planted leaf lettuce varieties so that we can cut that.
NBC. We're now just days away from another budget showdown on Capitol Hill. When Congress returns from recess next week, lawmakers will have just 9 days to avoid a shutdown. Joining us now, Politico's budget and appropriations reporter, Caitlin Emma. It's good to see you, Caitlin. All right, here's the thing. It seems to me like the House Speaker is stuck between a rock and a hard place, and right now it's the hardliners trying to get that boulder moving.
Right. I mean, this is really the same fight that we've seen all year over government funding, just dragging itself into 2024. Basically, Congress left a few weeks ago for the holidays without a deal on an overall government funding framework. So that would be essentially the parameters of a deal that would allow for federal agencies to get updated budgets for the current fiscal year. Right now we're operating under a continuing resolution, a stopgap that just extends flat funding. So without this deal in place, it's really hard to sort of write the rest of the spending bills that comprise like a huge government funding deal. And really lawmakers needed this weeks ago. So we are heading into 2024 with, two separate government shutdown deadlines in January and February. And, lawmakers are no closer to just nailing down the basics.
What's the incentive for deal making?
Keeping the government open is a huge priority, for everybody at this point, except maybe hardliners in the House. I think, seasoned Republican appropriators know that this is not a winning message to shut down the government, in trying to get policy concessions or spending cuts or something like that. It's almost never a winning message when you're the party that's blamed for it, particularly heading into an election year. Basically Congress should be able to keep the lights on and stay functional. But time and time again, we see the same fight where, the two sides are warring over funding. And right now, Speaker Johnson's in a really tough spot, just as former Speaker McCarthy was in, where he's being pulled in one direction by, his right flank and pulled in another direction by moderates.
Okay, so what are the sticking points? What areas do they absolutely need to find compromise on in order to keep the lights on?
Right. It's kind of an interesting situation that we're in at the moment because the 2-year debt limit deal that President Biden and former Speaker McCarthy negotiated earlier this year should have done the heavy lifting. That should have set the parameters for a deal, should have made things really easy. Of course, it's been anything but. You've had House Republicans, conservatives in the House, like the Freedom Caucus, trying to walk back that deal pretty much for the better part of this entire year. So at the moment, both sides still have to agree to, an overall number for military funding, an overall number for non-defense programs, whether or not to provide any emergency funding, whether or not to include certain policy provisions, how to package the spending bills and pass them. So these are really basic details. They could otherwise be taken care of by the debt limit deal that was struck earlier this year, but nothing has been easy in this Congress.
Caitlin, do you think that one of the reasons why they have yet to agree on even some basic details is because there is an election coming up? Is that seen as a potential reason for lawmakers to really dig their heels in as opposed to formulate compromise and come up with some kind of agreement to keep the government open?
Yeah, I think it's always harder to get these government funding deals in election years. Congress is often famous for operating under continuing resolutions. I think that's, even more so the case when you're approaching something as, consequential as a presidential election. So, the last government funding package that passed was for fiscal 23, and that passed last December. So just about a year ago, and a lot of Republicans at that point, were saying, yeah, I'm going to support this because I think it's the last time we might be legitimately funding the government for a really long time. So everybody knew that coming into, this year with a Republican-controlled House, that things were going to get so much harder, and that's really proven true. And it just remains to be seen what happens.
Do the Democrats think that there's any negotiating to be done?
No, that's the thing, is they have this bipartisan debt deal that was negotiated earlier this year, and it wasn't a good outcome for Democrats. The non-defense funding number is way lower than they would like it to be. Essentially, without getting too wonky about it, there was like a side agreement to that debt package that would provide an additional nearly $70 billion for non-defense programs. So think health, education, labor programs. That wasn't written into legislative text. It's something that is like routine. This is a normal thing that Congress does, where, changes in mandatory funding and things like that, different budget maneuvers, to have a little bit of wiggle room outside the funding limits set by that debt deal. Without it,
so really, you're looking at a situation where does a potential shutdown really incentivize them to go back to the table on one side and to come to the table on the other side? Caitlin, thank you so much for sharing some of your reporting for Politico with us.
Thanks for having me.
Coming up, the Fed's signal of potential rate cuts in the new year, giving a boost to commercial real estate and the REITs that track the sector. Our next guest will tell us why 2024 will mark an inflection point for real estate investing. Squawk Box is coming right back. Welcome back. The Federal Reserve's pivot away from rate hikes is likely good news for U.S.-listed REITs. Joining us for more on the real estate landscape heading into the new year, Rich Hill, head of real estate strategy and research at Cohen & Steers. Rich, so you say that after a challenging 2 years in CRE, 2024 will mark an inflection point in real estate investing. Is that purely just based on the direction of rates?
Sure. Good morning, and nice to see you. Thanks for having me on. Well, look, it's been a really tough 2 years for commercial real estate, and specifically listed REITs. They're down around 17% on a total return basis from their peaks at the end of 2021. Prices are down around 22% or so. But believe it or not, they were down even more at their trough in October. They were down around...
Now, as we walk away from 2023, heading into... What does the IPO market look like? Can we see some signs of life continue now in terms of all things IPOs?
Yeah, I think we'll probably see some normalized activity. I think if you do consider looking back, I think 2018, there were effectively just about 200 IPOs. So the trend obviously has been down since 2020, 2021. I think if interest rates start to fall, we'll probably see quite a few IPOs in the back half of next year. But overall trends are declining, and I think that's to be expected considering the pretty monumental, if you ask me, interest rate hikes that we've seen in the past couple of years. So it's going to take some time for the IPO market to hit some of those 200 to 400, company-based trends that we've actually seen in the past. But I think right now it comes down to not quantity but quality, because interest rates are still relatively high, and I think that unless companies feel qualified to list their shares, investors are going to be a little bit more choosy, I think, just because of what happened in 2020 and 2021. A lot of the reverse mergers via SPACs ended up going under. So I think there's a little bit more careful selection going forward, at least in the next year or two, especially if we start to see some sluggishness in the overall economy.
So perhaps some patience will be needed in terms of an overall IPO rebound. But SPAC, gosh, that word takes me back to about 2 years ago at this point. But really great breakdown on what has been an overall exciting space to watch into the back half of this year. We will leave it there. George Tillis, Senior Markets Correspondent for the network. Now that does it for our Next Gen Year in Review of 2023. From Alex and myself, we appreciate you watching every single day. Have a wonderful holiday, and we will see you in 2024.
Good morning, retail traders. How are we doing today? We're going to go off and talk about the watch list for today. I prepared a 2024 watch list yesterday in the room, and I'm going to kind of go over some of them. Right now, we've got Nile on top of the list. I have real high hopes for Nile this year. It came out with I think it came out with a new car or something. Nile did. So we've definitely got it on watch. If we pull up the 20-day, 1 hour time frame, we're about to hit resistance. And if you pull up the yearly, we've got a ways to go. So I think, 1123 is going to be our goal to break. And if we can break that, we should probably move up into the next resistance level somewhere right around 1242. We're on the body of that count. Well, actually 1271 to 1242, somewhere in that area right in there. But we got to pass through this here support, this resistance level of 953 to 1004. And then we've got a good climb to a pivot point on the chart, which I think is right around 1059. And then just keep on moving up. Hold support right around the 65 or maybe even the 51 EMA on the daily chart. Tesla, I have high hopes for Tesla too this year. I think production numbers are going to be good. GM and Ford are having difficulties. The only competition they really have is Nile and XPEV. So yeah, I think definitely you'll hear all kinds of rhetoric about Tesla. It's number one in my book. Then we got Intel. We'd had that magnificent news about Israel. This should settle down a little bit, pull back some, and then go ahead and retrace into next year. But definitely bullish. I was bullish on this. I called it out off the 200 when we hit the 200, and it's done nothing but run up ever since. This is an old timer, and it's due. Coin's had one hellacious run. I like to see it pull back some, consolidate, maybe right around 153.80. Right now we're at 172.05. Baba, I'm still a little bullish on China. Not real bullish, but we hit a pretty good solid support area, and I want to keep China, this one in mind. If you draw a trend line from the low to that low, we're raising right above it right now, and we had a little head and shoulders right here. So if it breaks on out, target 84.11. K-Web should be doing good. That internet, we got a 123 on K-Web. I think we can bounce back up and hit the 200 right around 27.88. XPEV, that's another car company in China. Right now we're hovering off the 200, and I think it's good to go to run it up to around 1558. IWM to me is the one that's the most oversold, and this is the one I'd probably watch into 2024. We are starting to reach a pivot point area, and that's right around 208.33. We got AMD on the watch list for next year. I really like AMD. I think we're going to catapult up to 157 and then find some resistance level, pull back some, and then bounce off this head and shoulders, and then go ahead for the third time and break that 157.63. NVIDIA, you're going to see your 650 next year. Definitely. There's so many bulls on this company. And it's consolidated long enough. It's ready to go ahead and break out. Now let me see, I thought I put 10 cent on here. Well, I did not. FedEx, I'm in this one long, or at least until the 19th of January. I do believe we got way oversold on this company. And right now I'm up about $100 a contract. UNH, same way. Healthcare, I think it's something that we really got to watch. And energy next year. I'm bullish on this one right here. I'm not in the trade yet. I do think we're going to consolidate. If it pulls back to 500, that's a strong buy to the 200. But I don't know about that. Right now, I've got a low support of 521.11, and we hit 520. So, Humana, same reason. I like this Humana a lot. I traded it last time when we were down here, and everybody was very bearish. And it was just on rumor. I do believe this thing's going to bounce back up. Although I'm kind of upset with Humana because of my health care, but they say you can keep your doctor. That's not the case. So that's kind of it. Let me think, is anything on the top of my head? Yeah, CHRS had news today. I think this is going to pull back and have a little knife and then have an opportunity maybe to pick it up right around 265, or maybe even if it crinks on down, got a lower support here at 245. These are my 3 buy zones for this stock right now. Whoops. 245 and 234 is the buy zone. Support area, hold, stay bullish, is 265. This one had good news, FDA approved. One to watch. Mara had a pullback yesterday, and it bounced back up pretty nicely. I always like to keep them on watch, both Mara and Riot. I'm going to put this on my top 20 watch list. And that's not top 20 no more. What happens if I go through these and they're not producing, they don't have any volume, I'll go ahead and take them off the watch list. Anything else? Let's look at the pre-market runners. Let me get me another one. EV car sector next year, I'm only going to stick with the top 3 or 4. You know, I like Rivian. I like XPEV. I love Tesla. And Nile, I think, is going to have a good year next year. It's not been doing very well. And I did a video on BYDDF. This was a Buffett play. And I think he's still in it. I'm not sure, but he's been selling. And we are definitely down here at a 1, 2, 3. And it needs to hold support off the 200 and run back up and hit the 50 SMA on the weekly time frame. And that's BYDDF, BYD. Rivian's a real good company. I think Rivian will bounce up too. It'll be Rivian, Tesla, Nile, and XP are my top 4. FUV, I remember trading this a while back. This one's kind of had a heartache. Blink. Here's another good one. We had a breakout on it. We had a 1, 2, 3 breakout. And now our target is this 200 up here at 524 on the daily time frame. Blink. Don't blink. XPEV is a China company. I really like their car. Right now we're sitting at the 200, so it needs to hold support. I do have a double bottom right here at 1328. But if it holds the 200, we'll jump back up and hit the shoulder line of this inverse head and shoulders right around 1550. You see the head? You got the left shoulder. We had the right shoulder. We broke down, hit the 200. So this is a good setup. XPEV. Keep a good eye on XPEV. Now I'm going to go to the daily highs. This is kind of what my routine is every morning when I'm checking out sticks. You know, the percentage gainer. See what's breaking out this morning. I don't see anything in here. This BP, I was doing some homework on it. I think this is a good one to be watching. Add to your watch list. It's a big company. Watch banks. Banks are going to have a good little run. They've already had the run. I mean, I talked about banks a couple months back, and I said, man, these banks are cheap. Well, they're not cheap anymore. They're definitely coming up here and hitting resistance levels. So once they do that, they're going to consolidate, pull back, have some kind of small correction, and then maybe continue with the run. But banks, nailed the banks. I mean, the banks were cheap. So was airlines when I called them out. But these banks, they had one heck of a run from the bottom call that I called on them. It was just too easy to explain. One, the interest rates, you know, with the Fed came out, and before he talked, I said, I don't think they're going to be raising these rates anymore. And that really got me into these. The Goldman Sachs, all the way from 289 to 381 in 2 months. I mean, this is irrational exuberance at its highest point. And we can't go higher. We could draw a trend line, I'll tell you exactly where it's going to go. Now, you know, I'm a master artist, so I use the bodies of the candles to get in key with the heat of the moment. So we take and we draw that little candle right there, and your target's going to be right around 394. If we break, yeah, I mean, we're at a shoulder line of a three-headed snake. This is your left shoulder, this is your right shoulder, and we've made up with that right shoulder. So this is really a hard resistance, and it could pull back to the next previous high, and that's going to be right around 373. And I'm going to put an alert in there and alert this out when we hit it. But the banks have definitely had a good run, and I'm very proud of this call. Morgan Stanley, same thing. We were down here at the bottom. I said, any bank you pick, you're probably going to make some money on. Now, airlines, next year, I really think the banks are on fire. We call this inverse head and shoulders. Almost every trade I take anymore is an inverse head and shoulders. Almost every trade I take, 95% of the trades I take are, or 90% are inverse head and shoulders. I really like this pattern for a reversal into the bull market. UAL, this is the weekly time frame. We got the left shoulder head, pulled back to the right shoulder, boom, to the 200. So that's at a resistance. Once you hit that 200, you got to consolidate, regain double top, and then break out. AAL's the worst one of them all. And it even bounced up. Inverse head and shoulders, boom. They can run up to the 200 and that'd be about it. It's the worst of all. You got Delta. Delta inverse headed shoulders with a two-headed snake. Left, right, right. Bounced up. Past the 200, hit a resistance level somewhere right around in here somewhere, 45.13. It needs to consolidate. They all need to consolidate. The fat cats are very bullish because any headline, and we got earnings coming up in 3 weeks, so that's going to be the catalyst to bring this market up higher. If the earnings are even 51% better than 50. I mean, if they're at 51% good, the market's going to take it overwhelmingly in good taste. They're taking small little, quote, anything that is positive, they're going to run with it. And we're in the middle of a world war, and inflation hasn't dropped one bit. I was paying $5 for a head of lettuce, almost 2 years of it. I kept complaining, man. I said, you know, he ain't going to sell this. The shit's going to sit there and rot. Who's going to pay $5 for a scrawny piece of head of lettuce? Onion, if you wanted to buy an onion, you're going to pay about $2.50 for an onion. I mean, it's just outrageous, the food prices. Meat has gone up almost 80% here in Missouri. I was paying around I'd get a pack of meat for about $8-9. Now I'm going to be looking at 17 to 20, the same size. Trash bags, I was paying 12, now I'm paying 17. These prices ain't going to drop. We're just going to have to live with it. So we got airlines and we got energy. Now, with the Red Sea the way it is right now, you know, we've had a little pullback in oil. I think we're going to consolidate and get back to 75 if we're not there by now. XOM. And you got the big fat cat. I mean, this is pulled back too to support level. I got a support channel here right around 99.30. We need to hold that with the bodies of these candles. Now, I've done this here chart way before this last 4 weeks. So that's what we got to watch. We got to watch that support. Make sure it holds. And if we break the 51, we're going to run back up to the top. Now, Oxy is a Buffett trade. He's got 27% stake in this company now. And I would assume that he's going to, the next bounce, probably he'll start selling some of it. I'm assuming. We called 1, 2, 3, had a nice little run. Now we're back to that support level, which is a double, triple bottom. We got a 1, 2, 3. So hard resistance is 67.34. Solid support is going to be that triple bottom right around 55.21. If it doesn't hold that, it's going to be a good drop. Good drop. His average cost, I think, is $56, 57, somewhere in that area. So he's definitely up on this trade. He's got a lot of money in this company. So I think that's about it. I want to look at pre-market movers. Right now we've got CHRS, which is the one I was talking about that had that FDA approval. I think I'll definitely trade this today if we can pull back and hit this first support. I like scalping stuff like this, but I never chase. Now, I know traders that do, and they get stuck in them. I wait for the pattern, and right now we've got what you call a symmetrical flag right here. So we draw this in. We draw this in. And we've broke out of that flag, came back and hit the 51 and broke out of that flag. So, you know, I'm going to put a support line, an alert right on that, on top of that flag. And get just a little bit above it. I traded these pennies for many years. So I know how to trade them. They're just hasn't been the market for it here in the last couple. This has been a wild, wild run. We had to sell off in 2022 and the run up in 2023, and the pennies didn't do nothing. But I'm definitely going to be watching this one today. Second on the list is Nile. Now everybody's starting to pump Nile. Not pump it, but alerting it. But I think Nile's really going to have a good chance next year. Mara, this is a scalping trade for me. We definitely hit some hard resistance levels. This thing's really popped up real good. Called us at the bottom. We have some room to run. We definitely have some room to run. We got to break 2680. 2680 is my number, and if we do that, we can get it up to about 31. Now, if it doesn't hold, strong buy. I have already registered in here right around 20 bucks, 1983. That's a triple top breakout. Like I said, I play patterns, and the triple top is a pattern. So this thing could come back down and hit that triple top. And that's a real good strategy to have on your list. Triple top breaks, always pull back to the triple top. Oh, not always, but everything, nothing's always. 90% of the time. And NVIDIA, we're going to see the 600 next year. There's so many pumpers on this stock. I mean, this thing's the biggest pump at all. And we nailed these support levels right around 404. Every time it pulled back, it hit that 404. And now we're starting to hit higher highs. So I think we'll get higher lows. And you can clearly see the pivot point in this chart. And I'm going to set an alert right there at that pivot point area. Pivot point is an equilibrium in a channel. 442 would be a very strong buy. If we see that, that's where I'd set my alert. Very strong buy. Apple. Now, they've been pumping Apple real hard. Apple's a stock that could never really be bullish past 150, 155. And you can tell in the last couple of years we've had a pretty good substantial breakout from that area. And they're pumping Apple right now. The Apple Watch is bad news. They said, what they say, they'll lose 138 million a week. And I'm going, what? Especially when they're not, you know, bringing in, their quarters aren't looking very good at all. So this Apple Watch is a big deal, I think, in my opinion, but they kept bringing, it's only 2% of their earnings. It's only 2% of the earnings. Well, they've been pumping this Apple Watch for years. So when it comes out bad news about Apple and it gets banned and, oh, it's only 2%. It's not a big deal. And we're about done here. They were pumping, yesterday CNBC was pumping gambling, all the gambling stocks. They're going to open up a big casino in New York. So they were all over it all day long. To me, I wouldn't invest in something like that, but Microsoft, it's a good one for next year. I think I put it on my watch list. I'll just double, yeah, there it is. Microsoft, we called the bounce off the 200. We nailed the bounce off the 200 back in last September. I mean, it was a beautiful double bottom here on Microsoft. I love the 200 SMA in any time frame that I use, from a 1 minute all the way to the 1 hour, all the way to the weekly, all the way to the yearly, daily. I really put that 200 SMAs in all my charts. You know, for example, we got the 1 minute right here. It's acting as a pivot point area on Microsoft. If I was to day trade it, I would know once it's like a VWAP, more or less. And the VWAP only measures 20 days. So let me think of something else. Solar. FSLR, First Solar. Pulled back and hit, well, that's not This is what I'm talking about. See the 200 SMA? It acted as a pivot point area. We hit resistance. Once we broke down below it, it became a resistance level. And once we broke above it, it became a support level. And you see this all the time. And I've added the 300 in here, SMA, just in case that fails. And I've got the 51. I'm a moving average. The sneaky snake trading strategy is all about moving averages, chart patterns, and being in the now. Shipping containers. Nile. Interesting thing about Nile is they bought this big shipping container to ship the cars because shipping got so expensive under the Biden regime and the war on energy and the war on gas combustion cars, the war on America. So this is definitely a pivot point area on FSLR, just on the 1 minute. So that needs to kind of hold support. I like to watch Weight Watchers this time of the year. After the holiday seasons, people like to shed them pounds and get ready for the bikinis. Called this out here in the room a couple weeks ago, and we've had a bounce off the support line of right around 674. Right now we're at right around 9. So I'm very bullish on this stock. I called it out. I said, hey, we got Thanksgiving. We got to think about Weight Watchers. This is a seasonal trade. It's a seasonal trade. They got a buy rating on it right now. I see them right here on the 20th to $14. So if you look at the $14, I'd say kiss my ass, and I'd tell them maybe a hard resistance at 1171. Somewhere in that area with your first resistance to break right here. And that's where we are right now at 953. Thing pulled back and hit the 51 here on the weekly time frame. I think that would be a good entry point. Or the 65. I got the 65 EMA on here. I use it quite a bit. As a continuation or maybe even a hard resistance. But Weight Watchers, we've definitely had a good bounce off it already, and the next level was 1171. Once we break $10, that's the catalyst to get the fat cats in, no pun intended. Oh yeah, pun intended. So now we've got that all out of the way. I'm going to go ahead and head on out of here. And I wish everybody a great day. Stay tuned.
feels today.
Mortgage rates have dropped dramatically in the last few weeks after rising for much of the year, but will that be enough to kickstart the housing market in 2024? Diana Olick joins us now with more. Diana, the woman with the answers.
Good morning, Contessa. Look, 2023 may have been the least affordable housing market in history. Record high and rising home prices combined with rising mortgage rates, which don't usually go together, made that happen. Now, through October at least, the typical 2023 home buyer needed to earn an annual income of at least $110,000 if they wanted to spend no more than 30% of their earnings on monthly housing payments for the median-priced home. Now, that's according to Redfin. The median household income is about $75,000. So there you go. Mortgage rates started this year at about 6.5% and rose steadily over 8%, jumping there in October. They have since fallen back sharply and will start next year about where they did this year. So let's compare a 6% mortgage rate to an 8% mortgage rate. So if you're buying a $400,000 home with 20% down on a 30-year fixed mortgage, at 6%, your monthly payment is $1,918. That's without insurance or property taxes. At 8%, that jumps to $2,348. So a difference of $430 a month or $5,100 a year. Now, lower rates help on the monthly payment, but home prices continue to rise, and the gains are actually getting bigger because the supply of homes for sale is just so low. As of October, prices were up 4.8% year over year, according to S&P Case-Shiller. That's the largest annual gain of this year. Sellers, however, were a little bit more active this fall, but the supply of homes for sale is still about 38% below pre-pandemic levels. So will sellers get off the fence and list this spring if it would still mean likely trading to a higher rate, but just not an 8% rate? Guys, we will find out.
Okay, but if the supply is somewhat 40% lower, is there any indication that is that going to crack?
Well, only if sellers put their homes on the market and if home builders ramp up the building. They have a little bit. We got a big jump in housing starts in the last month in November, but builders are still not building at the levels that they need to be. So we need builders to ramp up more, and we need sellers really to just get off the fence and decide to sell, even if it means trading up to a higher rate.
Diane, I'm really glad you're back. You know, you left me all alone last week, all right? Housing starts
Sorry,
I
went on vacation.
Well, I mean, come on. Housing sales comes out. Inventory jumps up to 9.2 months from 7.9. And I have no idea. I have no idea how excited to be about that. So would you please help me out here?
So the inventory jumped in the new home market. And the reason it jumped so much is because new homes are expensive, right? So you're looking at November numbers where mortgage rates were still higher. Mortgage rates have come down a bit. They were in the kind of the 7% range in November. So those were November numbers. Now you've got it more in the 6.5%. Maybe you get to 6%. Maybe the builders get a bump. People come in the door in January. Remember, November, December are not big home buying months. So that's why you have this big jump in new home inventory. But it's really the existing side, the cheaper homes that people can afford, that we need to get on the market.
Next time you tell me when you're going, you leave a cell number, and don't leave me hanging on the new home sales.
I mean, sorry.
Thanks, Diane.
Not sorry.
All right. For more on the housing market, I don't know how much more you get after listening to Diane Olick for all that time there. We are now joined by Lawrence Yun, National Association of Realtors Chief Economist. Lawrence, thanks for joining us.
Good morning.
Okay, so here's the thing I'm wondering about. Rates are coming down. We still need, inside the CPI, the housing component to come down to justify the Fed cutting rates. Is housing like this tinderbox ready to explode when you get down from an 8% mortgage down to, say, I mean, God willing, a 5% mortgage?
Well, you know, certainly the buyers always respond to lower interest rates. The prices, which early in the year had been actually declining somewhat, especially out in the West region, but now prices are beginning to accelerate upwards. Home prices are not part of the consumer price index. It's considered like stock prices, gold prices. It's an asset. It's not part of the consumer price index. What goes into it is the rental component and owner's equivalent rent, hypothetical what the owner would pay in rent. And that has been decelerating because we are essentially at a 50-year high in terms of apartment construction. So many empty units will be reaching the market, and I think that will begin to calm down the inflation numbers.
Okay, what about the housing market? Is there a level that, or is it just a relative level that people are going to see, hey, it was 8, now it's 6, it's go time?
Well, we have a new reference point. People saw the 8%, so they're comparing from that. So 6% looks much more attractive. Now, 6% was not attractive when people were comparing with a 4%. The rate, which I don't think will ever return, at least for the remainder of my lifetime. And so what is needed for the housing market is really about the supply situation. So as long as we have more supply, it will moderate home price growth, and that will be good for America. People's incomes are rising about 4%. We need home prices not to exceed that 4% level.
Lawrence, how many people, I don't know if you
God, Toll Brothers.
This, how many Americans are stuck in their home because of this mortgage situation right now?
People are loving their 3%, 4%, which they purchased a few years ago or refinanced into. If one looks at sort of the demographic dynamics over the past 2 years when the inventory levels were low, we have to remember there are over 7 million newborn babies, 7 million Americans who have turned 65. So there are a lot of people who need to trade up or trade down, but they have not done so. But I think as people begin to realize, 6% mortgage is not that bad. It's not 3 or 4%, but I need to make the move. I need that larger house, or I need to trade down. So I think we will begin to see more supply coming onto the market next year.
But Lawrence, isn't it the case, though, that we are seeing supply in places where people don't want to live, either because it's too cold or because there's no jobs? I mean, if you drive through central New York in some of these towns, you can see house after house after house that's either up for sale or looks like it's about ready to be auctioned off by the bank for whatever pennies.
Notice she didn't mention crime.
The opposite is true in Florida, where we've seen such a migration, and Texas, and these low tax, lower cost of living states.
Oh, you are absolutely right. There is so much variation across the country.
People are moving out of these democratic cities.
Inventory there. The downtown, people are not returning to downtown. Obviously, the work from home phenomena is leading to the suburb boom, the strength in the suburb over the downtown areas. And what you mentioned, the people migrating from, say, Pennsylvania, New York, Illinois, into the southern states of Texas, Florida, Carolinas, and people going into the Rocky Mountain states of, say, Arizona, Nevada, Colorado. So we are seeing some different dynamics across the country. But broadly speaking, the number of homes on the market, as people are walking down the street, looking around the neighborhood, is about half of what it was compared to pre-COVID 2019.
Lawrence, wrap it up first. There's a couple right now with a small baby in a small Brooklyn apartment. Maybe another baby on the way. Is next year going to be a better year for them to buy a house?
There will
Not
be a
that
little more
getting out of
choices.
Brooklyn's that important, but I'm just saying.
Well, there will be more choices to select. Builders are building more. There will be more pent-up sellers beginning to put the homes on the market. Mortgage rates will be a little lower. So, those are better conditions, certainly, than what we saw here in 2023.
And let us end then on a note of hope. Thank you, Lawrence.
Thank you.
Coming up, our virtual power plants, the energy resources of the future. We'll talk about the technology that can lighten the load on the nation's grid and the companies emerging as power players in the sector. Stay tuned. Squawk Box will be right back.
NBC.
Welcome back. As electricity demand increases, virtual power plants might be the answer. Pippa Stevens is here now with more. Pippa, this is a new one for me. Virtual power plants. I'm trying to wrap my head around what that even means.
Yeah, so essentially the grid is facing a host of challenges. As you said, electricity demand is rising, and then intermittent sources like solar can't just ramp up when we need it. And that's where virtual power plants come in. At the simplest, it's a collection of thousands of smart devices. Think panels, home batteries, thermostats, EVs, that when grouped together can help the grid by either providing a power bank or reducing demand at peak times. There are benefits for both the customer and the utility. First is just a more reliable grid. Blackouts have surged 64% over the last decade, costing some $150 billion annually, and VPPs can help utilities load shift. They also cut emissions and reduce costs. The utility might not have to build a gas peaker plant, and the customer gets a credit for power supplied to the grid. And there are multiple stakeholders here, including residential battery installers like Sunrun, Sonova, or Enphase, grid services companies like Itron and STEM, and then utilities themselves that are adopting these programs, including Edison International and National Grid. So this really is a story about power in numbers.
What does it mean for the overall costs?
So essentially, it reduces costs for both the utility and the customers, because utilities always have to have generation to match demand. And so there are things called gas peaker plants, which only fire up. It can be only a couple of hours per year, but it has to be there as a resource, as a resource should demand surge. And so if the utility has a VPP, they might not have to build that gas peaker plant because they can call on customers to reduce their demand rather than ramping up supply to match, demand that could be at an all-time high unnecessarily.
But how does it work? The residential customer buys the battery or the generator or whatever the devices are that are going to feed into the grid, and then the utility goes to them and says, hey, we know that you bought this, we'd like to have you as part of the grid.
So customers opt into these programs, and a lot of the time utilities will incentivize it by providing something like a smart thermostat. So think about it, if, let's say thousands of customers, thousands of homes are lowered by 1 degree. That starts to have a very meaningful
Do they lower it or do you lower it?
The utility lowers it, but you can
But
always
they control
opt
my
out.
thermostat?
No. You opt in, and you can always choose to opt out. So another thing is like charging your electric vehicle. Maybe you want to charge it at peak times when you get home from work, but everybody's tapping into the grid at that moment, so power prices are higher. So you can say to your utility, hey, you can charge it at a time maybe 2 a.m. when there's not a lot of demand on the grid, but you can always opt out. There's always the option to say, hey, actually I do want to charge my EV at this time. But you get a credit, and sometimes you actually get paid directly for the power saved.
How reliable is this? I think of anything that's more in my control as being a little scarier in terms of reliability. Is it? Well, is it as functional as the old way of doing this?
Yes, and so ultimately it's here to help grid reliability, because the idea is that the grid is changing with more distributed energy resources. There's no longer this constant supply and demand. We're not ramping up fossil fuels to meet demand. The grid of yesteryear was built to always have that match, and today it's different. Customers are generating their own power. And so ultimately, if the utility can tap into your battery and be smart about it, then they might not have to implement things like rolling blackouts, because they're tapping into a customer's battery in one area and then shifting the power.
Maybe they went. Striking thing in your report, that blackouts are up 64%. At a time when we require the grid to be more and more reliable, it's getting less and less reliable. That's pretty outrageous.
Yeah, it's really hard to manage.
Something's wrong.
Costs are going up, electricity demand is going up. I mean,
Climate risk is real, and that there's always the potential for a cyber attack that takes down the grid, and that's in the insurance space. This is something
we don't need terrorists to take down the grid. We take it down ourselves. Yeah. It's 64% increase in blackouts.
People are tapping the grid a lot, and it's a very different grid. It's no longer the centralized behemoth. Now, when you have all these devices, when you have EVs going around, you have heat pumps. There's just so much more demand and different types of demand for a grid that was built a century ago.
Thank you very much. All right, coming up, a holiday season retail wrap-up, including what to make of a potentially concerning sales growth number. And a reminder as we head to break, you can get the best of Squawk Box in our daily podcast. Follow Squawk Pod on your favorite podcast app, and you can listen anytime. Power that. We'll be right back. Well, we're about to close out the chapter on the 2023 holiday shopping season. Things aren't looking too good. According to MasterCard, retail sales between November 1st and December 24th increased 3.1% year over year. That is below the 3.7% forecast by MasterCard in September and well below last year's 7.6%, but still 3.1% growth. I guess it's a matter of perspective. Joining us to talk about what drove shoppers and which companies saw the benefit is Sucharita Kadali. Nice to see you today, Forrester Research retail analyst. First of all, what do you make of the number? 3.1% growth. Would you characterize that as solid? Would you characterize that as disappointing?
Well, it's not a great number, and there are a couple of reasons. One is that when you break it out into online versus offline, the online number was about 6%, and the offline, which is the physical stores, that's the vast majority of where we do our spending, and a lot of it actually is in categories like restaurants or grocery stores, which are not really holiday shopping places. That number was 2%, which suggests that there were a lot of sectors, like for instance, electronics, that just did not do well. The other factor is that there was inflation in that number, and inflation is about 3%. And what that means is that when you take inflation out, there was also almost no growth in spending, and that means that demand was pretty soft.
The National Retail Federation had predicted that the amount spent should have approached $1 trillion, and instead it looks like it's in the $900 billion range. That includes not only the stuff you buy, but also, you know, eating out and what you spend on groceries as well. Give us a sense of, you know, missing that mark and why that would be.
Well, I think that the biggest factors are just that consumer confidence. This has been one of the quandaries, I think, that has really perplexed economists and, you know, kind of just observers and certainly retailers for the last year, which is that even though a lot of the key economic indicators like unemployment rates and wages are relatively strong, consumer confidence continues to be pretty weak, and the shopper is not really spending above that inflation number. I think part of it could be that the consumer spent so much more over the last few years. They're finally done with all of the excess savings that happened during the pandemic. You have other economic factors, like in the case of students, that perhaps some of their anything that is left over and discretionary is now going to loan repayment. So there are a number of factors that could be driving consumer issues. And the retailer sales, candidly, were not great this year either. It was pretty mediocre from a qualitative standpoint. There wasn't as much from a store offer standpoint. There wasn't even as much from an online free shipping standpoint.
We talked yesterday on Squawk Box about the fact that some retailers are instituting fees for returning items now. If Americans are returning 15% of the gifts that they get for the holidays here, how much do those returns eat into the bottom line of these big retailers?
Well, returns are definitely a cost center. There are some retailers that do try to turn those returns into exchanges, or they try to somehow preserve that revenue. But it is generally perceived as a cost center. It's absolutely, and that 15% number is a conservative one. I mean, that's the store return rate for your average physical goods retailer. When you're looking at online, that number can be anywhere from 25 to 50%, depending on the retailers that we're talking about. And it's a huge, huge cost. There's a lot of technology now that's going in to try to optimize return rates. There's also pretty well-known stat that, you know, a minority of shoppers contribute to a majority of returns. And if there's a way to try to make the experience, you know, kind of more challenging for some of those heavy serial returners is what they're called in the industry, that is actually something that could improve your overall profitability.
Going into 2024 then, what are the retailers that you think have an opportunity for profit here? Where should investors be looking?
Yeah, there are some of the big names that we have been familiar with for a long time that have been capturing more and more share. Walmart and Amazon are two that continue to outpace the industry. They're outpacing inflation. In the apparel sector, companies like Lululemon do particularly well and have been doing well, also have been outpacing their peers in the sector and continue to have a lot of energy with the shopper. Where I would be a little cautious is in the electronics sector at the moment, and that means potentially companies like Apple, which have had some softer quarters recently. Now, that doesn't mean that it won't recover and its innovation won't support it through 2024. But absolutely, the electronics sector has been adversely impacted by
if they can't sell their highest end watch, and in fact they told the government that it would be material, you can see that that's a problem. Sucharita, thank you.
Thank you.
Coming up on Squawk Box. The hits and the misses at the holiday box office and what 2024 could hold for Hollywood's biggest studios. That and much more. Sometimes you just got to keep them, on the hook, right, when Squawk Box returns.
NBC.
Good morning. Futures trending higher this morning. Will the bulls continue to roll into the new year, breaking records along the way? We'll get you ready for the trading day ahead. Big Pharma's battle against obesity, a sort of gold rush for the industry this year. We'll look at the players getting into the race. And Barbie wins the box office crown for 2023, followed by Super Mario. Is there any hope for Hollywood in 2024? We'll have a sneak preview. The final hour of Squawk Box begins right now.
Good Wednesday morning. Welcome to Squawk Box here on CNBC Live from the NASDAQ market site in Times Square. I'm Contessa Brewer along with Leslie Picker and Steve Leisman. Joe, Becky, and Andrew are enjoying a well-deserved morning off. Let's take a look right now at the futures at this hour. Hovering around the flattish mark, you're seeing the Dow Jones Industrials implied open up 16 points, the NASDAQ implied open up 19, and the S&P 500, and all eyes here because we're just 0.5% away from hitting that record high again. We haven't seen that number in more than 2 years. That we're looking at 40,796. That would be the number to set the new record. In the meantime, Treasury yields heading downward this morning. There you're seeing the 10-year note at 3.861%, and the 2-year lower as well at 4.285%. Checking energy prices this morning, you're seeing WTI lower by almost a full percent, same with Brent crude, but in an opposite move from what we saw yesterday. Natural gas is up 4%, almost an equal move that we saw this time yesterday morning. Steve.
Let's get to Dom Chu with this morning's stock movers. Good morning, Mr. Chu.
All right, Mr. Leisman, let's kick things off with a check on shares of Amazon right now, which are up marginally after a muted day in yesterday's session. The cloud computing and e-commerce giant will unveil advertisements on its flagship Prime Video platform that will start on January 29th for customers here in the U.S., also in the UK, Germany, and Canada. Other markets will follow suit later on this year. Amazon, by the way, will also offer an ads-free option that will cost an additional $2.99 per month. So some news there on the media front streaming-wise. Amazon shares already up 83% so far this year. Our next check heads over to the crypto world. We know about the massive rally in shares of Bitcoin over the course of the past year. Remember, Bitcoin price is up about 158%. That gain has driven gains in business software and solutions company MicroStrategy, which has the most Bitcoin on its balance sheet of any publicly traded company out there. Those shares, by the way, have skyrocketed on the heels of those Bitcoin holdings. Over 174,000 individual Bitcoins on its balance sheet. So MicroStrategy shares up 330-some% over the course of the year. And those shares, by the way, seeing some movement because of that momentum here in the pre-market as well. And then we'll end with a broader check on the broader S&P 500 because it's been a banner run ever since those October 27th lows that we saw. The blue line is going to be the market cap weighted S&P 500, which is up 24% so far this year. But this move since the 27th has been an eye-popping 16% gain overall. But it's been outdone, believe it or not, by the equal-weighted S&P 500, which weights everything on a more equal basis as opposed to market cap-weighted. And since those lows, by the way, it's also been a more respectable 18% gain for that equal-weighted S&P 500 index. And Steve, what that kind of shows you a little bit more about is this idea that there is a possible broadening out of the rally, that it's not just those so-called Magnificent Seven stocks and tech, media, and telecom that have driven a lot of the gains recently, that many more companies have participated. Some will notice the outperformance in financials, notably during that time period as well. So it's an interesting move and dynamic, and one trend that a lot of traders and investors are watching to see if it carries over into 2024.
So
Steve.
I think that line, Dom, should be red because I'm calling it the Heinz 57 trade. You know why?
Why is that?
It's the catch-up trade.
Oh, I see what you did there.
The Heinz 57 trade. I just made that up for what it's worth. But here's the thing, Dom. It still has a ways to go to catch up with where it was, right? What's the differential there? It's like if you could zoom in there, 28% versus, what, 11% year to date?
So it's 24% for the S&P 500.
Okay, right. No, that's for the full year there.
And just about half, about 12 to 13% for the equal-weighted S&P 500. Remember, that gap is still fairly wide, as Steve points out. It wasn't that wide in the beginning of the year.
Right.
But again, the catch-up trade it doesn't seem like a lot. We're talking 200 basis points, 2 full percentage points of outperformance. But if you look at that on an annualized basis, going over just a couple of months, a lot of hedge fund managers and investors out there and traders would kill for a 200 basis point, 2 full percentage point outperformance during that kind of a time span. That could translate into a huge gain on an annualized basis. So a lot of folks out there are trying to see whether or not those trends can emulate themselves again over the course of the next year.
And the question is whether or not you've had the gains that you're going to get in that catch-up trade, or do those two over time, I guess we need to see a 10-year chart of that maybe some other time, whether or not over time they tend to go together, or do they tend to have just a bunch of outliers lead the way all the time?
Well, here's what I would say. I would say over the course of the last, since the great financial crisis and the era of zero interest rate policy.
10 years, Dom. Look behind you, Dom.
Ask and you shall receive.
Unbelievable.
So if you look, I mean, there's no doubt about the fact that during a zero interest rate policy time frame over the course of the last decade and a half, that you've seen the value of mega cap technology, media, and telecom stocks overall drive the bulk of the gains in the S&P 500. And what that shows you here, you're kind of seeing that bear out. Over the course of the beginning, say 5 or 6 years, it's been pretty close. But it really has been the meta platforms, right? The Microsofts, the Apples and whatnot that have done the heavy lifting, which is why you're seeing that kind of gap widen out, especially since the pandemic lows, because the focus has been so much on the valuations being driven by zero interest rate policy and, of course, the recovery from the pandemic. So mega caps are huge in this story.
And I have to thank you and Terry King for coming up with that chart like this.
That's not me. You called for that shot. Teresa over there is the one who's doing it. All that we're doing is trying to put some words to the graphics that you're seeing out there, Steve.
Well done. From catch-up trade to catching up to Steve's request.
Heinz 57.
Heinz 57. We'll see what other condiments have in store for 2024. Let's take a closer look.
Mustard trade.
At the markets with Andrew, the mustard trade, exactly. Relish of Morgan Stanley Investment Management. Andrew, just to kind of tag on to what Dom was showing us there, it's interesting because the so-called catch-up trade, as we were describing, that 200 basis point differential between the equal weighted and the S&P 500, to me, that's happening largely during a period where you don't have much in the way of fundamental news. It's after a lot of the earnings reports have come out. You've got obviously a lot of reaction to a potential pivot by the Fed. What does that indicate to you as we look into 2024 when we should get some more idiosyncratic information, some earnings reports, some fundamental news? What does that tell you about just kind of the trend and the broadening out that we've seen this year?
Sure. Well, look, first of all, Leslie, I think you have to remember that, unfortunately, the first year off a bear market low, investors sell stocks. It happens all the time. We saw net outflows from equity, mutual funds, and ETFs for a year off the COVID low, and we saw it again this go-round, and it's about 1 year later, investors flipped from being bearish to bullish. It happened in February of 2021, and it happened in November of this year. And when they go to buy, when they realize they shouldn't have been selling, they should have been buying, they look around for things that they feel that they could play catch up. So it is entirely logical that the equal weighted S&P has played catch up to the cap weighted because it was really lagging. And so as I move into next year, the breadth of the market, and so what Dom talks about, so many stocks are working now. If you look at history, it is an extraordinarily bullish signal for the market. You have to have your head in the sand to really be bearish at this juncture. It means the market is breaking the upside. As Contessa said, we're near that 47.96. I think when we break through that level, you're going to see an even higher level bullishness. Keep in mind, the market has gone nowhere for 2 years, and that's about to flip. So I think it's a bullish sign for the markets going into next year. My only comment, I'm always interested in what people do not expect. I hear everyone talking about how equal weighted will outperform the cap weighted. That seems to be an overwhelmingly consensus view next year. And so I'm intrigued by, well, what if these big stocks, they have not kept up, obviously, as Don's pointed out, they have not kept up with the broader market. And so they look like they stalled out recently. So new money, I think new money coming in might want to flip and say, well, maybe these stocks will play catch up. Yes, they've done better year to date, but they've kind of lagged recently.
Interesting. Well, you've got, what is it, $1.4 trillion that went into cash this year. Obviously, cash was an attractive asset. Bonds did pretty well if you're a bond investor, and I know you believed that investors were underweight equities going into Q4. Do you believe they are still underweight equities, especially as you look at the various attractiveness of the other asset classes out there?
Sure. The hottest product this year was the money market. And my experience is whatever is the hottest product usually doesn't do well the next year. So if rates come down because the economy is slowing down, that will make the money market not as attractive as it was this year when rates were higher. Some of that money will come out and it will go into bond funds, and some of it will go into equities. Look, at the end of the day, we've just seen fund flows turn positive on a weekly basis. It doesn't stop after 3 weeks of positive flows. I think that money will come back into equities, and that will push the second year of a rally as it did in 2021. Doesn't mean the market looks a little bit short-term overbought, but I think it's a good sign for equities for next year.
How much does investor psychology play a role, especially as you kind of turn that calendar year over into the new year? You've got obviously 2023, really the Magnificent Seven kind of catapulted into the consciousness of your average investor. Do you think because the returns were so strong throughout the course of 2023 that could be maybe a hindrance to performance next year, just based on psychology factors alone?
Well, first of all, I love that you bring up psychology, because I think it's incredibly difficult to predict GDP, earnings. Look at all the people who predicted a recession this year. Earnings were going to collapse. Boy, oh boy, was that dead on wrong. But what was so consistent is just what you mentioned, psychology, which is, unfortunately, investors cumulatively get bearish after a bear market. And we came into this year with overwhelmingly negative consensus. And so it's entirely consistent with what we've seen in the past. We are moving slowly from the fear stage to the greed stage. And I don't think 1 year is enough. I think it will continue. That is the consistency of investing. As I said before, I think predicting economic data is very, very difficult. And all you have to look at is what was the average price target for this year to know that that's a fool's game. So yeah. I think the psychology is we are in the process of moving from fear to greed, but we're really only very early in the stages. I think next year is the continuation of 2023.
Fascinating. Yeah, behavioral economics, behavioral finance were my favorite classes in business school as well. Andrew, thank you.
Thank you.
All right, coming up, warm weather giving a chill to natural gas and heating oil prices. We're going to look at the trend and the rest of the energy market next. And later, Eli Lilly, one of the big winners in the obesity-fighting gold rush of 2023. Will this sector continue to be a big winner next year? That's coming up in the next half hour of Squawk Box.
50% off.
Welcome back. The price of natural gas has tanked in 2023 amid record production and warmer temperatures. For a closer look at what's ahead, let's bring in Tom Closa, Oil Price Information Services Global Head of Energy Analysis. Tom, thanks for joining us. I guess we're up a little bit today. I saw these weather maps yesterday. They were all red for, I guess it was the end of December, but now there's some blue on the forecast maps, which they're temperature anomaly maps, and those are the things that upon which gas really trades, right?
Yeah, and I mean, weather is the 90% fundamental that moves natural gas all the time. It's almost like Mother Nature is short, you know, some of the heating elements, whether it be natural gas, to a certain extent, crude oil and heating oil in particular, because she's bailing us out in another winter here, without question.
And that's the second one in a row, right? Because last year, obviously, when there was big concern about supplies of energy from Russia, had it been a cold winter, we would be talking about very different results for the economy, for the global economy, really. But again, it's interesting the way you put it. It's almost like you're feeling a little paranoid, like Mother Nature has it in for you, Tom. So tell us and just to be clear, they can't, the guys producing the natural gas, they can't stop this stuff from coming, right? They can slow down over time, but not on a week-to-week basis, right?
Yeah, they can leave the liquids in natural gas, you know, things like propane and butane when it doesn't pay to remove them, but they're pretty much tied into this. And if you look at the numbers, I mean, last year we saw the equivalent of $500 or $600 a barrel oil for European natural gas. It's down quite a bit now. It's probably about 4 times the U.S. price. And really, the only thing that's sustaining the U.S. numbers at less than half of what Europe and Asia are, you know, tends to be the LNG export. So it's very, very cheap. Heating oil is very cheap, probably down to about 14 or 15%. Right. And actually, jet fuel is down about 25% from last year.
So, Tom, there's nothing to get too geeky about the weather, which I actually really like, but there's two kinds of forecasts out there. One is these short-range forecasts where they put out the temperature anomaly maps, and you can see they're red or blue. But there are these longer-range forecasts, and if I'm not mistaken, this is an El Nino year, and I think that means warmer temperatures in North America through March. Is that right?
Yeah, and well, it is. The one thing, Steve, you have to be careful of is in an El Nino year, sometimes some of the winds and the masses of air do allow for a polar vortex. And, you know, one thing about natural gas, we've got a lot in Texas and Louisiana and places like that. We don't have a lot of it downstream because it doesn't get stored that much downstream. Right. But if you had a polar vortex in New England, the middle Atlantic, or in the northern Midwest, you could have a problem. So that's still something we have to worry about if the scientists are accurate about, you know, perhaps a little bit more of a chance for a polar vortex.
Tom, I don't want to get too corny here. I don't want to cue the national anthem, but I'm enormously proud of what the American energy industry has done in terms of responding to what's happening in Russia and Ukraine. How much natural gas are we exporting right now? How vital is what the American natural gas producer is doing relative to keeping Europe warm and keeping Europe safe right now?
Yeah, I mean, we are the Saudi Arabia natural gas to the world. We're a combination of the Saudis, the Russians, and the U.S. and crude. And it very much makes us a privileged continent. If you look at Latin America, where we provide a lot of gasoline and diesel, we provide it because it doesn't make sense to have refineries in Latin America because they don't have cheap natural gas, let alone natural gas in a lot of places. And when you're making gasoline and diesel, you use natural gas to fire up the boilers, but you also take the hydrogen out of the natural gas, and that enables you to make some of the refined products. So one of the reasons why we're exporting 1.2 million barrels per day of gasoline is because of the fact that we are the privileged continent right now, more than any other continent in the world.
Tom, I know that there's legitimate ecological, environmental concerns, but how important is this Louisiana natural gas terminal that they're talking about, or liquefied natural gas terminal?
Well, it's important to accentuate the exports, and we've got the export capability to move an awful lot more natural gas that we can find at probably break-even numbers close to $2 per million BTU or so. And, you know, that's going to be one of the battles that rages, because this administration is out for environmental justice. So they want to make sure that if we have these facilities, they're operated properly. And yet, in the balance of trade, you know, what we're sending out there. Steve, the one thing I would mention is we always talk about the Strait of Hormuz as being the most vital choke point in the world. A very close second now is the Gulf of Mexico, because this summer we'll be exporting 11 to 12 million barrels a day of various hydrocarbons.
Unbelievable. Tom, really good stuff. Thank you very much for joining us.
Thanks for
natural
having me.
gas for the winter, keep you nice and warm.
Toasty. All right, coming up, 2023 saw some blockbusters out of Hollywood, yet we are still not back to pre-pandemic levels at the movies. After a break, are there opportunities in film in 2024? Stay tuned. You're watching Squawk Box on CNBC.
NBC.
The 2023 box office struggled with film delays because of the Hollywood strikes, a focus on streaming, and dwindling interest in superhero movies. The highest grossing movies of the year are Barbie, followed by Super Mario Brothers movie and Oppenheimer, which both of the second are Universal films.
I only saw the third one.
Oh, you did?
I saw Oppenheimer, that was it.
Okay, well, I saw the first two.
Me too.
Because we have kids.
You didn't go to Guarding the Galaxy or Guardians of the Galaxy?
No, I saw that on the plane. Yeah, so
Did
that
you
was,
really?
Mm-hmm. Joining us now to discuss what to expect in 2024 is Paul Dargarabian. No. I can do better than this. Dargarabedian. How did I do?
You got it. You
ComScore
did it
Senior
perfectly.
MBA.
Thank you.
You know what? I want to get it right because, I have a 3-syllable first name and it's important that it's accurate. So, Paul,
Well,
thank you for being here.
my name won't fit. It won't even fit on a movie marquee. That's a problem sometimes.
Practice makes perfect. Let's talk a little bit about the much proclaimed demise of the superhero movies. I'm looking at the top box office here, and I still see 3 superhero movies made it to the top 10. It's not all bad, is it?
That's right. I mean, there's this idea that there's superhero fatigue, and you make a great point. When you look at those top movies, there are many superhero movies among them. I think it's more an issue with audiences who are uninitiated, who aren't necessarily big fans of comic book movies, having to do a ton of homework to figure out how all these characters and universes fit together. There's a huge amount of these superhero programs on the small screen as well. And I just think there's been an oversaturation of that. But yes, if you look at those top movies worldwide and domestically, a lot of superheroes there. But this weekend with Aquaman and the Lost Kingdom, that earned about $38.3 million for the 4 days, according to our ComScore data. I think people had hoped for more. But I think that audiences love going to the movies. And if you have a unique or different way of telling a story, like with Five Nights at Freddy's, Godzilla -1, and in fact, this past weekend, we had 2 Japanese cinema and 2 Indian cinema titles in the top 10. I think we're getting a lot of actionable intelligence from audiences who are saying, either with their absence or presence at the movie theater, what they want to see on that big screen.
How much of that is because it's super important for the movie makers to appeal to an international audience? I mean, I'm looking at the domestic earnings versus worldwide earnings. In every case, like Barbie, more than doubled what it made domestically with what it made internationally. That says to me, you gotta make movies that appeal to Europeans and Asians and South Americans.
You just hit the nail on the head. That's exactly what's going on. And in fact, the first Aquaman movie earned almost 71% of its box office outside of the US and Canada in the international market. In fact, this weekend, it did much more business internationally than it did in North America. So you're absolutely right. A lot of these, having a global view is very important, both from the filmmaker perspective and also from the studio perspective. And if you look on streaming, look how much content on streaming is internationally flavored, has a point of view that has, you know, everybody is kind of included in that. There's something for everyone there, but you also need it to be unique and different. But yes, a lot of those franchises, the big ones, really rely on that international box office. Fast X, you know, the Fast and Furious franchise, for years, those have totally relied on that international box office to build up their profitability.
Well, I wanted to ask you about all of this chatter about the potential tie-up between Warner Brothers Discovery and Paramount. If you see a merger of that scale, or, you know, that then gets floated, well, could Comcast be interested with NBC Universal? What does that do to the creative content that we see in the movie theaters?
Well, you know, that's really interesting, because by combining 2 huge studios, it really is a big deal for their streaming platforms, because they want that content. And a lot of these studios, or these entities, these streaming entities, they want that filmed entertainment on a big screen first, and then that can feed the streaming side to bring people on board. And I think for audiences, they follow showrunners, movie franchises, the archive titles, the library titles that a lot of these studios have. So, and then you also have everyone circling around, you know, whether it be Amazon or Apple, you know, Warner's, whatever it may be. All these companies are kind of doing this dance. They're trying to figure out what everyone is doing. We're in a time of incredible change right now. I think we're seeing a shift in audience taste. Also, I think we're seeing how streaming is impacting movie going, meaning I think a lot of people who love streaming, they also love going to the movie theater, but streaming is presenting so many different types of content that it's opening I think the minds of the audience that they want something different, not cookie cutter all the time.
Paul Dergarabedian, thank you so much for joining us. Appreciate your time this morning.
Coming up, the Fed seems like it's gotten a handle on the inflation picture in the last few months, but should investors brace for a relapse next year? We'll talk about the risks to the economy. Also, a reminder, as we head to break, you can always watch or listen to us live using the CNBC app. Stay tuned. You're watching Squawk Box. We're live from the NASDAQ market site in Times Square. Welcome back. Let's talk about inflation in 2023 and what to expect next year. Fortunately, we have Steve here, and he has been mulling over that for all of 2023. I bet there's not a day that goes by that you don't think about inflation. Is that right?
Yeah, and I didn't used to think about it at all. Remember?
No, we never
used to
talked
think
about
about it.
inflation.
But take a look at that chart right there. Looks pretty good. We're heading back on that's the year-over-year change in the headline inflation, 2.5% to 2 it's right around 3% right now. The trouble is this, last year around this time, we had some good data. It turned out that was revised upward, and so we thought we were out of the woods, and Fed Governor Chris Waller called it a head fake. Now I talked to Mike England from Action Economics, and he suggests, last year was the result of some seasonal adjustments, some really nerdy kind of things that had to do with the Ukrainian war, that they expected a rise in prices, never happened. So he doesn't think that we're in danger this year of another head fake. But there is one other thing to look at, which is let's go back in the Wayback Machine, I guess they call it, to the 70s. Ooh, some sound effects, please. There you go. So look at that on the left there. Inflation went up, came back down, Fed cut rates. What happened? Went back up. That's the thing that really animates a lot of Fed policy right now. This idea that there was this inflation redux, inflation return, and whether or not it would be too quick to cut rates next year because you have this. Now remember, oil prices came back up, so that was a big part of it. You remember that, Contessa?
I don't actually, but
You don't?
I've read about it. Yes.
Ooh.
No,
Kinda hurts a little bit.
but to your point,
Yeah.
if past performance is no indication of future results and
Right.
everything, do you think that the specter of that double peak in inflation is overplayed?
I don't know if it's. We're going to ask our guests about this because that's always like my leading question. What I care about more than anything is that I think it animates Fed policy. I think it drives them to be a little more reluctant to cut. So that's what I think is important about it. Let's take a look at what we can expect from the economy and the Fed in 2024. Joining us now, Ben Harris, the Director of Economic Studies at Brookings, and Michael Strain, Director of Economic Policy Studies at the American Enterprise Institute. Mike, let me start with you about this issue of how afraid should the Fed be of cutting too early and having a return of inflation like we had in the 70s?
Steve, I think it's a great question. The case for being concerned is as follows. The labor market is still very, very tight.
Right.
Labor demand is still in excess of labor supply. Labor demand is still way in excess of what we thought in 2019 was a lot of labor demand. We have 9 million job vacancies right now. In 2019, we had millions fewer and thought that we had quite a bit of labor demand. Potential GDP is likely lower than actual GDP will be. So not just the labor market, the economy overall likely will be running hotter in 2024 than its underlying potential. Services inflation is slowing at a much slower pace than overall inflation. So we have a services inflation problem. Wage inflation is slowing at a much slower rate than overall inflation. So wage inflation is still inconsistent with the Fed's target. And most importantly, the market is reacting to the Fed's communication strategy, the Fed's decision at the last meeting, by going gangbusters. And so what the Fed wants to do is to tighten overall financial conditions. Overall financial conditions, by some measures, are looser today than they have been in 2 years. The market is expecting many, many cuts in 2024. And so all of this, I think, should make the Fed concerned that inflation, if it doesn't rebound, it might just kind of get stuck at the 3% level it currently is, which is, of course, much higher than the Fed's target.
Just to fill in some of the data that Michael was talking about, in 2020, before the pandemic, 6.7 million job openings, and now it's 8.7 million. So Michael it was like a cold stream of cold water all over the optimism of this market, Ben. Do you want to try to restore the optimism of rate cuts, or do you want to pile on, Ben?
So, Steve, I think I agree with what you said at the outset, which is I think markets shouldn't be so quick to assume the Fed is going to cut. I mean, I look at this Fed and I see a group that's dying to pause and doesn't want to hike and doesn't want to cut unless it is absolutely forced to. Now, if we get 3 months of really strong inflation data, the Fed's going to have to cut in March, and they'll cut by 25 basis points. But it's going to take some pretty sharp declines in core PCE for that to happen. Now, they did show in their summary of economic projections in December that they are expecting over the course of the year core inflation to fall by about 80 basis points, which is a lot, but that has to happen in order for the Fed to cut. So I think we're kind of in a pause unless the data forces you out of that pause type of moment right now.
Ben, let me stick with you. Give us your best outlook for next year. Is it crazy to think that the Fed lands this plane? We have a soft landing. We keep unemployment low, GDP at potential, and we just go about our merry business in 2024?
Yeah, I mean, this economy right now is like the definition of a soft landing. Unemployment's at 3.7%. We've had this gradual moderation in the labor market. That's something we've almost never seen. You saw labor market tightening not because of, easing in the tightness in the labor market, not because of raising unemployment, because more people are coming back to the labor market, which is a great thing. You're seeing strong consumer spending, household balance sheets, except for those at the very bottom, are still in really good shape. So I think there's a ton of reason for optimism. My base case is for slow but positive growth over the course of the year, which is consistent with the Fed. I just don't think there's much reason to think that we'll see a recession the next year.
All right, Michael, here's your opportunity now to throw some cold water on what Ben is saying. Are you on board with this fabulous soft landing that we're going to have next year?
I'm kind of off message for the third day of Christmas with all this negativity. I think okay. Ben and I see this a little differently. You save people money,
you're on message. That's a good thing.
That's great. 3 scenarios. One is soft landing. A second is the economy heats back up again. The Fed has to hike some more, or at least pour even more cold water on this dot plot that shows 75 basis points of reduction, which is what the Fed's forecast is for 2024. Third scenario, recession. I would put a soft landing as the least likely of those 3 scenarios. We don't have soft landings in the U.S. Economy. You can debate, how many we've had since World War II. Some people say 0, some people say 1 or 2, but it's not all that many. And I think the underlying reason for that is that recessions are ultimately about a loss of faith on the part of investors and on the part of consumers. Think about this in terms of the labor market. The soft landing narrative is that monthly job gains kind of slow to the 30,000, 40,000 jobs per month level, stay there until inflation comes down, stay there after the Fed starts cutting, and then kind of come back up again to right. 150 a month. That just seems way too neat and tidy. If right. CEOs, if hiring managers, if small businesses wake up in the morning and they see 60,000 jobs gained this month. A 20 or 30 basis point increase in the unemployment rate. They're gonna be worried about their revenue projections. They're not gonna add to headcount. They're gonna try to let some workers go who they think aren't necessary, and then the recession psychology takes hold. That's I think a much more likely scenario than this really neat and tidy Goldilocks soft landing scenario.
Michael, we have to leave it there. Do you have nowhere to go on New Year's Eve? Is that a part of your outlook?
Let me help you. Let's see if I can make this work. Look at that. Christmas cheer in the necktie.
I see it in the necktie. I'm not hearing it in the forecast at all, though, Michael.
Yeah, you got to find it somewhere.
But that's why I'm wearing the tie. That helps balance it out.
No, it doesn't. Not at all. Ben Harris and Michael Strain, thank you so much for joining us this morning.
I like it. I'm all into the tie.
I got my red tie on.
Does it play music?
It does not.
That doesn't count? Grinch?
Come on, look how nice that is.
Coming up, 2023 was the year of the weight loss drug and the weight loss drug maker. Novo Nordisk and Eli Lilly, just 2 of the big names in that sector. After a break, we'll talk about what's ahead in 2024. Is there a diet in the future? Stay tuned. You're watching Squawk Box on CNBC.
only in theaters.
Weight loss drugs skyrocketed in popularity this year. Eli Lilly and Novo Nordisk are up more than 50% year to date. Our next guest says weight loss drugs will likely continue to dominate the discussion within healthcare as companies like Roche and AstraZeneca will get into the race. Joining us now with more is Emily Field, Barclays head of European Pharmaceutical Research. Emily, is there anything that you see that could slow this train down?
Good morning. I mean, I think what we're most watching closely on our side is really supply, just because both Eli Lilly and Novo Nordisk, the demand has just been so unprecedented for these drugs that really we think sort of how sales evolve in 2024 is going to be dictated by just how quickly can they make these drugs. They're trying to ramp as quickly as they can, but we think that that's really what people are going to be watching is just how much can they produce to meet this demand.
What do you estimate to be the total addressable market here? I've seen some estimates as high as $100 billion in sales by 2030. I mean, does that sound right to you?
You can absolutely put us in that camp of we've forecasted $100 billion for the obesity market by 2033, so within the next decade from this year. And we think that's just a matter of new drugs coming on the market from Novo and Lilly. Of course, other competitors will eventually make it to market, and then expanding both within the U.S. and globally as companies launch outside of the U.S. market.
We've seen a lot of pharmaceutical deal making, even in this time of year, which traditionally hasn't seen too much in the way of announced deals. Scott Gottlieb put it on Twitter yesterday by saying he thinks it's in spaces where there are natural barriers to entry, often owing to formulation, manufacturing complexity. That may not be coincidence. We'll see a bid put under these kinds of platforms as patents are eroded by policy mistakes. Do you see that continuing to be a key driver of M&A? If not, what do you think will be a catalyst for additional deal making?
Well, that's a great question. And I would say sort of, this diabetes and obesity space, we get asked all the time, why are Novo and Lilly so far ahead? And I think just the rest of the field, due to a number of factors, was underinvested in this space. Obesity just has been a graveyard for development for a number of years. So now you have Lilly and Novo out in front, but this is going to be such a big market that a company really can't be out of it completely. So that's why we've seen companies like Roche, like AstraZeneca,
that just
buy
seems,
their way in.
It's baffling, though. Like, if you look at the obesity crisis in the United States alone, the fact that anybody could think that that should be a graveyard in terms of pharmaceutical development is jaw-dropping. And then in the meantime, I know you're looking to see more data on then how these drugs have an influence on sleep apnea or liver fibrosis or chronic kidney disease. So that, in other words, if you're solving an obesity problem, there is effects on other health outcomes as well.
Yeah, exactly. That's the key to why we think this market is going to be so big, because both companies are producing data to show these aren't just vanity drugs. They are going to help with so many health-related conditions. Novo had data earlier this year showing a 20% reduction in a high-risk population of having a heart attack or a stroke. And we think data just like that, sleep apnea, liver disease, kidney disease, this is all coming in 2024. That's going to build this notion that you can pay for these drugs and get a return.
Emily, I've seen a report that people who have critical conditions that require some of the drugs used in these weight loss drugs cannot get those drugs. Is there any danger of a regulatory or a move by government that would stop some of this use of the drug for, I guess, what you might call voluntary reasons, rather than those and provide and get those drugs available to people who need them for critical conditions?
Yeah, we have seen that particularly in the drugs that are meant for type 2 diabetics. Novo
Right.
and Lilly both work very, very closely with the regulators to ensure that the right patients are getting the drugs. And we think we're going to continue to see that evolve just as supply comes online. But, the companies are certainly playing ball and have very good relationships with the regulators. So we don't see any regulatory risk to either of these companies.
Yeah, it seems like that will be a key story to watch for in 2024. Thank you, Emily.
Thank you.
We have some news just coming in this morning. The New York Times suing OpenAI, the creator of ChatGPT, and Microsoft for copyright infringement. The Times says millions of its articles were used to train chatbots that now compete with the Times as a source of information. The paper says the defendants should be liable for billions of dollars in damages.
This is...
Microsoft is an investor in OpenAI and has incorporated the technology into its Bing search
potential
engine.
big story. I don't know how they thought they're going to get away with it.
But you've seen concern from the New York Times is maybe the biggest name in journalism so far to come out with this. But we've seen the concern from the actors and the writers when they were making sure that AI protection was written into the contract.
My wife found out that her novel was one of 30,000 ingested into a large language model. Does she get paid for that? Should she be paid for that? I honestly don't know the answer to that, but...
Well, the New York Times is saying yes.
Well, we have very strong copyright laws in this country.
Except that when they're broken, then nobody...
Well, except when we have to adapt to new technology.
Right, exactly.
Coming up, what to watch ahead of the opening bell on Wall Street. We will be right back.
Back.
A little more than half an hour until the opening bell on Wall Street. Joining us now, Catherine Rooney-Vera, who's the chief market strategist at StoneX. We've had so many insiders today talking about whether we're too optimistic, whether the optimism of the holidays is bleeding over into the new year, or whether there's cause for concern that after such a big run-up in the markets, that we're kind of overdue for some big pullback. Set the scene for us.
Well, I heard a phrase today, weaponized FOMO, and I think it makes sense. There's indiscriminate buying now. So everyone's very positive, expecting that the Fed hikes cuts more than 150 basis points. What I would say is, fine, keep your long positions, but hedge them. I mean, the VIX is very low. You can get cheap puts, and I think it makes sense. So if you're going to stay long and overweight the Magnificent Seven, overweight triple Qs, overweight S&P market cap, I would say start to take hedge positions, and that doesn't have to just be buying puts. That can be buying gold. That can be buying tips. This is the just-in-case trade that I think is cheap right now, and I think is prudent.
The interesting thing about a weaponized fear of missing out is that we're seeing the S&P only 0.5% half of 1% from a record high that we haven't seen in 2 years. And you know, the psychologists and some of these advisors say people don't like to buy when you hit that peak, that if they are not in it already, now is not the time that they're getting, that they feel like they want to get in it. Do you think that that's the fear of missing out overwhelms then the fear that I've already missed out and I'm just going to stay and wait for it to come back down?
There could be that, but I do get a sense that there is this still this AI trajectory that everybody kind of wants in. So the tech sector is very strongly held, especially in retail guys' portfolios. And what I would say is be careful with that, because if the Fed doesn't cut as much as is currently priced in, which I think is an inordinate amount, then you could see some headwinds and some serious ones on the cyclical sectors.
Another interesting dynamic of 2023 is that your traditional stocks and bonds portfolio worked
Right.
about 17% this year. Is that still going to be something that carries over into next year, especially as we look at just the prospect of rate cuts and all sorts of other cash shifting trends that took place this year?
So I like fixed income, but the biggest headwind or risk to the fixed income space is positive correlation, the continuation of positive correlation with the equities and fixed income space. I doubt that continues. It's historically very unlikely to continue. It's an anomaly, it's an aberration from financial reality that you have that positive correlation. And the reason that you had it is because of high inflation. Inflation is coming down. Whether it continues to come down because of immaculate disinflation or because of recession, I think that's still to be determined. But the fact is, I think that the negative correlation will return, lending additional credibility to the 60-40 portfolio.
Catherine, how much of your clients' money right now is in one-year treasuries maturing in February, March, and April? How much right now is in money market funds?
Yes.
And what are you telling them to do with that money when it matures?
If bond yields continue to move lower for good reasons rather than recessionary reasons, that money is going into equities.
Boom. Don't pass go. Don't collect $200 in a money market fund. Just go right in equities.
If bond yields can move lower because the U.S. consumer rolls over, which I think is an underpriced risk for many reasons, that's not good for equities. So my advice, Steve, is to hold on to those juicy 2-year treasury bills that out-earn the S&P 500 right now. Have a nice hefty allocation to fixed income. You know, the steepener trade I think looks
So you're
good.
saying take those 1 year and roll them back. Roll them back into ones, roll them back into twos?
Look, I think it makes sense. I think the Fed is going to be cutting. I think steepeners make sense right now. And I think having a hefty position in fixed income is a good bet, especially if we get this negative correlation returning.
But not in the money market fund.
I think you should have a hefty cash position, and you're going to roll it into short-term duration fixed income, yes.
Catherine Rennie,
Thank you. My pleasure.
Thanks so much, Catherine. We're going to take one more check of the futures market this morning. Where are we at now? I haven't seen it in a little bit. Is it in the big board there? Where is it? There it is. Are we going to make that record today, Contessa?
You know, like...
You feeling it? Are you feeling it?
If you're looking at only need half of 1%, don't you think that everybody just goes to buy just to see
Let's
it
all
happen?
make
Ding,
it.
ding, ding,
You want
ding.
collective action. We have to go. Join us tomorrow. Squawk on the Street coming right up next.
Good Wednesday morning. Welcome to Squawk on the Street. I am Sarah Eisen with Scott Wapner, live from Post 9 at the New York Stock Exchange. Carl, Jim, and David have the morning off. Take a look at futures improving throughout the morning. Getting a higher start, at least if you look at S&P and NASDAQ futures, both pointing higher. Dow futures unchanged. Our roadmap begins with the stock market momentum on Wall Street. The S&P 500 within 0.5% of a record closing high.
Also ahead, Tesla joining the December rally. The stock doubling year to date ahead of the company's quarterly deliveries report.
Plus, the latest on Houthi rebels attacking vessels in the Red Sea. One shipping giant says it will continue to avoid the area. We'll begin, though, with the markets chasing history here. Scott, we know the level to watch now, 47.96.
And change.
That's
Getting
the closing
closer.
high.
Getting closer.
But interestingly, this rally, which yesterday it started on our show and really picked up steam throughout the day into the closing bell, being led by the Russell 2000 index of small caps. And I think it's hard to ignore the 1.5% move that you've seen there. wondering if the Russell's going to break out. We're at a 20-month high. It's been in this sort of stuck narrow range, underperforming the rest of the market. As the market picks up steam, it broadens out into small caps.
I think just since this really rally got going in the last days of October into the very first days of November, the Russell's up like 24% over that period of time. So it's gone from nowhere to everywhere really, really quick. You have people like Tom Lee suggesting you could get 50% gains out of small caps in 2024 because they've dragged so much. And his whole thesis is what you know, economy performs well, inflation comes down, Fed cuts a bunch of times, and then it's time for the rally to broaden out.
I think he believes inflation is coming down like a rock now, which you could make the argument. If you look at some of these 6-month annualized charts of things like core PCE, we're lower. We're back down to the Fed target kind of ranges. So
hey, what was we had the who was the former Fed economist we had on yesterday? Who suggested the last mile? I'll never forget this. The last mile is the easiest.
Well, that's what Jenny Yellen says.
I know,
well,
but that's sort of counterintuitive, right? People think the last mile is going to be the hardest, the stickiest, maybe, to get inflation down to target. I was just struck by the fact that she said that she thought it was going to be the easiest, and that would play right into the bullish hands.
The only question at this point is how do financial conditions impact that? Because we've seen this steep drop in treasury yields. That's going to bring rates down, mortgage rates, credit card rates. I mean, it's good. It's relief for consumers and relief for Americans, but it also threatens to undo some of the progress on inflation. That's going to be one of the tells. By the way, the 10-year note yield this morning hit a new low of 3.844%, lowest level since December 21st. The German 10-year Bund yield hit the lowest level in a year. So we continue to see these sinking treasury yields, which has been fodder for this rally.
How about, as we look at these forecasts, do you see Goldman's 10 forecast for 24? Because it plays right into what you're talking about. No, number one, GDP growth. I've highlighted what I think are the most important. GDP growth will beat expectations. Consumer spending beats expectations, right? So growth is good. Yep. The consumer hangs in. Core PCE inflation will fall below the 2.4% forecast, and the Fed's going to cut 5 times.
And bank lending will reaccelerate. So it really is kind of a rosy forecast. The only thing maybe to quibble with is that they say that the balance sheet runoff won't end until 2025. So by the way, that's still happening. The other kind of negative part of it is that fiscal policy will not turn stimulative ahead of the election. We kind of knew that already. We've got a debt problem.
Yeah,
overall,
that's true. How are you going to introduce more fiscal policy and stimulate after all of the criticism about whether that stoked inflation even further? Right. Yeah, of course. The Biden administration wants the economy to be as good as it can possibly be, and consumers to feel as good as they possibly can feel as you get closer to the election. But the dynamics of doing anything are going to be so difficult.
Ugly. And they are scratching their heads about why people aren't feeling better about the economy, given we have very low unemployment, very tight labor market. There's still plenty of job openings for those unemployed. We're seeing real wage growth for the first time in a while. Inflation is starting to come down. So I think people are wondering about consumer confidence, which has been weak while spending has been higher. It doesn't necessarily track. In the Goldman forecast, I think the biggest out of consensus call, they say, those economists, is the 2% forecast for 2024 GDP growth, well above consensus of 0.9%. They think consumer spending is going to beat expectations, and they're pinning it on this real income growth that we've seen, 3%. Household net worth, they say, close to an all-time high. So that's the soft landing scenario.
It's all going to come down, I think, to the very simple question. Can the Fed cut rates because inflation has come down, or are they going to have to cut rates because the economy slows too much? It's all going to factor into that. I mean, that's where I think the market conversation begins and ends, because that's either the soft landing, the Fed pulled it off scenario, or they did too much. It took a long time to have these long and variable lags show up. They finally do. The economy slows too much, and their hand is forced. That's what you don't want to have happen.
And there are plenty of those that are still arguing that, and they look at leading economic indicators, which have had a string of negative numbers portending recession now for the last, year and a half. They look at the yield curve, which is still inverted and continues to be inverted, even though it has steepened a little bit. They look at the 10-year yield now falling like a stone. Is it just factoring in higher odds of lower cuts, or does it factor in some sort of economic weakness?
You also wonder, as the market has rallied so much, as you make the turn, the S&P's up 24% now year to date. Do people stay with this rally, or do they start to get a little bit skittish? I noticed that you had $10.5 billion of net outflows from stocks last week. That was breaking a 9 straight week inflow of inflows. So, you've got all this money rush in, market's going up. Now it gets a little bit toppy and tired, perhaps, and people maybe, stop putting money in for the meantime, right? You had an initial move as rates came down, maybe some money from cash or money markets or whatever, came into stocks, and maybe that slows a little bit too.
Or is there some chasing in the new year? Because remember the money market wall? That's one of the charts I would think in the stories of 2023, which is how much money went into cash, essentially, into money market funds, because they were getting paid to do so with higher treasury yields. $6.1 trillion is how much money is held in money market funds. It's about 29% higher than its level just before COVID, as people rushed in because the rates were attractive. Does that money come out and go into stocks and bonds? Is that even a tailwind or not? I remember talking to the Charles Schwab CEO a week ago or so, Walt Bettinger. He said, no, that's not in itself going to move stocks higher, but it could speak to the fact that there's still demand and there's still a lot of caution on the sidelines.
Well, there's not much caution from Ed Yardeni, I'll tell you that.
No,
he was on Closing Bell yesterday and had this to say about his target for where he thinks the S&P can go next year and thereafter.
5,400 by the end of next year, and then 6,000 by the end of 2025. I think this is a bull market that has legs, that's going to continue to charge ahead. I think what we're seeing here is a significant relief rally, and the relief is that we're not going to have an economy-wide recession, and the relief is that inflation, in fact, can come down without a recession.
That's the optimistic case.
Yeah. Well, one of many. As targets come out, and some targets have come out, I think we were talking yesterday that even targets that came out a month ago are being revised higher, right? I think it was David Kostin, he had this target of 4,700, and then, the market sort of takes off, and he's like, maybe I need to reassess where we are. I think he bumped it up to 51. So you got a lot of targets at 51. You've got Tom Lee, who's a little bit higher than that. You got Yardeni talking these big round numbers by the end of next year, and thereafter, you better get inflation down to target, you better get cuts of interest rates, and you better get the economy hanging in there, or none of that's going to happen.
So there's the next year. There's also the next few days. You mentioned the Santa Claus rally yesterday. I think it's worth, I looked at some of the statistics in the stock traders. So it's last 5 trading days of the year plus first 2 of next year, 7-day period. Mm-hmm. It is a really historically, 79% of the time the market rises in that period. Average gain 1.3%. So we're right in the middle of that kind of sweet spot. Just a seasonal tailwind for you.
Well, it's a sweet spot too, because there's like an air pocket of things that can happen to impact stocks one way or the other, right? You haven't really had anything this week because the holiday. Next week you get JOLTS, you get ISM, you get Fed minutes, and then we start talking about earnings, which are going to begin in the middle of January and have to live up to the hype in some respects. Growth of 5.5% expected. If you take out energy, it's a little higher than that, but our earnings better live up to the hype.
Especially in the shadow of Nike. I would say we do have a couple of regional Fed reports today that we're going to focus on. Richmond Fed, Dallas Fed, of course, manufacturing. We get some more treasury auctions. And by the way, yesterday, I don't know if you noticed, the bond auctions, very strong demand. It's something we were watching a little bit this year because there were some wobbly ones, as we were talking about the high deficits and the fact that the Treasury has to borrow so much. But we are seeing strong demand now, whether that's people coming in off the sidelines to lock in higher rates before the Fed starts cutting next year, or just this idea that they are going to be cutting, and that's driving just demand, continual demand for treasuries. The other thing we're seeing that's helping this rally, Scott, besides the lower yields, is the weaker dollar. And we're now at a 5-month low on dollar index, on this idea that the Fed is most dovish right now. In the competition of central banks, it's speaking the most dovishly, the market's pricing it in the most dovishly, even though our economy is not in all that bad shape. Mm-hmm. The euro has gone up on this idea that even the walk back from the Fed that we got, remember a little bit of the walk back from New York Fed, Governor John Williams and others, it was weak and it was dismissed. And the market just raced on in terms of pricing rate cuts we're at 90% odds in the swaps market that the Fed cuts in March.
Look, the most powerful Fed speak, now obviously the Fed chair with great respect, obviously his voice carries the most weight, but Waller set this whole thing in motion by suggesting if inflation continues to come down, we can cut. And that was the first moment where I remember Leisman was saying, he said the quiet part out loud. And then, Chair Powell had a chance to throw a little water on that.
He didn't.
Did not.
No.
And that just extended the rally to where we are now.
Also, Waller was an important voice when the Fed turned uber hawkish, when it started, quadrupling its rate hikes to 75 basis points or tripling. He was an important turning point there. So, or did again. We're going to continue to talk about this incredible rally. When we return, an analyst joins us with his top picks for social media stocks for 2024. Taking another look at futures here as we head to the opening bell. And we've gone positive on the Dow, joining the S&P and the NASDAQ, continuing this rally. Are we going to hit that record closing high? We're going to watch that level carefully, 47.96. We'll be right back. Welcome back. We're taking a closer look at tech and social media stocks and their impact on online advertising into 2024. Our next guest forecasting 11% growth in the online ad industry, naming Pinterest a top pick, along with Meta and Alphabet, just raising his price target for each of those names. Joining us now is Colin Sebastian, Senior Research Analyst at Baird. What kind of signals are you getting, Colin, that lead you to the optimistic growth forecast on online ads?
Yeah, thanks and good morning. So, really it boils down to the state of the internet sector is quite positive. We're seeing revenue growth accelerate in many cases, margins are expanding, and there's line of sight to a lot of product innovation. And along with the fact that valuations, at least in historical context, are not really stretched. So that's what keeps us excited about those names you mentioned and others across e-commerce and social media.
It looks like you have a buy on nearly all the stocks that you cover, everything from Alibaba to eBay, Meta, Pinterest, Shopify, except for maybe Airbnb. Is it just a rising tide lifts all boats when it comes to online ads?
Yeah, that's certainly part of it. The reality is we are seeing this year and into 2024 really a resurgence of secular growth trends across digital media, online advertising, e-commerce. We certainly have a preference for the larger platforms. And, in a year where there are a lot of macro uncertainties, as you've just been discussing, we do have a preference for the higher quality companies. to those like Meta, like Amazon, like Alphabet. But there is room for companies like Shopify and Pinterest that in themselves, are emerging as higher quality technology and consumer internet companies.
Yeah, where does AI, Colin, factor into all of this, particularly around Amazon? I ask you because one of your peers on the street today over at Raymond James makes Amazon their top pick. They're looking from laggard to leader in terms of AI. It seems like so many other companies are the ones dominating the conversation here, but what about Amazon?
Well, for Amazon, I mean, on a broad level, you have that same context. You have faster growth, expanding margins, market share gains in online retail, and recovery in cloud. In terms of AI specifically, Amazon's strengths are fully in the infrastructure layer. And where they lack some momentum is on the application layer. That's where Microsoft and OpenAI have shown a lot of progress. So for the year ahead with Amazon in AI, they need to show more momentum in the application layer, things they announced recently at reInvent. That being said, we still think the stock is positioned really well for 2024.
What does Meta have to do to back up the kind of year that they just had? Not suggesting in any way they're going to, do 200% return on the stock, but to have any sort of outperformance, what has to happen?
Well, first off, on historical levels, the stock trades below its typical earnings multiples. So, I think compounding earnings growth will be enough for Meta. Aside from that, there's still a lot of concern around competition from TikTok, for example. And there we're seeing Reels continue to take market share. Stories is still driving a lot of monetization on Meta. The part that may be less well understood is the fact that messaging, WhatsApp and Messenger, these are emerging as new billion-dollar businesses for Meta. We think that's going to be a major theme in the year ahead, and one reason why we like that stock.
I'm curious about your outperform on Instacart, because this one was a more controversial, I would say, new entrant in terms of the IPO market, questions about the moat. I know they get an increasing portion of revenues from online ads, which may be why you like it, but the overall business, what do you think are the prospects for that? And what's the sentiment like from some of your institutional clients on this one?
Yeah, sentiment on Instacart is quite mixed. I think the prospect of a lot of competition from DoorDash, from Uber is what keeps a lot of investors on the sidelines with this one. While that's clearly true, what we like about it is the very large market that grocery presents. It's still very underpenetrated in e-commerce. Less than 1% has shifted online to this point. So massive market opportunity. Instacart is the leading player in grocery. You mentioned advertising. That's a very profitable revenue stream for them. What we expect in the year ahead is that growth expectations are perhaps a little bit conservative for Instacart, and we think margins will continue to expand. So on that basis, we do see upside for Instacart.
Let me ask you about a stock that we haven't really talked about much outside of the controversy recently from the CEO at Wayfair, suggesting employees need to work longer, work harder, etc. Is there any further fallout to come from that, from a stock standpoint, execution risk? Are you thinking about that story at all, and that it may have more legs?
Good morning, retail traders.
Well, Wayfair is a high-quality technology company in a very challenging end market in home furnishings, and I think that's been...
Dare somebody tell them to work harder. That is an insult. I think that's probably the downfall of me. I work too hard. Everybody hated working around me. Jim, slow down. You're doing too good at work. We can't keep up with you. Oh, water. I gotta get the water ready. It looks to me like there's a lot of room for this baby, unless it's had splits. Controversy of work harder, huh? Year-end memo to staff. Long hours and work-life blend. Nothing to be shy from. And me not be having a family, I had to fill that void. tax season this year is not going to be fun. Take off my shoes. The first thing I got to do is get comfortable. And taking off my shoes is the main objective here, and get my coffee ready. I was listening to Warrior Trading talking about 3-day weekends, holiday weekends, and how, you know, how hard it is, not hard, but how different it is coming back to trading. You always got to try to keep focused. I think he said he's only took, and I'm the same way, because I have a full-time business, but he's took 2 weeks off in 20 years or so. And I took 4-day weekend, 4 days, about 3 times, I think, and left the country. Coming back, you know, like coming back after Christmas during the slow period now. A lot of people take this week off. I was telling, we did a video about the SPX and the SPY, and we nailed the SPY. I think the SPY yesterday on the 52-week high. I mean the 2-year high or 3-year high. Right to the penny. I was 2 cents off. Not the number I had in the video, but the one I came up with yesterday at 476.56. So this is what I'm thinking we're going to happen in January. We're going to probably stall out. Earnings are going to come in, and they're going to be, some of them are going to be, well, they've lowered the guidance on a lot of this stuff. A lot of earnings had lower guidance last time out. So I think that the market's going to react positive to that, which will give us a pullback and then a breakout past the triple top high. And I really can't see it going much lower than the 9, holding up the 9 on the weekly time frame, and that's the SPY. So as y'all know, we don't have the scanner anymore, and I've got to adapt to a new strategy. So we'll see how it goes today. Let me see. I got to figure out the scans that I probably need to create a few new scans. It's been so long. And we'll try to use TrendSpider a little bit more, see how their scanners work. I had an alert on Disney yesterday, hitting the 200. what time frame that was in, though. So far, I'm about the only one that's called out that double top on the all-time high. The people on CNBC just don't want to mention it. Probably was on the hour. No. Yeah, we gotta watch Disney at open here. And we got 2 minutes. I gotta do something different here. I got 4 monitors. I need to put the channel, the Discord channel, so I can see it all the time. Now I think this coming year, for the ones that are having difficult trading, I'm going to be trading SPY every day. It's an easier trade than the SPX. So you can learn a lot of charting and stuff with the SPY with me. And I'm just going to trade it every day and see how much money I can make on it. I might start a new challenge. Call it the SPY challenge. Fund it with about 1,500 maybe, or something like that. Maybe $2,000. I screwed up my last challenge that I did last year. My ding-a-ling just went off. Wow, there's a FWBI's up 275%. We got Nile pulled. Oh, Nile pulled back. What's going on here? That don't look right. 906. Huh? Yeah, pulled back. Let's watch this. Niles on the red. Pfizer. CCL needs to pull back some. They talked about T yesterday. Watch T here for a double bottom. Off head and shoulders. Right shoulder hit. They were pumping T yesterday. So let me see here. Option land. I've got FedEx. And we're going to watch the SPY. The SPY's hit a double bottom. Needs to hold right here. This was yesterday's close. We got a double bottom on the SPX. I mean, they all can drop because I'm not very bullish right now. Watch, what did I say? Oh, I forgot. Nile. I need to put up my 4 calendars here. We got a double bottom at the 200 on the SPX. If it breaks, we're going to run up and hit 47.80. Where there's some resistance at 47.78. So check your orders out. SPY, we played the 28th. We just hit the 200. Now we're going to find out if we're bullish or not. Looking at the 476. It's already up 20 cents. I'm going to wait for it to pull back. We got the 50 now. We're squeezing on the SPX. We're in a Santa rally, so, you know, people are going to trade it when we're bullish. We got two white soldiers. Where's my chat room? Where'd you put it? Here it is. I got it. AI trying for 30. No, I don't think I put that on my watch list, and that's one of them I need on here. Freddie and Fannie are down big. This was a huge trade for me long years ago. Years ago, back during the Obama years. I made a killing off Fannie and Freddie. And Tupperware. Billy is China. XP, we got a double bottom on the weekly. Okay, SPY's pulling back here, so we got to watch it. Damn, I missed it. I tried to get 135. Now we'll wait. That's a bear flag right there. I'm setting an alert right off the VWAP for now on the SPY. Got an alert. Okay, go on the bar, SPX. So I've got me another chart up here I got to look for that don't need to be on here. Ready, set, go on SPY. Wait for that volume drop. I got my order ready. 476. Not in it yet. I'm just waiting here. Tesla. I get rid of that ding ding. Tesla's popping. Now Tesla's numbers out of China are going to be real good. We surpassed my resistance level and broke out of the channel. I called us an ascending triangle yesterday. AI. What's that one I had on this morning? We have an ascending triangle on AI too. That's why well, not why, but that is maybe one reason. Symmetrical flag into an ascending triangle. It's very bullish. Where's that chart at? I got one in here I got to take out of here. No. That could be no. That's not it. Oh God, do I got to listen to her today? I really don't like listening to that chick. One thing I can't stand is a snob. There we go, found it. I got a new chart that I was going to try out today, but it sends alerts. So we'll just go ahead and get rid of this for now. Yesterday I nailed the put. It took a little bit, but man, that was nice. It says, AI says it's finished for now, but these resistance levels on an ascending triangle, they always pull back to it, so that's a lesson to know. Don't chase that and wait for the pullback, and then you'll have a better chance if it holds. In fact, I'm going to draw the resistance line, and I look for the most consecutive. Randy, I hope you're feeling better. We love you. Okay, here's the knife. Now we're pulled back to support. There's the resistance level right there. AI is an iffy one. There's the support level. SPY's pulled back some. I think my alert was triggered. Did I get rid of that chart? Damn, I don't know if I got rid of it. There it is. We'll get rid of this for right now, because I don't want to listen to it. So AI bounced off that hammer. QQQ's about to hit the 200. Right now you're holding up the 9 on the SPY. I did a video about the 9 this weekend. So once I get through with the 1 minute, I'm going to move to the 5 and see what kind of candle we have here, which is bullish. FWBI, Mr. I'm going to bring this up above the 200, my alert for the SPY. Then I'm going to put one above the 50 here for the SPX. I think we're going to pull back, but who knows. Mister's a good one to trade. I know people that make money on this one here on the options. We got a double top. We got an ascending triangle with a wedge, or a wedge with a breakout, with a double top. I gotta change that color. Green's not the one to use. So I'm going to set one on top of the wedge for Mr. I've not took a trade yet. Playboy had a good run. There's Bongo. CING's up 125%. AI up. Got a symmetrical flag on AI. Getting ready to squeeze. Is that big? Idiot. No. Okay, get ready. Ten healthcare stocks are moving. Downgrades. This is a downgrade. Came out on the 22nd. CING. So that's a non-tradable stock. It's getting pumped, in other words. I'm really bullish on Tesla. I got two reasons. One reason is that they're going to compete more with NIO and XPEV in China. They're remodeling the Y, the interior. Two reason is that sales are going to be real good. Three reasons, General Motors and Ford are having a real hard time during this transmission. Barrow or whatever her name is getting the heat. SPX is very bullish right now, but I'm just not in the trade yet. I'm not feeling it. Might listen to a little bit of Schwab today. Because I don't want to listen to this blonde. Real estate, they're pumping real estate, and I looked at Toll and I said, what the heck? So it's got to come down quite a bit. Hope you enjoyed my lesson on using the 9. Right now we're still bullish. As long as we don't have a body under here, this is when I get the put. Once we get the body underneath the 9, we got to have a whole body under the 9 before I take the put. And then it ain't going to be that much. So I just got to wait. Wait this out. I could probably jump it right here and take the big risk. And that would be the 476 put. Or the 75. And we got FedEx. I'm up more on FedEx. This is my long trade into next year. We're about ready to get to the right shoulder on the SPX. The 260 strike on FedEx is now at 340. I'm in at 207. We could take profit here, but I think we got a long ways to go to break the 65. Long ways to go. In fact, this here's going to be your pivot point. This opening day right here. Not your pivot point, but your next resistance. AI up alert. We broke out of that channel and pulled right back to the pivot point inside of the flag. So it's going to squeeze out still. And we've got a 1, 2, 3. Well, actually, if I did it right, it'd be going up higher the next time it comes up. Now should be, I can bring my put down now to the 476. That's my trend line that I got to hold. Okay, let's do it. In at 107, the 476 put December 28th. And this is kind of a risky trade. Come on. There's one I did earlier. CHRS. Oh, shit. Well, that was a funny looking hammer. CHRS from this morning. Hit 2 of my alerts on it. I want to hit the third one at 2:45. So I'll set another one right down here. I'm still in my put. FDA approval of some kind of on-body drug or whatever the hell they mean. Okay, here we go. Now take profit when we get to 117 on your option here. We are now, well, not yet. We haven't established a bear until this body here stays below the 9. This is how I'm going to trade. I'm going to trade the 21 and the 9 crossover on SPY. That's the 34, so I used to trade that strategy too. I'll make it 21 for now. Should have watched that first thing this morning. See how the 9 crosses over the 21? Now, if the 9 crosses down over the 21, that's an EMA. Now, if this 9 crosses down the 21, then you're very bearish. We're at 112 on the option, on the put. Okay, I'm going to draw this trend line right here. Where did I see that? Right there to right there. And that takes me straight to the 51. I should have got out of that trade once we hit that bottom there, but we'll see here. We established one red candle below the 9. We got an expansion pattern. Megaphone. You'll be seeing me trade more pennies this coming year because we've had like a 2-year layoff. BTBT, used to trade that with Bitcoin a lot. Bam. Another good one. Off the 200. Still in the SPY put. And we're at 112. Now this could be an exit idea. I drew out this expansion pattern. This is right here. Let's see if we can get 117 out of this. This is definitely a solid support right here. We're off the 51. Look at the 477 strike on the call. I got to identify what kind of candle we're going to have here. We could have a harmony, a doji. Right now it's bearish. Just looking at it, but this could be a spinning top and that'll reverse back up to the upside. So I'm going to take profit here. Bingo. Whoop. We'll go get a knife. Definitely right here if you want to get out. There we go. Bam, baby. 17, give it to, woo! Got it. Called it out, nailed it. Said I was going to get out of that trade at 117. And this here's the 200 EMA. Now look at the call. The 477 strike. I'm going to wait. So I got that one trade in for the new challenge. That trade would have cost me $1,070 and come out with 100. We got a double bottom on the QQQ. Affirm. Now, if Tesla doesn't hold the 21, which has been respecting here for the last 3 dips, we're going to knife down to 261.50. That's about a $1.25 dip. See, I'm not going to fall for this bullishness. I mean, on Tesla I can, but the market's not in that position right now. December 29, the 260 put. This is the weekly, the 260 strike at 240. Put a tight stop on this one. We're going to put the Fibonacci alert on it. Exit idea off the 65. Moving average. We'll just leave that alert right there. I think we get a 50% pullback back to 260.40. SPY up. Don't look to me like it's going up. It might after this here double bottom though. Damn, look at that. That would have been a good payday. Okay, this is my support level right here. We're off the 200. So this is SPY call. The 28th. God. Them suckers went to 476 are at 127 now. Just triggered. Boom. Shit. 140. Oh, God. Oh, I told you I wasn't going to fall for it. Oh. Poop shit. Oh, no. Oh. Crap. Oh. Oh. Makes me cringe. You cannot trust the market when you're at a double top all-time high. You cannot listen to these people on CNBC. They're a pump station. They haven't brought the Chartist artists up to play yet. We got a triple bottom on the SPX. That would have been a killer trade if I'd have held it. Watch the SPX triple bottom. Lotto. Damn, they're so high. Look at the 47.85. Man, that's tough. Just should have held it. I mean, should have, could have. This is way up too high also, but if we touch back to the RSI, where's it? Where's my VWAP? Where's my VWAP? There it is. Okay, we're going to retest, and I want it to hold this here support right here. So we're going to get in right now. 47.85 at 260. It's got to hold that support to be bullish. Right there. It can't go any lower than that. And put a tight stop on it. Now we want to build a symmetrical flag here and then push it up to the upside. That SPY would have been a good frickin' $400. XP in here. Let me look. I'm wondering why Nile pulled back. So we broke out of this. We had 3 soldiers here with a hammer. Now we've got to gain respect above that hammer, and we got a symmetrical flag. Damn it, didn't do it. We got to start thinking bearish here. See if I got a fake out. The body, I have to have a complete body under that trend line before I sell my option here or add on. Because a lot of times there'll be a fake out, but if that body of that candle was below this here trend line, I would be very bearish. Now I got to stay above that trend line right there to ease my senses, and I figure in about 2 to 3 minutes we're going to bounce to the upside. First resistance is going to be right here on this major candle. And the second one's going to be the top of that same candle. Actually, we'll take it to this body right here of this hammer. We got a triple bottom RSI. Poos, pies, what the heck? And we're going to look at XPEV. We're at $3 on the call. So each one of these moving averages represent a resistance. Now we built momentum above the 9. So if we can stay above the 9, I really want to get this, how to trade the 9 across to everybody to know when you need to get out or when you need to stay in a trade. So as long as we continue with the 9, we can run this back up to the 200. And that would be a good spot to get out of the trade. This China guy is pretty cool.
in that ecosystem are all going up. But Bitcoin price is currently at 42,865. Remember, at the highs that we saw just in the past few weeks,
I love Asian people. /CL is kind of moving above. So we're up 50, 60 bucks a contract right now. Okay, here we go. Now this is where you want to get out of the trade if you're a scalper. If you're scalping this trade, you want to get out right here at 330. There it is, bingo. Remember, it's all about chart patterns, moving averages, and being in the now. This is 2 engulfing candles with a symmetrical flag. Damn, 340. Right to my target. Nailed it. Nailed it. You're welcome, Johnny. You see where I got that resistance line from, right? I explained the 2 engulfing candles. This was the first one to take it to that engulfing candle, and then the second one. And then I took it off the body of this here hammer. And I knew, and we hit the body of that hammer perfect. So you got to look for the candle that's bullish in this swamp. And that's your lead out candle right there, is that big hammer. I call them a sledgehammer. In fact, you had 2 of them. And then you had a shooting star, and another hammer, and another hammer, and a rolling pin, and a long leg doji. All right, we got a bunch of migrants coming north. 6,000 of them in a pack. What has America come? Does anybody agree with this? Do you believe in this welfare state that the Democrats are bringing on us? That's what they thrive on. If they don't have the welfare system working. That's what they done to the blacks, and now they're doing it to the world, and it's going to backfire. It'll create a huger welfare system in America.
Going on at OpenAI. Now, based on previous reports, we knew Johnny Ive, that's of course the chief designer formerly at Apple. He's involved via Love From. That is his independent design firm that he started after he left Apple. Bloomberg
Pumping
reported
AI.
yesterday, though, that Tang Tan, who is the departing Apple designer for the iPhone and Apple Watch, is now joining the same secretive project along with Johnny Ive. Now, we have no idea what they're working on, but thematically, this is really interesting on the Apple side of things. You have the hottest company in Silicon Valley tapping Apple's legendary designer to work on some kind of fancy new AI gadget. Now, there are lots of changes and departures at Apple Design's team since Ive left way back in 2019. Love Form, by the way, was contracted by Apple to do some design work, but that is over now, and he's free to work, for Apple competitors, frankly. And the design team is now run by COO Jeff Williams, and he has a reputation kind of like an operator, more like CEO Tim Cook than a sort of product visionary design guru that usually led that group. And it says a lot about the state of Apple today. There's a mature market for phones and watches and computers. I took part in the Vision Pro design, which we're expected to launch in a couple months here, but nothing brand new on the horizon that'll need that famous Apple design.
Got a bull flag on Meta? It needs to hold here, or if it doesn't hold, it'll drop to the 200.
Your guess is as good as
Apple.
mine, Sarah. I mean, it's not a phone. It doesn't seem. There's this one startup that's working on something called an AI pin that is going founded by some former Apple designers. That's going to launch next year. It's this kind of pin that you put on your
Next
clothing,
week.
and it can display stuff on your palm. I don't know if that's really the answer to what an AI thing looks like. We're also hearing a lot of
195
people
strike.
talk about AI computers. Again, unclear what that really means beyond just adding AI to the name. But look, if Johnny Ive is involved in this is really telling the direction that the CEO of OpenAI, Sam Altman, wants to go and come up with not just the software that's kind of captivated everyone, but some kind of new hardware that can tap into it. So look, these kind of things take years and years to design and come up with. So I don't anticipate seeing anything soon, but it's fun to speculate. And again, thematically interesting that this hot startup is taking talent from Apple.
All right, Steve, thank you.
Sure.
Steve Kovac. Let's stay with AI news this morning. The New York Times suing Microsoft and OpenAI for alleged copyright infringement. The tech companies exploited its content without permission to create their products, including OpenAI's chatbot ChatGPT and Microsoft's Copilot. Here to break down the impact for Microsoft and other names in AI is Jeffrey's Brent Thill. Joins us now. It's good to see you. So you see this headline.
Okay, we're going to set an alert.
What kind of risk is there to Microsoft, if any?
Well, I think the AI world is a new world. Obviously, this is the first big
It's
lawsuit we've seen, and clearly,
new
when you
world.
think about news flow on AI chatbot to go onto the open internet and look.
I'm going to set an alert at 361, the previous high on the body of this candle. Actually, I'm going to take it to the wick.
So we'll see what happens. Microsoft's great at navigating these legal overhangs. I don't think it's going
So
to be a big.
you'll have a triple bottom
Again, as we've said,
at 366.81. That's where I'm going to set my alert for Microsoft.
Of this journey, we are not anywhere near the middle or the end of it.
When you get a lawsuit or a suit, you want to go ahead and not be as ambitious as I was yesterday with it.
Into 25, so we're still super early in the journey.
Where are we in the stock journey then of Microsoft? As we're just talking about $3 trillion in market cap and not that far away.
Yeah, the stock has had a phenomenal run. We think for 2024 it's going to have another great year. And that's basically backed by double-digit growth, continued margin improvement over time, and their leadership.
Shame on them
We continue
pumping
to
this
think,
stock.
Again, the back half of 24 will be a better AI revenue build. So we think Microsoft is going to go higher. I would caution the IGV or the software index is up 60% year to date. We're not going to see the same type of returns in 24 that we saw in 23.
Hell no.
Everyone was positioned. Everyone was.
It's up $160 in a year.
And underweight software, and the software rally caught everyone off guard. So if you think about next year, I think it's more of a modest return year for software.
Finally, somebody can speak the truth.
I think again, it'll be one of our top picks as we head into next year.
What about Salesforce? Also one of the biggest winners of the year. Best Dow stock of 2023, up 100%. I know they've done a lot on the margin and profitability front after activists, but also have an AI story.
Yeah, the bigger story there is the margin improvement. So they're still running 30% margins. The peer group and software's running 40%. They're, as we've said, they need to still go on a diet and hit the Peloton harder. So we think there's a tremendous amount of margin upside in 24 for Salesforce. They are behind in AI. Adobe and Microsoft had the products in market shipping.
These idiots on CNBC are.
Customers. We think it comes.
So we got Apple. Apple had the real bad news about the watch. They cannot shut up and pump this stock. They're still pumping Apple. You do not. When they're saying that they banned the iWatch, I mean, that's a huge deal. And they're ignoring it. And they're still pumping this thing. And look at it. It's going to knife. That's not good news. It's just not good news. And for them to act that way. Now we've got inverse head and shoulders here. We're bound to hit. Here, let's clean this up. So we got the previous high right here. That's where I think I'd short it to and see if we rebound off that right there. So one of my major indicators is news. It's what makes the stock tick. And then chart patterns. I always look at the news first thing. If it has no news, I ain't going to trade it. I'm talking about pennies, anything out there. That's not good. Now we've came back and hit support. We hit the 200 and we exited the trade. And now you got a new support here with a hammer. Huge hammer off the trend. And that's the SPX. And then the SPY. We've been in here long enough. Let's look at the 5. We got a hollow hammer right now. We had a triple bottom off a wick. Okay, here we got a resistance level to break. If we break this resistance on Apple, which is right now, we could get a little bounce here. And it was at 80 cents just a little bit ago, and now it's at 86. So I was watching it, but you got to keep that bearishness in your head here. And watch Schwab a little bit. See how they act. CNBC pisses me off sometimes.
Over the last 5 years, which I think speaks to the volatile nature of the solar industry, frankly. I mean,
it's like the reverse arc for the year. It did terrible on the year, but it still is
tan.
Exactly, and I think
over the last 5.
I think that's really interesting. I mean, I think that solar stocks have been some of the most fascinating stories to watch because we've seen the stark divergence in the ways these companies operate. Because we call them all solar stocks, but frankly, they benefit from different trends. First, solar was the standout, closing the year in green territory pretty firmly, while other names, I mean, hemorrhaged on the year, like Solar Edge, Sunrun, just unable to catch any sort of love from investors. But all in all, one of the major issues was collectively for the space was that it was expected we'd see some slowdown in spending in the solar industry in the US, but then we started to hear the same sentiment echoed in Europe, particularly in nations like Germany, which was not expected. So not only are we seeing weakness here, we're seeing it overseas, and that led to some of this downside. But the solar industry, while it's facing challenges and some skepticism, some believe it can only really survive with these significant
Tesla's at a major support right now. The 65. If it doesn't hold, it's going to be a nice little knife.
Capacity in terms of
Tesla.
production by 2050. So it's like this is going to be a longer term story because right now the overall market is
And I got in at 240, and now we're at 263 on the put.
It's a massive addressable market, but again, it's a volatile ride, of course.
Yeah, and
We'll see if this does not hold. This could be a nice trade here.
The time to sell, a year prior, which was fascinating. I do wonder maybe what role crude oil played in here, especially when thinking about kind of the international slowdown and some of the solar stuff, because there was like this energy crisis a year and a half ago, and then all those prices dropped, so that like strong feeling of imminent, immediate need for alternative energy. And when crude oil drops like it does, it kind of lessens some of that race a bit. Technically, Rick, is there hope that the last month put a low in, or what do you think?
I think there is hope, and things really went from kind of not great to worse when we crossed below that threshold near about 67.
You got a chartist?
Down in late July here, so that was kind of when things really started to accelerate to the downside here. You can
Look
see
at this.
we have a long-term trend.
He's got a chart like mine.
A shorter-term downtrend in the light
What the
blue
hell?
color, the more cyan color, I guess you could call it. But since then, we've broken through that downtrend. We put in yearly lows. We saw bullish divergence on the RSI. Price made a new closing low. RSI was trending upward here. Complicated a little bit by the fact that we were in the oversold area, bouncing back and forth once again, but trending upward. You can see we've got that green line on the RSI. RSI has crossed above the 50 midline. Price has moved above our two shorter-term moving averages, yellow 21-day, orange 63-day. The moving
Bam, look at
starting to
Tesla.
Trend upward, suggesting that the trend is improving and picking up some steam toward the toward the upside there. 54, that red dashed line, that would be one area to look out for. We had a small gap there.
We're about to
That
hit
was
my
about
first
where we
support
had
to
some
get out of the trade.
consolidation as well. That's also a low point in our volume profile area. That's an area of relatively thin trading. So we could see fast moving prices if we get beyond that area. But to the upside, that's the point to clear. Then our 252-day exponential moving average comes in there 60, 70.
I'd say 70, if I don't add on, 70% of the trades I take are between $1,000 and $1,200. So if I bought 5 of these at 240, you can do the math. But that's how you maintain not big losses. And you can make $200 or $300 a whack like 150 on this one. We're at 30. We're up 36 cents, and I got 5 of them, so I'm up 150 bucks. I don't look at things as percentage. You know, I got into it with people that I really admire. They get so pissed off because I wouldn't give them a percentage. I get out at a dollar amount. If I'm happy with 150, I'll get out. If I'm happy with 300, I'll get out. I just don't want to give, you know, I'm just not into the percentage thing. Never have been. How can you get, the reason why is because I trade off chart patterns and moving averages. If I stuck myself, okay, I won't get out of the trade until I take 20%. I don't know what it's going to hit. At least when I hit a support level or a chart pattern, a resistance on a triangle or a double bottom, or I'm going to get out of the trade. A double top, I'm going to get out of the trade. So I can't pay attention to the percent. I have to pay attention to the chart that gives me the idea of the exit. See, like right here, we had a double bottom and I got out of the trade. You can see it. And that was an indicator to get out of that trade right there. $261.38, and we went right straight to the double bottom. Same as the video I did here on the SPX. I titled it SPX and SPY double top definition patterns and use in trading. What? What the hell? That don't make no sense. Double top definition patterns and use in trading. How to trade it. Ah, you dumbass. Puts on the SPY. That would have been a killer trade. So I'm gonna go get some lunch. So far I like these guys.
The expansion until we hit that credit wall with the banking crisis, and then that's when you really saw the mega caps come in favor, right? They were looking for the cash, they were looking for the peak cash flow, they were looking for the safer balance sheets, and mega caps really took off. And then we got into this summer period where we started to see kind of a little bit more rotation. I think that happened around June, where we started to see this idea that, well, if the economy can hold up, then maybe we want to we want to look maybe towards maybe some of the smaller caps and maybe look a little bit more towards some of the cyclical names. And then that all changed again in August when the market pulled back. And then here we are at the end of the year. And I think the end of the year is the last 2 months or so. Maybe we'll focus on that because I think that's really been the breadth expansion that we've seen. Small caps are back in favor. Interest rate sensitive sectors are back in favor, but you still got, the mega caps setting all-time highs. So there's a lot of positive momentum, positive breadth under the surface. And it's led, Oliver, it's kind of led into this area where we're at right now, where, it's possible there's a bit of an inflection point. And you look at it and say, okay, we've had this big move off the bottom of, almost 20% here from the October lows.
I love this guy.
From here? I think that's what it's going to set up for 2024, because I got to tell you, one of the things that shocked me this year was just how quickly volatility came in.
Exactly.
And where we're trading at right now. So, one of the themes that I'm going to be looking for, just for the next week or so, kind of heading into 2024, is whether or not the earnings cycle that's coming up here is going to justify these multiples and justify this low volatility that we're at right now.
Okay, yeah. Like that. Good take, Nate Peterson. Dive in. As we talked a lot this year about volatility, and it seems like one way to summarize it is we ended VIX low, VIX 12.
Yeah, and if you look at the melt up that we've recently had, I think that explains a lot what's happening with, the VIX basically creeping down to 52-week lows while the S&P is creeping up to 52-week highs. But, Oliver, when I look back, I think the one thing that I take away from maybe even more beyond just this past year is that, take the consensus view with a grain of salt. The Fed was wrong about transitory inflation. The analysts were wrong about
I love this guy. I love him.
The bond market has continually been wrong.
Totally opposite of CNBC. I mean, they're saying all the right things. The Fed has had it wrong from day one.
Is on its way to 2%. The soft landing is achieved, and earnings growth is going to pick up next year. So as we know that is the market psychology right now, and given that we've rallied 16% since October 27th, we have the Dow at all-time
magnificent.
highs. We've got housing stocks at all-time highs, semiconductors all-time highs, industrials all-time highs, NASDAQ 100
You got a bear candle
highs.
right now on
It's
Intel.
easy to get caught up in this mode of, hey, this is great, it feels good, the Santa Claus rally is on, but just be cautious a little bit with that in mind, because if we go back to the middle of the year, we can remember when AI came on the scene, there was a lot of optimism, and we ran all the way up to 4,600 on the S&P by late July, and then pull back
I
to
like his spot right
4,100
here
by
also.
October. So sometimes you got to zig when the market zags, so it feels good to be where we are right now, but don't go to sleep.
Yeah, I like that. And also, we got a little chop right at that S&P all-time high. The NASDAQ kind of blows through it, but when you broaden out, the weakness shows up more. That is kind of one of those key stories of this year, which is the bigger your basket of stocks gets, Joe, the more likely.
Just, these guys are just the total opposite of what CNBC says. They got one or two people that get on CNBC and say, wait for earnings and see if it justifies the huge run. I've not seen a run like this in 20 years into Christmas. Never. Huge. These guys, every time I get on here, they want to justify the huge run. And when I'm looking at a stock and I say, oh man, this thing's cheap, I mean it. But when things get expensive, you got to recognize that. I'd rather be cautious when you're hitting an all-time double top high at the end of the year, because I always know that the first quarter is not the best. First quarter usually summarizes what kind of year you're going to have, in my way of trading. even Intel, you know, we called this down here at the bottom off the 200, and that was at $32, and you're up $19 in 2 months, almost 80%, 75%. I don't know, whatever it is. It's just too much. That's why I don't have big losses, because I recognize shit like that. So I'll be able to take Microsoft once it hits 366.81. XPEV, China's not doing well. Niles, one of my favorites, semi-favorite, is down right now, and this should be down also. Now this 200 is a major support. The 200. So I'm going to take this to the weekly and see if we hit the 50. See, we take the 50, the weekly, and we hit the 50. I knew that was going to be there. This is a double bottom, so I mean this is triple bottom. Little head and shoulders. So you take and draw a trend line off this here candle. I'm going to raise my thing up above that shoulder line, above the 200. And that looks like it. What? So it triggered. We're definitely at a support level on XPEV. I'm excited about the Tesla news. Tesla wants to compete with the EV market in China, so they're redoing the Y, the Model Y SUV, to make it more compatible with what these other companies are putting out up there in China. So that's huge. That's to me is good news. And I hear the numbers are going to be outstanding. It'll be in the middle of 2024. But these guys here I'm liking these guys. They sound more honest than CNBC pump station. They kept the same people on CNBC for many years. Now they've got so many new young faces, and they want to be so politically correct. Their station turned into a politic network. And you just don't put politics and business, they just don't mix very well. I haven't found anybody on the social media, Twitter, StockTwits, which I'm no longer on. They blocked me, permanently banned. And Howard gave me a free t-shirt and a mug. So what was I getting ready to do here? Google. Google will be on fire next year. And it's also had a killer run from 84 to 140. And Amazon, they can't shut up about Amazon. Amazon 81 all the way to 153. So your target on Amazon would be right here. We've hit a triple top. See, now they're pumping Amazon at a triple top. Jimmy doesn't like that. The definition of a triple top. A technical chart pattern signaling that the asset is no longer rallying and that the lower prices are on the way. And as I was saying, I'm the only one on CNBC, on StockTwits, and I can't post on Twitter, but I'm the only one that said we hit the 52-week, the all-time high. All the other people are pumping the market up. I'm the only one that strongly holds that position. And we're going to pull back. And then we're going to come back up and we're going to break that resistance. It's going to be a good pullback to 45.71, a couple $100. Not that one. Take that body of that candle, not the wick. 478304. There it is, yesterday. Tesla bounced up. So I got out of that trade. I'm going to go get something to eat, but I think we could trade the SPY here. Bring it up to the 476 strike. You got inverse head and shoulders. So we're looking at the 476. Breakout, pull back, inverse head and shoulders. This is the 476 call. We got a dropping wedge. This is a wedge. Boom, baby. Now she's got to break out of the wedge. It's a 476 strike. And we just got an alert on the SPY. It says go, baby. So it's dead. It's dead. Time to go, baby. Okay, got in at 102. Set a tight stop. This is a little bit risky here, I think, because I'm bearish. But I'm going to give it a shot. See if we can get out of this wedge. Falling wedge. Falling wedge. Now here's this website that I like looking at when I'm doing my homework. Falling wedge is a bullish pattern that begins wide at the top and contracts as lower prices move lower. This price action forms a cone and slopes down as the reaction highs and lows are covered. Contrast to a symmetrical triangle. It's a falling wedge reversal. Here on TrendSpider. So we're in this trade at 102. And you got to keep a tight stop on it. They already put it in the room? Yeah. So we break out of the wedge. The resistance is the 200 SMA. And we'll probably get out right here at 475.60. Now if I fall below this, I'm going to hold on to the double bottom, and that'll be my last support level. See the higher lows right here? that gives me hope that we are going to break out. We got a long leg doji. We got a hammer. And we're going to get us another one here. I'm going to go in the kitchen and cook my lunch. But I'm in a trade now. What's wrong with these guys?
Thank you. Coming up next, the Stocks 3 charts 3 trades. Ben Lichtenstein will go through the technicals. Theo trades. Don Hoffman will take us through some trades longer term for Baidu, TLT Treasury ETF, home builder Toll Brothers, trading 360.
They mentioned Toll Brothers. How in the heck? I love these people.
My dad was a hard worker. He used to do side jobs installing windows, charging something like $100 a window when other guys were charging $400 to $500. He just didn't want to do that. He was proud of the price he was charging. My dad instilled in me, always put the people before the money. Be proud of offering a good product at a fair price. I think he'd be extremely proud of me. Yeah.
No trust. I don't trust your dad.
There's no place like the New York Stock Exchange. We've got you covered. The biggest stocks, the biggest trends, all the market moves. The Watch List with me, Nicole Petalini, 2 p.m. Eastern on Schwab Network.
A fresh take on the hottest trends in the market, from every click to every tick.
There's no fear of missing out on Next Gen Investing. 1 p.m. Eastern, only on the Schwab Network.
Wrap up the trading day with me, Oliver Rennick, for the biggest earnings coverage, 3 p.m. Eastern. It's Market on Close.
We're getting ready to squeeze. There it goes.
Schwab Network.
Accelerate your market knowledge and shift
This is
your
bullish when you get the higher lows and get respected.
a full hour of trading. I'm Tom White.
I'm Kevin Hayes. Catch me on Fast Market, weekdays at noon on the Schwab Network.
Fast Market, ready for you.
So if you ever want to look anything
at 4
up,
p.m. Eastern on the Schwab Network.
go to chart school.
Welcome back to Trading 360. I'm Nicole Petalini at the New York Stock Exchange. Big 3 times, 3 stocks, 3 charts, 3 trades. Then Lichtenstein will take us through the charts. Will take us through the trades? Don Kaufman, co-founder of Theo Trade. Great to see you both. Before we go through some trading ideas, just Don, as we wrap up 2023, and you've been on with us a lot. We're so thankful that you've been on with us so much. A good look at the big 3 all the time. But what's the big picture and takeaway from 2023, and maybe spin it forward to 2024?
Sure. Ultimately, 2023 has effectively been big tech. It's all about big tech and the Magnificent Seven. Really, the last couple of weeks that we've seen in 2023, yes, they've been buying other things like, financials to eke out some returns, but 2024, very, very different year, and it's going to be a year of questioning the Fed and ultimately some wild moves inside of interest rates, which could really wreak havoc on the entire marketplace.
Yeah, there was concern about, the fact that the volatility index came down so much, and that that could actually be indicating that people are becoming a little too complacent, and that worries folks. In the meantime, let's get to some ideas. We look at a name like Baidu, and we think about some of the Chinese stuff. Do you think that this is a good one for a longer-term play, either way?
Yes, So I'm looking right now at some bullish positions inside of some Chinese large caps. And I'm looking at these bullish positions because every time we continue to slip just a little bit in some of the Chinese kind of larger market caps, China steps in and stimulates their economy.
See how we break out of the wedge?
Baidu is really no different. So
This is important to identify.
Taking a shot at Baidu or taking a shot looking at the technicals of Baidu, but it's really taking a shot.
This is very important to identify, to know that you're in a good trade. And that's when you create the higher lows at the end of the wedge. This is telling you that it's going to break out. There's nothing but nothing's 100%, but it's telling me 95% that we're going to break out of that wedge because we have higher lows. And I'm using the bodies of the candles. I don't give a crap about the wicks. It's the bodies that matter in something like this. And when you get that higher low at the end of the wedge, you're going to break out almost 9 out of 10 times. So I'm up 80 bucks on this trade. And if I was a newbie, and I'm not winning, you take that wedge, almost 9 out of 10 times it breaks out, or even more. The odds are high. A falling wedge is one of my favorite patterns besides the inverse head and shoulders, which is right here. So you got the left shoulder, right shoulder, boom. You've got a falling wedge. You got two reasons to stay in this trade, because you've got a support level off the left and right shoulder of the inverse head and shoulders, and then you've got a falling wedge with higher lows.
Up to 126. I'm going to show you why it's got me a little bit concerned.
And that's true with any kind of pattern. Let's say it was a daily pattern.
Coming off that level, look, it was testing a key area that we had found a support in the past, right? Prior to breaking down into the lows this fall.
These guys, they show charts, man. I just love this channel.
In this continuation pattern where we're seeing a series of lower highs come into play here. Again, open up the door to the downside, take out those October lows below 103, could see some energy to the downside. Let me show you what's going on with the 50 to 200-day moving average, because it's a pretty good example of a stock that's struggling, right? You can see how we've tested the 200 a couple times. We've been below it since October. Retested the 50-day moving average, recently failed. That was that move up to 126, so we're back below that. Look at RSI, not really providing a lot of conviction either way, but again, the range John was talking about, unfortunately for me, Nicole, this one looks like it's still struggling to recover here, much like, again, some of those other themes that we've been talking about throughout this year.
All right. Well, and that's the big picture. And do you think that the story is for other Chinese stocks as well, or is this more of a Baidu type of story, Don?
Yeah, no, I think Ben has to have a little bit more faith in the Chinese government and their ability to stimulate their economy, or at least create a bid to the marketplace simply by throwing capital at the market, which is exactly what they've done time and again. So I've actually watched, some of these range bound. They hit the lower edge of the range.
Spies at 110. I can get out with 80 bucks, but I'm interested in Baidu here. Jimmy called an inverse head and shoulders. Again, the inverse head and shoulders. My number one chart pattern.
And then we take a look at the Treasury ETF, TLT, and it's interesting because towards
And I know I called this off already once.
dropping, right? The 10-year went from 5% to less than 4%.
So this could be a good swing into next year.
And meantime, we've had the Fed with all those hikes. So at this point now, what's the bet on the TLT Treasury ETF?
So this is a really tough
January 19.
Because I always grew up as kind of a efficient market hypothesis, and that's basically
Target would be right around 122.
I have got to fight that internally. I mean, I look at Fed Fund futures, and they think their cut is coming in March. All but assured, okay, by the May time frame, and I'm telling telling you right now, I don't see it, and some of the Fed speak around this is kind of corroborating that story that some of the Fed, they're looking at like maybe second half of 2024 in a cut. So I'm going to take the other side of the bond market. I'm going to look for the TLT to sell back off, for rates to go back up when the marketplace is disillusioned that rate cuts are not necessarily coming in the first half of 2024. This position is all the way out to the March 15th expiration. And I'm picking March 15th because, again, plenty of time, right? So I'm going to buy the 96 puts. I'm going to sell the 91 puts. And I'm going to do this for $1.10 debit. It is absolutely a bearish take on TLT, which has just been...
Oh, he's looking at a different one.
Exploding, if you will, to the upside. I think people are going to be disappointed that those rate cuts are not coming quite as fast as they assume.
And how about the market pricing in a total of 1.5%?
I'm looking at the Baidu one right now, the 120 strike for January the 19th.
Being likely, they're saying 6 or 7. The market certainly has a lot of enthusiasm about a lot of cuts to come. Ben, your thoughts
Start off
on
with
the
one.
TLT Treasury bond ETF chart.
Nicole, the rate debate was a heated one in 2023, that's for sure, and I think it's going to continue to be the case, and into 2024, that theme will play throughout. Let me show you why as we get into the bigger picture. But first and foremost, the move up that we saw in TLT, an impressive one this fall, that really caught a lot of attention, right? To your point, the yields came
These
off
guys are spot on.
4%, and here you can see TLT in the end of October was around 81, 82, and the rally we saw all the way up to just shy of 100. A very well-defined trend, bottom left, top right. We always talk about that. I actually want to step away from this move off those end of October, beginning of November lows and show you where this put us on the bigger picture, because this move here from, again, 81, 82 back to 100, well, reverse this longer-term trend that we had been into the downside. Take a look here as you go back to the top left corner of this chart. Back in April, if you remember, TLT was up around 108. Then we balanced around 106. You can see these areas of consolidation.
That's what I got, 108.
At lower and lower levels. And again, as we were balancing around 95, the bears wanted to see us break down, form a new area, balance at a lower level. We did around 86, and at that time, they wanted to see that kind of wash, rinse, repeat type pattern that had been playing out continue. In fact, look what happened. We actually rallied back above 95 here, invalidated that trend to the downside, and want to show you why I think that debate's going to continue, because while we're seeing some strength here back to this 100, 101 level, let me show you.
He's spot on.
Here right
92.
Now. Again, on this longer term chart here, you're going to see a continuation of this pattern where value's been moving at lower and lower levels. This move off this balance area around 86 comes into a key area right now to keep an eye on into the new year. Still a longer term trend to the downside, but potentially reversing should we get above that right now, Nicole. Definitely watching the 100, 101 area.
All right. Any final thoughts there, or should we move on to the world of housing? Don, I'll let you add in if you want to add something in, but as we turn to housing, yeah, go ahead. Tell us your thoughts on that one.
I got plenty of thoughts when it comes to like rates. I mean, look, the marketplace right now is literally pricing in a cut, at least 25 basis points, almost every single meeting of 2024. That's not, it just seems insane at this point in time. I mean, the economy would have to be absolutely tanking. Is the marketplace telling us something about, the economic forecast? And it's a big question, because if that's true, they're going to be cutting to basically prop the economy back up. And that's something that the retail trader needs to be thinking about.
Yeah, and as we talk about rates, that's what's really one of the things that at the end had been driving some of the home builders and some sentiment as the Fed paused again for the third time. Sentiment improved, then people started betting on cuts. And when you look at a name like Toll Brothers, which is the one you're featuring today, and was hitting 52-week highs at the end of the year, your thoughts on Toll Brothers?
Yeah, to begin with, Toll Brothers is up 100% on a year-to-date basis, which if you had asked me at the beginning of 2023 with the rate hikes, of course, everybody would say that's absolutely, again, it's ludicrous to think that the stock would actually be up 100%. Whatever happened to higher rates for longer? and we've completely wiped the slate clean. But again, Toll Brothers coming into early next year, again, I think there's going to be a lot of this rate discussion. It's going to put some nerves into the home builders. Specifically, Toll Brothers is kind of the leader of the pack, and I would expect some degree of a pullback in a stock that, in my opinion, has gone too far too fast.
Yes.
March 15th expiration once again. Giving myself some duration here. Buying the 95 puts, selling the 85 puts. It's a full-fledged $10 wide spread in this underlying.
I agree with him 100%.
$2 debit.
Yeah, you know, it's interesting because as mortgage rates dipped and stocks took off, and even the XHB, another one, was at 52-week highs at the end of 2023. The question is, where is it headed? Ben, you take a look here because we certainly came off the mortgage rate highs and there was some optimism, but you still have very costly homes. It's not like there's a ton of bargains. I mean, year over year, homes are still expensive.
Yeah, you know, Nicole, one thing, Don and I have rarely agreed across the board, or disagreed for that matter, across the board in the segment here this year on the big three, but this is going to kind of fit in line with that, right? That's what makes a market in many ways, kind of seeing things through different time frames or different lenses, and in this instance, I still see trend up, a lot of strength in this name. Let's first and foremost begin with the 30-minute candle chart and the move that we saw this fall, much like the broader market enjoying gains here. We're talking about off the October lows here around 67 all the way up to 105 with conviction, and not only conviction, Nicole, but areas of consolidation that have formed at higher and higher levels along the way up. So that footprint that the market leaves us, that staircase type pattern, however you want to describe it, bottom left to top right, value is moving higher. Tough to debate that one at this point. And again, this is a 30-minute candle chart here. Looks like we're balancing possibly around this 100 area, but it's very bullish as long as we hold above 92. Again, a 30-minute candle chart here, so now let's not give too much credit to this one. Let's step back here where you can start to see a very identical and similar pattern, right? We're just distancing ourselves time frame wise, adding a little bit more on. Daily candles going all the way back to June of 2022 when the stock was trading around 39. Again, similar pattern. Value moving to the upside, well defined. Bottom left, top right, a few different ways of describing it, but it has a very similar depiction, right? That staircase type pattern where we see value and a migration of value to the upside. So still in a bullish pattern here is the way I see things. I want to step away from this daily candle chart, bring in the moving averages so we can see where we are. We've been holding above them for a while now, for the most part, aside from a couple tests throughout the year. Got RSI, look at this, very bullish right now, supportive of this vertical move we're seeing to the upside. Potentially we start to balance here considering the nature of the price activity through 90 into this 100 level, but this one's got some momentum into the end of the year here, Nicole, and exactly what the bulls are looking for, building on gains we saw throughout the year. That's shares of TOL currently trading and holding above 100.
Yeah, exciting, exciting big three. Don, final thoughts here.
Yeah, no, you know what? I kind of enjoy it when Ben's taking the other side over here. As he said, that's exactly what makes a marketplace. Look, some turbulence coming in early 2024. Expect it. This rate cut debate is far from over right now. I think the market's going to be rather surprised when it's not getting what it wants.
Exactly.
All right, John Kaufman of Theo.
This is crazy, this run, I'm telling you. I'm just
on the charts for the big three. Thank you both.
I've never seen anything like it,
We're going to
especially when we got a president that can't even speak.
Gasoline prices, $30 range of moves. I mean, we saw some big swings, crude oil prices. So what does it mean for the consumers when they go to the pump? Gas Buddy's Patrick DeHaan standing by.
I was born on the south side of Chicago. It has been a long road, but now I'm working for Schwab. I love to help people understand the world through their lens and invest accordingly. You can call us Christmas Eve at 4 o'clock in the morning. We're gonna always make sure that you have all of the financial tools and support to secure your financial future. That means a lot for my community and for every community.
every trade, always live. Expert earnings analysis, in-depth technical insights on.
Now I like this channel because they just don't talk gibberish like CNBC Pump Station does. They're showing actual charts. And I'm a chartist artist, and I believe in charts more than rhetoric. And CNBC is the best at pumping stocks. So, it pleases me to hear a channel like this because it's my style of trading. And I just really admire that. Now let's like Baidu here. I was asked about Baidu. Support level is at 106.32. So that's where we want to take the trade. And we'll have to wait until that alert is hit. And actually, I'm going to go to a 20-day 1 hour time frame. I'm going to raise that alert up to this head and shoulders right here at 111. There we go. So support, that's a strike. And entry, support, is at 111. And I won't take the trade until it hits that 111. That's a $3 drop. It could be a little bit higher because we have a higher low right here. So let's adjust the alert to the higher low on the shoulder. And we'll move this up to this here bottom right here. And that's now a 111.75. So set an alert at 111.75 on Baidu. And I'm going to take this off and rename it. I'm going to say inverse support off inverse head and shoulder. I'll just type in soup inverse. I don't know what that means. And then I'm going to type in hour. So, baby, I got it. I never buy at resistance. I always look at a chart and say, okay, I want to take it here. Then I'll get in the trade. And Toll Brothers, I disagree with him. Yes, it's bullish, but it's also irrational exuberance. I've been following Toll Brothers for years. I watch their videos. I look at their houses. They build a nice house. The prices have gone up big time. But this is at an all-time high. This is irrational exuberance. These candles are way too big. So they're pricing in something that it hasn't hit reality yet. I'm going to take it to the top of this triangle. I got two supports, 92.88, and then this other one. So I disagree with him. I agree with the other guy. I mean, 39 all the way to 105. That's a 200% increase plus. 230% increase or something like that. That's just not right. Nailed the reversals on the SPX and the SPY. Bingo. Good. The SPY. 102 to 121. Exit. Or we're going to go, let me see here. Yeah. Take profit. Man, this is too easy. Florence, did you take that trade? SPY at 102. You're now at 122. You're up 200 bucks. Get out of the trade. I think this SPY is the easiest one out there to trade. Anybody that really has a hard time trading, just follow me on this baby all year and you'll make a ton. This is a good lesson to learn right here. I'm going to show it to you. This is important to know to keep you in a trade. So we called the wedge right here. We got in the trade at 102. She broke out. They always, not always, but 8 out of 10 times, they'll pull back to that support level. That's the falling wedge. That line on that wedge is your support. Pulled right back to it. Boom, baby. Then you take it to the top right here, that previous high, and you're out of the trade. Or you take it to the VWAP and get out. You understand that I'm learning. I'm learning new. Well, without that scanner, I have to come up with a new strategy. And I'm got to listen. You know, I got to have something guiding me somehow. And CNBC pisses me off every time I turn it on. But these guys right here, these are...
Schwab Network app and join in on the latest market trends. Anytime, anywhere, on any device for free. Schwab Network.
Might have a new Becky Quick here.
Welcome back to Trading 360 Year in Review. I'm Nicole Petalides. No doubt, Magnificent
Baidu is up.
Certainly stole the show in many ways. It was one of the biggest storylines of 2023. So that group making up such a big portion of the gains that we saw for the market overall. Our next guest, Dave Sequeira, is with us, Chief U.S. Market Strategist, Morningstar. Dave, thank you for being with us.
Fox Business.
We used to say FANG, FANG. Then it became Magnificent Seven, and a lot of this group,
That's a good one.
into the new year of 2023, was somewhat undervalued, and these names took off. What do you think drove that, and what does that mean for 2024?
Well, as you mentioned, the Magnificent Seven were certainly the story of 2023. But thinking about 2024, we're looking for the market really to broaden out across, multiple different areas, looking for where we see gains next year. As you mentioned, coming into this year, 6 of those 7 Magnificent Seven stocks, according to our valuations, were pretty significantly undervalued. They were trading at 4 and 5 star levels. But following the rally this year, 5 of those stocks are now fairly valued, trading with 3 stars. Alphabet, the parent of Google, is the only undervalued one that we still rate as a 4-star rated stock. And Apple has actually risen too far in review. It's actually now rated 2 stars. So what I'm looking for next year is that broadening into other areas, specifically looking at value stocks. That's the one area that with market we still think is the most undervalued, trading at about a 12% discount. Core stocks are actually getting a little bit ahead of themselves. They're trading at a 4% premium. And growth stocks are pretty much, in line with our fair values. Although I would note we do think tech stocks are overvalued, and I'd probably look to start taking some profit in tech and moving that into some of these other areas.
Well, we did actually see market breadth improving as the year went on throughout December. It was no longer just the AI stocks or big tech, right?
Exactly. Well, really, I think the next big test for the market's going to be in February and March next year. That's when management teams are going to report fourth quarter earnings. I'm not worried about fourth quarter earnings. I'm much more worried about the guidance and the body language they're going to give, for next year. We do think the economy is going to slow, starting here in the fourth quarter and then slow sequentially, all the way until the third quarter of next.
Say you were watching Apple here. We called out this bottom a little bit ago, and then we broke out, and we came back and retested the double bottom. Boom, baby, to the VWAP. In and out of that trade in a few minutes.
Ratios, and a name like NVIDIA, which tripled. I mean, it was over 200% gains. I mean, when I was checking, it was 240%. I mean,
God, SPY.
We can't gauge exactly
Bam.
where it ends the year, but the point is, had a huge move. But is there still more upside? Because there are folks who say quality, market share, it's okay if it's expensive. What do you say to those folks? Do you agree?
Tell them to shove it.
Well, again, we don't really focus on PE ratios. I know a lot of people look at that as a short-term way of, trying to gauge market valuation or gauge, individual stocks. We do a full discounted cash flow analysis. So when you think of something like, NVIDIA, a PE ratio is really hard to gauge what that means, for the stock. Part of our model, we do look for revenue to grow, over 100% this year and almost 50% next. We're looking for a 5-year compound annual growth rate, on the top line of 35%. So essentially, we're looking for NVIDIA's, revenue to go from, $27 billion in fiscal 23 all the way up to $121 billion by 2028. So I think you really need to think about the valuation of a company in that context, as opposed to trying to look at a PE ratio.
Right.
Plus, when you look at NVIDIA, those margins are going to more than double over that same time period. That's how we come up with our $480 share fair value.
Right.
I love this guy.
When we look at the names, you had Alphabet, Google, which you mentioned, 4 stars. A majority of the names that we've discussed here.
CNBC says 650, 1250, 1500 on NVIDIA last year. This year, this guy says 480. I mean, I can respect that. I can't respect $1,500 for NVIDIA. You cannot do it.
Gotten ahead of itself when you look at the long-term fundamentals of the company. So I know, talking to our analysts, we just think that when we look at the long-term growth trends for like the iPhone, for example, the market, we think, is overestimating that, too far into the future. We also think that the market is probably overestimating the long-term operating margins for Apple.
Right, understood. Dave Sequeira of Morningstar, thank you so much for being with us. A look back on 23, look ahead to 24. Glad you were with us. Thank you. Coming up, a focus on EV stocks. Tesla, that would be one of the legacy names. We had a lot of up-and-comers. Much to discuss in the world of EV vehicles and which companies could be best positioned for 2024. Next on Trading 360.
We'll find out.
Download the Schwab Network app and join in on the latest market trends. Anytime, anywhere, on any device for free. Schwab Network.
Trading the trending names every day. It's Fast Market. Ready for you, ready to go. I'm Kevin Hicks. Catch me on Fast Market, weekdays at noon on the Schwab Network.
No politics, no noise. From bell to bell and beyond. Available anytime, anywhere, on any device for free. Schwab Network.
Missed out on today's market headlines? Get caught up and catch the wrap at schwabnetwork.com.
Think I gotta go get a snow shovel.
Anywhere, on any device, for free.
Welcome back to our year in review edition of Trading 360. I'm Nicole Petalides. So glad you've been with me throughout so many storylines. And in this one, a deep dive into those EV stocks, those electric vehicles that have been running the show in many ways. And Steve Wesley is with us, founder, managing partner of the Wesley Group, and Garrett Nelson, vice president, senior equity analyst at CFRA Research. Thank you both for being here. We've had so many great conversations as we wrap it up. Steve, would you say 2023 did not disappoint? I mean, did you feel like there were a lot of great moments when it came to the EV space?
Look, 2023 certainly didn't disappoint at all. Look, the big picture here is the EV market's continuing to boom as prices come down. And I think expect 30% year-over-year growth globally, from 10.5 million units in 2022 to close to 14 million units this year. This means that almost 20% of all cars sold globally are EVs today. That's stunning. More price cuts are coming. Battery prices down 14% this year, 40% by 2025. We're entering into a world of EV dominance over the next decade. Big story. Will BYD, Tesla battle for the throne? I think in 2023, Tesla's going to keep the crown. They're probably going to sell about 1.8 million units to 1.6 for BYD. But by 2024, BYD is growing faster than anyone. They'll probably outsell Tesla. The big question, who wins the cost down war, and how soon can Tesla get that $25,000 car on the road?
Yeah, look, and you had the Cybertruck unveiling and got those up and out at the beginning of getting those out. Garrett, what did you make? You had a buy rating. You both liked Tesla as a stock. Were you happy with the performance of Tesla in 2023? And is it a buy for 2024 going forward, Garrett?
It was a great year for Tesla. The stock has more than doubled year to date, so they have a lot of momentum. As Steve mentioned, declining battery costs. Their unit costs have come down for 3 straight quarters, and lithium prices have really plummeted. So, they have a lot of tailwinds on the cost side. Also, the UAW deal increases the costs of their competitors, the Detroit 3, by a significant amount. So, Tesla has a lot of tailwinds at its back heading into the new year. We have a buy on it still, $300 12-month price target. So we think it's going to be another really good year for the company in 2024. We think they will introduce this mass market next-gen EV model in 2024. Elon Musk has been talking about it more recently. We think next year's the year. It probably won't be at a $25,000 price point, just because that was a promise made 4 years ago, pre-COVID and pre-inflation. But we think it'll probably be somewhere in the range of a $30,000 to $35,000 price point for the base model. But we like Tesla a lot here.
Yeah, and Garrett, just quickly, which names, if people want to write them down, which ones do you have buy ratings on going forward?
So it's a pretty short list right now. It's Tesla, Ferrari, luxury automaker, but about $65 billion market cap. And then in the EV space, the one name aside from Tesla that we like is Polestar, ticker PSNY.
Okay. That being said here, Steve, you know, BYD is a name that I think a lot of people have a lot of respect for. We know they were battling neck and neck, which of the two companies, that and Tesla, to get more vehicles out. It's one that Buffett liked. It had a growth trajectory that some would say Tesla was more in an intermediate growth phase after sort of more surging. Is BYD also a name? Would you say those are both stocks that you like, Steve?
Absolutely. And look, there's just no disputing this. BYD is simply put growing faster than Tesla. So I think
BYD is the one that I pointed out.
BYD for sure. Look at the Koreans. Hyundai and Kia are doing awfully well. And you've got to give Rivian credit. I mean, they've been in this EV auto space for 6-7 years. They're already selling.
One of my other favorite ones.
At GM and Ford are at 52,000 units this year. They've just raised their plans and they're heading toward profitability, so they're getting it right. The big question is, what the heck happened to Toyota, GM, Ford, the legacy manufacturers with all of this R&D
piece of shit.
Global capacity? They just didn't get the memo on EVs. I think they're going to be punished. And then there's a whole slew of firms that I think just don't make the cut. You know, Lucid really on air support here, being knocked out of the NASDAQ 100, losing dramatic amounts on every vehicle. So it's going to be a tale of two cities, the winners pulling away and some laggards really struggling to stay in the game.
Yeah, you mentioned Lucid. There are so many names. We watched XPeng, we watched Li Auto. You know, Garrett, you were just talking about Polestar. So some of these names that NIO, some of the names that necessarily people don't talk about. I mean, the F-150 Lightning had a lot of excitement surrounding it, and then it just didn't have as much demand as they had hoped, and now they had to cut Ford, had to cut the production by half. You have GM Cruise. Was that a Ford problem? Maybe people didn't want an EV pickup truck. I mean, you have Rivian. But Garrett, what's the final thought? Is EV demand still hot? Do you expect that to still grow, or was it a fad or a phase?
What we've seen is a lot of traditional automakers actually pull back on their EV investments, their EV growth plans. Part of it's because of the new UAW deal. You've seen the Detroit 3 pull back. But also part of it is consumers are demanding more hybrids. And automakers are really getting the message that there's a lot more demand for hybrids than pure electric vehicles. And so, you know, you look at Ford, one of the only companies that discloses their EV results. They lost $36,000 per EV sold in the third quarter. That's just not sustainable. And so the companies themselves are making decisions to pivot their portfolios going forward. And so I think you're going to see a whole lot more hybrids being planned in the future, and a bit of a pullback on EVs just because consumers aren't demanding them.
Yeah, great to see you both. Thank you so much. I'll see you in 2024. Steve Wesley, Garrett Nelson, thank you for being with us. That's going to do it for Trading 360. I'm Nicole Petalides. Thanks for joining me with this year-end special. We'll be together in 2024, I'm sure. Schwab Network, we have you covered. All of your market news 2024. Keep it here.
Beautiful call in the bottom there. I gotta go get a snow shovel. We're starting to snow outside. I hate this time of the year. They like to mention you. You're a magnificent person. Yeah, I was just checking to see if you had snow shovels in.
Yeah, we do.
Okay. The yellow ones or?
They're all different kinds.
All different kinds. Okay, thank you very much. Bye-bye.
co-host for the day, and that's going to be Kevin Hanks. I wanted to get your take here just on the market action. It seemed like at the start of 2023, everybody was predicting a mild recession, rate cuts by the end of 2023. That didn't happen. Now they're looking ahead to 2024, where there's going to be 6 quarter basis points cuts, and we're going to have a soft landing. So they were wrong at the start of 2023. Are they going to be wrong at the start of 2024?
Yes.
You know, when you look to what the next year is going to be fearful of this. If the majority of the people think one thing, that's what you can bet is probably not going to happen.
Exactly.
Right? I mean, this year, other than the fourth quarter,
right,
they couldn't have been more wrong.
Right.
They said a bumpy first half of the year, then strong second half of the year. Well, the first 9 months of this year, it couldn't have gone more opposite of what they said. Now, that said, you know, the market loves to jump ahead. 3 cuts projected by the Fed turns into 6 projected by the market. So the biggest risk in this market going forward is, Tom, it's reigniting inflation. How do we know that? Well, Jerome Powell's taken rates to 5.25% to 5.5%. But remember, there's still massive amounts of government spending unused yet and unspent.
I said that yesterday.
In the system next year. So any significant decrease in restrictive rates is going to unleash spending.
These guys are spot on everything I've said. I'm the devil's advocate to the fat cats. Government spending is going to increase with the stimulus package that they've already passed in 2024. I mentioned that yesterday.
It's going to be the most difficult part. But as Kevin mentioned, the market's pricing in a quarter of a basis point cut in the March meeting, and we've seen some pushback towards the end of December from some of the other Fed members after a.
I almost got inputs right here,
from Fed Chair Powell.
but now I got to go get a snow shovel.
But one of the big news stories as far as individual news this year has been Microsoft, the resurgence of Microsoft's partnerships with some of the other companies and ChatGPT. Let's bring in Jenny Horn, markets correspondent here, to help us break down this story. It's a pretty good year for Microsoft. Jenny hit an all-time high in the month of December and up about 50% or so throughout the year. What's your take?
Yeah, the year that was for Microsoft, and I would say that arguably they kicked off the AI arms race, as we've deemed it, with their $10 billion investment in OpenAI back in January. Now they have around 49% ownership of that company. So with ChatGPT's rise, Microsoft is seen as a huge beneficiary, obviously, and it's rumored that now actually their stake is closer to around $13 billion. Now, January of this year was not the first time they invested in that venture, spending about $1 billion back in 2019. But AI has led so much of the enthusiasm when it comes to Microsoft's strength that we've seen pretty much all year long. We have seen as AI continues to rise, it also has helped its other ventures. It's integrated with its Azure, its Viva Sales, its GitHub Copilot, and its Teams units, among others. And I do think Microsoft sometimes doesn't get enough credit for just how many companies it operates. They do have Azure, Xbox, that's Office Suite, LinkedIn, GitHub, Skype, Nuance Communications, Bing, just to name a few. And that doesn't even include some of their most notable partnerships with massive companies like Oracle and Salesforce. But in its 2023 fiscal year, they generated about $69 billion from their productivity and business segments, and around $88 billion.
You got double confirmation at 475.50 for the SPY.
Top line. So cloud is still the story. I know they're still second to AWS, but 60% of their top line is so dominant. But we've also seen some trends in terms of the PC market, perhaps reaching a bottom, be favorable, as well as their gaming segment coming back. And
What story is that?
Leads us to naturally the story that has been Activision Blizzard, as we finally did get regulatory approval for that $69 billion deal in terms of all cash transaction. That is its largest transaction ever, with that topping its previous largest, which was LinkedIn back in 2016. But right now, when looking ahead for 2024, I think a lot of these skeptics are calling for the magnificent top, if you will. That if you believe we are in any sort of a bubble, the pessimists are calling for a lot of these stocks to come back down to earth. I will say something that's encouraging, though, is the fact that if you look at the Magnificent Seven, Microsoft, in terms of its year-to-date performance, it's in the bottom tier. It's not seeing the same degree of outsized performance like Nvidia, Tesla, Meta is another one. So in that reason, I do think that's a little bit encouraging. However, it does trade at a pretty sizable premium to its key rivals, trading for around 33 times its earnings. So that's also then the case. Perhaps we became overvalued in 2023. But they are still in this very, very elite club of trillion-dollar valuations. There's only, just a handful of companies in the world that have that valuation. But Microsoft not only is in the trillion-dollar valuation club, it's in the multiple trillion-dollar valuation club with around $2 trillion, putting it just behind Apple. So a massive company. Its various brands, I think, speak to that. And it has been so fun to watch the way the AI plays out in terms of their various cycles.
You know, Jen, you made a point to mention Activision. And Microsoft has done a really good job of not only growing revenue growth organically, but growing it through acquisitions. Not only Activision, but LinkedIn as well, and other companies that they've acquired. But Jenny, if this stock is going to overachieve or outperform in 2024, it's got to be PCs. Right? Because the growth in PCs or a recovery in the PC market is going to mean Windows licensing and Microsoft 365 and Microsoft Word and the productivity suite, all those other products that feed off new PC sales, right, Jen? So isn't that the key for this stock next year? We know what's happened this year. What's next year going to be?
That's a really good point. And I feel like towards the end of 2023, all we talked about was, are we in the bottom? Have we reached finally the sort of the end we could see in lack of demand for these PCs, with other companies with massive PC exposure also hoping, I think, for the same thing. So I do agree that while any PC recovery will be a huge thing, and perhaps the bottom is already behind us, hopefully, I guess, for Microsoft's case, I do still think in terms of what the street cares about, I'm not saying this is my opinion, just based on their earnings moves, is cloud. It's like they could come out with earnings and say all these various things, and all that matters is the position they are taking in the overall cloud world, how much they're catching up to AWS, how much they're growing. The street is punish stocks that aren't able to post significant growth rates. Like AWS, we saw for so long was seeing that declining growth rate, still growing, but not good enough for the street. So I agree a PC market recovery will be huge, but seems like right now all anyone cares about is their cloud.
Yeah, and I think those partnerships that they have with Oracle, OpenAI, Salesforce also going to really matter as far as that goes. But then also you look at enterprise spend going into 2024. Our company's going to start to really ramp up their enterprise spend, because that was supposed to pull back pretty significantly in 2023, and it didn't happen as much as we thought it was going to. All right, great stuff. Great backdrop here. Microsoft in its year that it was, and what to look forward to in 2024 from Jenny Horn, markets correspondent. But now let's bring in Nathan Peterson, Director of Derivatives at the Schwab Center for Financial Research. Nate, I wanted to get your take here just on the equity moves that we've seen so far this year. As I mentioned to Kevin at the start of the show, we pushed back against everything that was supposed to happen, and you saw, the NASDAQ 100 and the Dow Industrials hit all-time highs in 2023.
Yeah, absolutely. And, I mentioned that to Oliver, maybe sometimes you got to zig when the market zags, when you look at some of the swings that we've seen this year. And how wrong the bond market has been, the analysts have been, the Fed has been, and we've lost 120 basis points in the 10-year here over the last 6-7 weeks or so. Have we gone too far? And so one of those risks as we roll over the calendar into 2024 would be a reset of the Fed expectations, or how many cuts they do, or a reset of, you guys mentioned it, inflation expectations. The consumer looks
about being banned from stock
looking at
twits.
the recent data points, and I think the easing of the financial conditions, along with the stock market near all-time highs, housing prices.
I told Bob Iger, I said, Bob Iger, when are you going to put out your next tranny movie? And it didn't take 2 seconds, and that was blocked off. On Disney, I put Disney, I said, Bob Iger, when are you going to put out your next tranny movie? Are you serious? I messaged him. I said, "Are you serious banning me for that?" I said, "Man, the trend is tranny, right? We want to, we believe we want to accept the new lifestyle, and where to start would be Disney." So that's why. Yeah, I put it on Twitter, and it didn't bother Twitter a bit. So they permanently banned me. You gotta watch what you say on StockTwits. Don't criticize their icons, whatever you do. Elon loved it. I said, "Come on, man, you're banning me for this? Do you know what a freaking joke is?" And then the stock tanks. I mean, why are you pushing that crap on our kids? America's just gone down to the shitter. Oh, you did? Did they have a love scene? Little Mermaid. "Oh, I'm quite attracted to you, Mother. You know, I'm woke. There's nothing wrong with falling in love with your mother."
Going to firm up here a bit at the end of the year, but still, crude oil is going to be a big story for next year. Inflation is going to be a big story for next year. Geopolitics is going to be a big story for next year. There's a lot going on here that can disrupt stocks. And Nathan mentioned valuations are not cheap either on a lot of these big names. So listen, there's a very euphoric feeling going into the end of the year. But boy, there's plenty of these landmines out there on the horizon that can trip up this market.
You just took my word. I was going to use that. There are landmines out there, Nathan. After 11 meetings where they hiked
No,
rates,
I got blocked from StockTwits.
75 basis points. Expectations next year, as Kevin mentioned, the market's pricing in 5 to 6 cuts of 25 basis points next year.
I'm gonna go get the
If
shovel
that
and I'll be
happens,
back.
You see a scenario where it's soft
I'll put the
landing,
volume
now
high
another
on
cut,
here.
or do you look at what the Fed's projecting, 3 cuts of 25 basis points, which would help us navigate that?
Niall's
soft landing?
already up.
It seems like there's a bifurcation here between what the market wants and is pricing in versus what the Fed is told them they're going to give them.
Exactly.
Yeah, and I'd say that bifurcation has existed
Bye-bye.
basically the whole time the Fed's been raising. The bond market has always been, always doubting the Fed and leaning towards the dovish. We do know they want 6, or they're projecting 6. The Fed says 3. The biggest, and look, we can see why the market is really enjoying this environment with the Fed pivoting towards an accommodative mode and being on their side, having a Fed put in place. If you look at the way we've been conditioned since 2008, it's not surprising to see the market that exuberant about that. But what's different this time is the inflationary component. On the previous times when we had the pivot, like back in 2018, for example, inflation was non-existent. Here, it looks encouraging. The trends are there, I got to admit. But with the recent easing, that's one of those questions about whether we get a reset there. And the other thing that I would throw out there, we got leading economic indicators this morning, negative for the 21st month in a row. You're basically saying it's different this time, even though historically that's been a negative indicator. We're also saying the inverted bond yield curve, it's different this time. It's like that's not even anywhere in the discussion. It's nice to see stocks around all-time highs. I'm enjoying it myself. But yeah, just let's respect the environment and the potential for those landmines to show up like you guys are talking about.
Yeah, some of those data points, that leading economic indicators that we saw this month in December, continues to show that might trigger that weaker than expected first half recession, Kevin. I think that's what a lot of people are looking at that, because the Fed looks at that number. But going into 2024, Kevin, you mentioned the landmines that are out there with the valuation stretched at this point. It kind of brings me back to that 2017 and 2018 when we had the Volmageddon reaction, when everything was going higher on the optimistic outlook moving forward. Are we in that same scenario, or is the robust jobs market, the consumer still out there spending, going to help navigate that soft landing?
Long and variable lags, right?
Yeah.
It's a very vague term,
Yeah.
and they can be plugged in at any moment. So what has happened to the overall market? When are the lags showing up? Have they started, or have they not even really a wave of higher rates hit the market yet? Remember, they say 9 to 12 months. There's a lot of play on when these interest rate raises hit the market. So I just think there's a lot of reasons not to be as euphoric as the markets are, or the pundits talking about the markets seem to be. They're all getting their pencils and erasers out and taking that 5,000 S&P and moving it to 51 and 52.
Right.
They're all moving it higher. Why? Well, because we've rallied into the end of the year, so they're moving their benchmarks higher for next year. It's just, I've seen too much, Tom.
Yeah.
And when it seems too good to be true, it usually is.
Yeah, you and I remember those days on the floor where, hey, we're grinding higher or we're grinding lower.
Seems like you'll never, ever go down.
Right.
And then you do.
But maybe we just need one of those years where it's a 7-8% gain for the S&P 500.
Can it happen? It absolutely can,
Yep.
with rates going down.
Yep, for sure. We'll see going into 2024. But one of the not surprises, I think, in 2024 is the moves that we saw in Apple hit a new fresh all-time high in the month of December, despite decelerating revenue growth. When we come back, we're going to take a look at Apple, the year that was, and the year that...
Yeah, do you have
may
snow
be,
shovels in?
For Apple, as it's near all-time highs. Fast Market's coming right back.
Yep. You should know that, honey. Yeah, do you have snow shovels in?
Trading at Schwab is now powered by Ameritrade.
Thank you.
Unlocking
Bye-bye.
the power of Thinkorswim, the award-winning trading platforms. Bring your trades into focus on Thinkorswim Desktop with robust charting and analysis tools, including over 400 technical studies. Tailor the platforms to your unique needs with nearly endless customization, and track market trends with up-to-the-minute news and insights. Trade brilliantly with Schwab.
It's time to look forward.
Find the next trend.
From every click to every tick.
There's no fear of missing out on next-gen investing.
Available anytime, anywhere, on any device for free. Empower your portfolio with the Schwab Network. He's Alex Coffey. I'm Jenny Horn. Join us for Next Gen Investing.
1 p.m. Eastern, only on the Schwab Network.
Download the Schwab Network app and join in on the latest market trends. Anytime, anywhere, on any device for free. Schwab Network.
Empower your portfolio with the Schwab Network. Schwab Network is available anytime, anywhere, on any device for free. Schwab Network.
Kickstart your morning with a full dose of commodities, technical analysis, economic data, and live reaction in global markets. Available anytime, anywhere, on any device for free. And available on all your favorite streaming services. Futures with Ben Lichtenstein every weekday, 8 a.m. Eastern on the Schwab Network.
Welcome back to Fast Market here on the Schwab Network. We're talking Apple, the year that was. Shares are up around 50% so far in 2023. Hit an all-time high during the month of December. Kevin, when you look at this company, you know, what sticks out to me, only Apple Services Unit grew revenues on a year-over-year basis. All other products, iPhones, iMacs, iPads, wearables, all decreased. Yet once again, Apple defies the odds and is a $3 trillion market cap company, hit an all-time high in December.
The iPhone is 52% of their revenue, Tom, and the iPhone is not really growing. Now, make sure we understand something. The iPhone has been struggling lately, but that can resurge just like a PC market can resurge, and it could be cyclical, and there could be another big wave of iPhone purchases coming up, but there's no guarantee that they'll do that. And Tom, the 5-year average for PE on Apple is 26. It's currently trading just under a 32 PE. So everything that could be really good about Apple is priced into it now. So there's really no room in terms of valuation for mistakes here. Now, it's been slightly higher in terms of the PE, but it hasn't stayed there very long when it's been higher than this.
Yeah, I think people are euphoric a little bit about the services side is growing revenue, and that's their bigger margin side of their business, which I think has put you know, a lift into the shares. Nathan, when you look at this name, you know, maybe they do get that resurgence. The iPhone 15 is selling well, but now you've got some problems into the holiday shopping season that they can't sell the watch due to some issues with the company, you know, about the sensors on that for blood oxygen levels. So that might dent those expectations because it's supposed to be flat in the fourth quarter. But moving ahead, and I think that's what investors and traders are looking at, into 2024, they expect, or I think the market or the stock is priced in, that they are going to start that reacceleration of revenue, which is kind of appeasing investors at this point.
Yeah, you know, I think if you listen to a lot of the, excuse me, analyst commentary around Apple, the bulls, so to speak, they're really probably citing or honing in on three things, and it's services growth, it's growth in India, and then potentially in the Vision Pro category. You know, look, I'm not an Apple analyst, but I'll tell you guys, in regards to the Vision Pro, I'd rather take a 3,500 Mediterranean cruise rather than get a pair of those goggles that has a cord sticking out. I don't know if that's going to actually translate into the bottom line for them. We'll see. Experiences, we kind of like real life experiences rather than perhaps spending that much money just for a virtual experience. But yeah, the big question mark there is that valuation and the lack of revenue growth, and will it reaccelerate? I mean, if you've got a 30 PE, and if we say that a PEG ratio, a price to earnings to growth ratio of 2 is normal, you'd expect something around 15%. My question is, has the law of large numbers really come into play here in terms of Apple? They're the largest company in the world, and it gets difficult to grow at that type of magnitude. So a 30 does seem a little bit high in retrospect.
Yeah, and if you look at a lot of cash on their balance sheet, they're repaying shareholders, they're shareholder friendly at this point with dividends if those get paid out.
Not a big dividend though, but a dividend.
And it continues to grow, right? They just instituted that a couple of years ago. So there's some positives there. But Nathan, looking at maybe you know, into the January cycle or through into February, how do you want to look at this from an example trade perspective?
Yeah, so they're likely going to report, you know, late January, early February. When I look at the stock chart there, did they hit a new all-time high recently? Yes, but very tentatively so. They basically hit 199. The previous high was 198 back in July. And, you know, it's it looks a little bit double topish. When you're breaking out to a new all-time high, technically speaking, you'd like to see some conviction, some volume behind that, some follow-through, a continual push higher, suggesting that there is actually price discovery going on and a re-rating going on with Apple there. But given the fact that it's been tentative around all-time highs, and given going into January, it wouldn't surprise me. I spoke to some of that rotation. Mega cap tech has been great. You know, we've seen new 52-week highs in, you know, Meta and Alphabet and Amazon, and, you know, like I said, all-time highs in Apple. That's great, but they also are widely held. They could be a source of funds. So I'm not saying January is going to be a down month for stocks like these, but it's not uncommon in the month of January to see some of that rotation. You don't know when it's going to kick in. It could be the first week, the second week. maybe it doesn't happen at all. But given the setup heading into next year, I was looking at just the standard or the January 26th, weekly, 195, 190 bear put spread. It was about $1.75 last I checked. That's about a 1 to 3 or risk 1 to make 2 type of a ratio when this $5 spread. And again, this is a little bit of Apple's stock has been performing exceptionally well since the end of October, but maybe you zig a little bit when the market zags.
Yeah, let's break this one down, this example trade. Going out to the January 26th weekly series, so just about a month into this position, buying the 195 put, selling the 190 put, $5 wide bearish, put vertical here, paying roughly about $1.75 debit. That's going to be your risk. The debit that you pay for it is going to be your risk, with a break even about 193.25 to the downside. If you're looking at a price of around that 190 to 195, you don't have that much to go. It might already be below that. But Kevin, this is pretty straightforward, and because you're buying it, you have that opportunity to maybe close it or adjust it if the market's open ahead of time. But it's definitely just a slight bearish type of position if you're looking at the stock around 195, 194.
Nathan's paper money trade is a long put vertical out about a month, just a little bit over a month. He's got about 17 and a half short deltas, and this is one where he mentioned the payoff is about, you bet 1 to make 2 on this one, right? If it can go to around $5. So this is a play where maybe you think remember, Apple's in 3 of the 4 indices. If the market does a global sell-off, Apple will be involved in that.
Right.
Look at the chart. It doesn't go straight up, and it's sitting at or near highs and a pretty high valuation. So this is something that takes the opposite side of the market that we see the momentum going on here. So yeah, an interesting way or a fundamental way to look at Apple.
Yeah, it's not surprising. This is a contrarian type play to what the moves we've seen so far in 2023, but the risk is what you pay on this type of trade. It's a low risk number compared to what you can make on it. Risk reward setup pretty good on this one. But if you're contrarian and going against Dan Ives and his $4 trillion market cap expectation that he thinks he was on the network talking about that, then this goes against that, but it's a shorter dated spread into the January, but avoids that earnings event, which takes place February 1st. So good look at that example trade to the downside there.
Tom, real quick. This is not a bearish view on Apple. It's more of a tactical positioning, kind of a setup for the next month or so. And if you get that rotation that does occur, they're a spread trader. When they put something on like this, you don't know when it's going to happen. That's why you get a little bit of time here, almost 5 weeks. If you get that rotation, if you get some money that flows out of the technology sector, or noting that the S&P hit an 82 RSI yesterday, maybe you get a pullback in the overall market. If this spread in early January expands to say anywhere around 350, a lot of spread traders might say, good enough, thank you, see ya.
Yeah, and that goes back to that flexibility of when you can adjust or close a portion of this or all of it, because it's a long one. And lower implied volatility means it's going to cost you less to buy a strategy like this when the VIX is around that $12, $13 level at this point. All right, great stuff. Thanks to Nathan Peterson, Director of Derivatives at the Schwab Center for Financial Research, joining us breaking down Apple. But let's take a quick break. When we come back, we're going to be joined by Landon Swan from Lightfolio for discussion on Amazon resurging in 2023 to 52-week highs in the month of December. We'll get the consumer data on that when we come back here on Fast Market.
Ameritrade is now part of Schwab, bringing you an elevated experience tailor-made for trader minds. Go deeper with Thinkorswim, our award-winning trading platforms. Unlock support from the Schwab Trade Desk, our team of passionate traders who live and breathe trading. And sharpen your skills with immersive online education, crafted just for traders. Also, you can trade brilliantly.
Binge watch the market with the Schwab Network. Tune in 24 hours a day, 7 days a week at schwabnetwork.com and on all your favorite streaming services. Schwab Network, available anytime, anywhere, on any device for free. Schwab Network.
Spotlight the biggest market trends on Trading 360. 11 a.m. Eastern, only on Schwab Network.
Kickstart your morning with a full dose of commodities, technical analysis, economic data, and live reaction in global markets. Available anytime, anywhere, on any device for free. And available on all your favorite streaming services. Futures with Ben Lichtenstein every weekday, 8 a.m. Eastern on the Schwab Network. Fast Market here on the Schwab Network. It's time for our cash tag segment. Let's bring in our next guest. That's going to be Landon Swan. He's a co-founder at Likefolio. Welcome back to the show, Landon.
Thank you. It's great to be here.
All right, so we got our year-end show. We're covering big tech. Amazon, this thing was left for dead at the end of 2022, down near $81 a share. We've seen a big resurgence to 52-week highs so far in 2023, Landon. Do you guys have the data that kind of supports this? Because this has been a spectacular rise over the last 12 months.
It is. You know, it's nice to see Amazon trading so strongly in December. It's still got a long ways to go. Not a long ways, but it's still got a ways to go to get to the pre-lockdown levels of a couple of years ago. But it's on a nice run. And I'll tell you what, a lot of the data that we see is pretty bullish. I mean, you think about some of the numbers that they've been putting out. They've had over $46 billion in advertising. They're adding advertising to Prime Video, which is really nice. We saw what happened with Netflix with advertising, so I think that there's some room there to the upside. And of course, when you talk about end of year Amazon, you got to talk about how the holiday shopping has went. So we're seeing a plus 8% mentions on people talking about using Prime and using those Prime features for their shopping. Which is, obviously it's stronger than last year. Last year was pretty good, but it's nice to see that a lot of consumers are turning towards Amazon for those holiday needs. And you can see here, the run up over the last little bit, still really nice on a year-over-year basis. And also, you know what? They're delivering a lot of goods. They're actually competitive, actually delivering a little bit more if you look at the charts of than UPS and FedEx in 22. So we're likely to see that gap widening. So they're getting into the delivery game, and of course that's a big part of what they do is getting people what they need very quickly. So when it comes to consumables and everyday essentials, people are getting used to customers are getting used to that very quick and convenient delivery to where they need something and they're getting it today, maybe later in the day, or worst case tomorrow morning. And what that does is it sets that precedent in the consumer's mind is, all right, I'm going back to Amazon next time I need something. And that's a very, very powerful thing, especially when you think about how that could affect other companies like Target, Walmart, Costco. And if you're just able to get on your phone or your computer and get something delivered to you right away, it's going to drive that engagement and the stickiness of the use of service. Now, speaking of those companies, you can see here the happiness levels. Amazon's right there with Costco at 70%, 69%, a little bit ahead of Target. And as we've seen for most of Likefolio data, Walmart bringing it up the rear at 60%. Not a surprise there, but it just kind of goes to show you that they've got happy customers. Costco's leading the way, but we're only talking about a point here difference between the two. So for all intents and purposes, you can say that Amazon's basically at the top of consumer happiness when it comes to large retailer delivery. So love to see that. And also, you talk about the stock. They've had a good run up in 2023. They've done better than Google, Amazon, or Google, Apple, Netflix, Amazon has better than all those other companies. But of course, there's still room to grow to get back to where they were. The only sort of, I guess, hiccup that we've got for Amazon is their AWS services. So, they were plus 35% in 2019. Now they're plus 15% in 2023. And you can see that, when you look at mentions, people talking about using them, they're down 11%, whereas Microsoft and Google doing a little bit better. Google leading the way, as you can see here on a mentions basis on a year over year. So while they're still growing, their growth has slowed significantly. Like I said, from plus 35 down to plus 15 this year in 2023. I'm interested to see how generative AI affects this, because I know a lot of companies are basing their development on AWS. Some of them are going all in on AWS. So it's going to be interesting to see if this sort of caveat, this is the one area that we're a little unsure of with Amazon, if that goes away in the early parts of 2024 or not. They've got a great platform. I can tell you, Folio is on AWS exclusively. We love it, but a lot of people are building new things, and what percentage of those are going to go on Amazon versus Microsoft and Google. So with the consumer, we see nothing but greatness with them. I mean, they've done really well in the past. We believe that 2024 is going to be great. With developers, I think is the only area where I'm a little concerned that Google may be taking a little bit of their market share here.
Landon, their stock price has reflected a new focus on balancing growth with earnings and free cash flow. And that's made this stock look a lot better to a lot of people. The market's kind of fallen back in love with Amazon this year. But what you mentioned about next year and going forward, it's got to be two things, right? As new budgets come out for next year, people are going to look at it at advertising that dipped and now is starting to recover. And it's AWS that dipped and it looks like it wants to recover. So if you want to focus on two things for next year, it looks like AWS and advertising growth, but this focus on earnings now, not just spending and growing, is really starting to affect the price of this stock, Landon.
Yeah, you're right. I mean, for a long time, it was all about what's our growth rate. That's it. Who cares what the expenses are? Let's see how much revenue we can get. But now, this is no longer that small company. This is a dominant, massive company. And every little tweak that they do, every basis point matters with this company, because you've got such big numbers that if you can squeak out, 0.1% here and 0.5% there, you are making a massive difference to shareholders. So it's got to be all about efficiency, and it's got to be getting those consumers to return back. So what I'm saying is I think that they've done a really great job with the consumer, and we see no signs of weakness. I mean, for a while there, we were looking at, is Target, is Walmart, maybe Costco going to take some of Amazon's, take some of their share of the pie, and I think that for a while, especially during the lockdown, Amazon struggled. I mean, they went from it's 100% you're going to get your item in 2 days to now it's like 2 weeks here and there, and they struggled for a while, but now they're back on track. You're getting things definitely within 2 days, a lot of times same day, and I think that they've done an extremely good job with consumers. Now it's just a matter of getting more efficient and increasing those earnings. And then, just like we said, it's all about AWS for some of that growth. They've got some serious competition there, and I don't think that they have, the name recognition doesn't matter as much. The brand loyalty doesn't matter as much as it does with consumers versus with developers. So they've got to do a good job competing with Microsoft and Google, and those are two tough names to compete against. But definitely bullish in 2024, and I love what they've done in the month of December for 2023.
Yeah, that was going to be my call going into 2024. You guys are still bullish, even though the stocks rallied up to those 52-week highs. But Landon, how important is the margin side of this advertising boom that Amazon's seeing, and the partnerships that they've got in AWS at this point, which kind of lend to that credence of, hey, if they're already the biggest cloud provider and the AI tools that they're generating right now for their customers, is that give them a leg up?
Yeah, absolutely. I mean, first of all, on the advertising, it's a small part, I think, of what they do so far, but the fact that they're getting into it, they're adding it to Prime Video, it makes me, obviously bullish on revenue on that side of things, just like we talked about with Netflix. So I love to see what they're going to do there. They've got so many people on their website all the time. It's not hard. It's not going to be difficult for them to increase revenue on advertising. So very bullish there. When it comes to AWS, yeah, they're the clear leader, but that growth is slowing, and it's kind of a bit of a wild west when it comes to AI right now, because it's a brand new technology. We're not talking about building web applications or mobile applications anymore. Now we're talking about something completely new. And if you can build something on a platform that is 10% better, you're going to move your development resources from one to the other. I'm not saying that Google and Microsoft are better than Amazon, but I'm saying that the competition really is a huge factor, because as a development firm, you've got to know where you're going to get the most bang for your buck. And AI is so competitive when it comes to computational reliability and performance that you will move based on those types of things. Whereas when it comes to web or mobile app development, it's not that critical that you have extremely fast processing that can do a ton of calculations per second. But when it comes to AI, it is extremely critical. So people will move to the best one. So that's, I think, their biggest potential weakness. But yes, 2024 like Folio is bullish Amazon, even though they're high on the 52-week chart. Zoom out a little bit, and you can see there's room to run.
Yeah, I agree with that. Also, you look at a 3-year chart or something, we're not even close to highs yet. So definitely have some room to run if they continue to execute. All right, great stuff. Great data as always, Landon. Have a great day.
Thanks, guys. Happy holidays. Happy New Year.
All right, that's Landon Swan, co-founder at Likefolio, breaking down the data on Amazon. And Happy New Year and happy holidays to him. And happy holidays to every other Amazon shareholder out there, Kevin, because it's bounced back, down 50% in 2022, up about 80% in towards the end of December here. How do you want to look at this from an example trade?
So
they're still bullish.
100 shares of Amazon right now is about $15,200, right? So what happened? What if I told you, Tom, they really don't have a dividend? So you can go out 393 days, Tom, to next January, okay, and do a stock replacement strategy that basically trades it for a sixth of the price. What do I mean by this, Tom? If I went out to January of 2025, so 393 days, and bought the 145 strike, okay, which is, I'm sorry, I did the 150 strike, I'm sorry. It was about $3 in the money when I looked at it. Now it's about $2.50 in the money. Buy the 150 call out to next January. Then you go to the January expiration, so 1 month from now, and you sell the 160 call. That's right in line with the expected move. Tom, the eyeball test on this doesn't look right. It's a $10 spread, and you're paying almost $24 for it, right? So the common sense would say, what the heck am I doing?
A $10 wide call diagonal.
For $24.
Yeah.
Right. But think about this. The price of the 160 call right now in Amazon, the 1 month out, 29 days, is trading about, the $1.60 is trading about $1.75. Right? Think if you did that every month. Right, you've got about $2.50 in intrinsic value, right? That takes you down to $21.50. If you do that 11 times in the next 12 months, that takes about 10 is 17, about almost $19 in premium out of that. Now you've got this for a much more reasonable, and you understand the theory behind why you do something long term like this. So a long dated stock replacement strategy that you can do shorter. You can always move it up. You could extend duration on this trade, Tom, and roll every week if you wanted to. But if you just wanted to do it 10 or 11 times, this is one way to do it. You buy a year out. It doesn't, the eyeball test, but you have to trust the math, Tom. If you did the 159 strike, it's $2. $2 times 10, that's 20.
Yeah, and that was only adjustments on a month-to-month basis.
Yes.
You have the ability to roll short options on a week-to-week basis with the weekly options.
As often as you'd like.
Right.
And then if it were to roll up to 160, you would roll that trade out more, but remember, you'd have profits. Right? If this stock goes from 150 to 160, there's going to be profits in your account to work out and put on new strike prices and roll strike prices. But this is a strategy where you're spending a fraction of the price of the stock, and your fraction your risk is a fraction as well, Tom.
Right.
And what's the differentiator? No dividend in Amazon.
No dividend. All right, so let's break this one down. Going out nearly 400 days to January of 2025 expiration. Buying the 150 strike call that was about at the money at the time that this was looked at. Buying the 150 strike call there, going to the January monthly cycle of 2024 on the 19th at expiry. The 160 strike call, you sell that one, you're paying roughly about a $24 debit. There's your risk, $2,400 per spread. And as Kevin mentioned, capital intensive buying the shares with no dividend. 150 strike call out in January 2025, about a 65 delta, so it's got that higher delta, it reacts more like the stock. But that debit you paid $24, now you break even just below 152. So if you're trading this with the stock trading at 152, you're right there. You've got an upside break even now of about 185 to the upside. Now that's break even is only if this stock just rock and rolls up to the upside here, Cap.
Right. One last thing. There is some risk on the upside in this trade because of the premium that you spent. When it gets up towards 160 or 161, you don't want to stay too much longer. You want to extend duration or close, right? If the market allows you to close, you can close it first. Or if you remain bullish on Amazon, you can extend duration and move the strike out date and strike price, Tom.
Right, exactly. And we see that upside break even about above 185, but that would only be if this stock ramped up exclusively. But as Kevin mentioned, as you get closer to January expiration over the next 3 to 4 weeks, you'll be able to roll or adjust that collecting credits, whether it's to a weekly or monthly options. But this is a long dated spread all the way out to January 2025. You'll have some transaction costs and some assignment risk on those short options, but a good look at a different way instead of buying the shares to buy a longer dated call diagonal here in Amazon. All right, Kev, let's take a quick break. When we come back, we're going to talk about another name that's been leading so far in 2023, and that's NVIDIA. The AI revolution has begun with NVIDIA. We saw some remarkable earnings events from this company as they build out their chips, the market leader there. Fast Market's coming right back.
The Schwab Network app and join in on the latest market trends. Anytime, anywhere, on any device for free. Schwab Network.
Wrap up the trading day with me, Oliver Rennick, for the biggest earnings coverage, 3 p.m. Eastern. It's Market on Close. No place better than the Schwab Network.
All the need-to-know info from every trading day. I'm Renita Young. Earnings, data, the biggest headlines that move the market, all condensed into a few minutes. Download the Schwab Network app and join in on the latest market trends, available anytime, anywhere, on any device, for free. Recap your trading day with the wrap, right here on schwabnetwork.com.
Kickstart your morning with a full dose of commodities, technical analysis, economic data, and live reaction in global markets. Available anytime, anywhere, on any device for free. And available on all your favorite streaming services. Futures with Ben Lichtenstein every weekday, 8 a.m. Eastern on the Schwab Network.
Fast Market here on the Schwab Network. We're talking big tech in our year-end show. Let's bring in our next guest, and that's going to be George Tillis, Senior Markets Correspondent here. George, Talking NVIDIA today, the leader of the AI revolution. They got 80% of market share in AI chips at this point. They're the picks and shovels. It's hard to bet against a company that's gone up over 200% so far this year.
Well, I mean, it's been a remarkable, past 52 weeks for NVIDIA, and you're right. I mean, you got to consider what they do. I mean, they are the lead architect in transformative technologies. They have a first mover advantage when it comes down to their core GPU technologies. But one thing about NVIDIA is they're just expanding their offerings from the standpoint of their Omniverse cloud platform as a service. So they're becoming effectively a software as a service integrated alongside their hardware, which you're right, they have the best technology as well as the largest market share. And I think the deployments of AR interface, in which of course NVIDIA is the core part of or building blocks of, is going to increase tremendous amounts of productivity in our economy. And I think that's one of the reasons why we've seen such a tremendous move in the stock over the past year. But they've actually backed it with tremendous amounts of earnings growth, over 268% expected by the end of this year, including the quarter we're in, as well as sales over 118%. So like I said, they're backing up their earnings and sales with the technologies, and there's no doubt this is a company that's very formidable in terms of its market position, and it's part, like I said, of that leading transformative technology, which is extremely enhancing productivity going forward.
George, this stock's PE has actually come down over the last several quarters as the earnings have grown. Rosenblatt just put an $1,100 price target on this stock, George. Their chips keep getting better and stronger. Are they soon to break through this 500 level that they seem to have a lot of trouble getting through, George?
Well, yeah, I mean, you bring up a great point, Kevin, because a lot of the folks earlier in the year were saying, hey, NVIDIA is too expensive. It was trading around 90 to 100 times earnings, and as the stock price has gone up, it's actually cheaper, as you mentioned, on a PE ratio. I think it's tough to move a stock, especially one that's at $1.2 trillion, considering how we've moved so far, especially in the last 2 quarters where there was a huge jump in earnings and sales. But overall, if you look at the valuation from an earnings growth standpoint, they're expected to continue to grow their earnings at over 60%. It's trading around 39 times earnings, so its PEG ratio is less than 70 basis points, and so one would say that's still a good value. But again, I think if you consider those price levels at 500, it seems to be stuck. It's sort of stuck in a short-term trading range, and I think it really comes down to the absorption of this equity, which is tremendous, like I said, at $1.2 trillion.
Yeah, $505 all-time high that we hit earlier this fall. So see if we can get back there. Big jump, but expectations continue to rise in this space. Competition coming though. All right, thanks to George Tillis, senior markets correspondent here, breaking down NVIDIA on a great year into 2023. Kev, so I looked at this going into 2024. They've kind of consolidated over the last several months between about $400 and $500 on this stock. So if they do break out, this is a strategy that takes advantage of it, giving us longer dated into the March expiration. So you'll actually capture the next earnings event on this one in 2024. So going out to the March monthly cycle, so you've got 3 months in this, about 3 months, about 80 to 85 days in this, where you're going to buy the 490 call strike one time in March, sell 2 of the 540 strike calls, which would be a new all-time high, and then buy 1 of the 550 strike calls. So you're buying an unbalanced or broken wing skewed butterfly here to the upside, paying roughly about a $16.50 debit if the stock's trading roughly around that $485 to $490 level. But the debit you pay on this one, $16.50, is you're going to be your risk, $1,650 per spread, with the apex of profitability, Kevin, at or near that 540. But because you made it broken wing, Kev, anything above that break even of about 506.50 to the upside is profitability.
$50 call vertical financed by a $10 short call vertical, Tom. Gives you about 16 deltas. You're playing this all the way out till March time. You're looking for exactly what we just talked about, which is that break through the 505 level that it's hit, frankly, several times, Tom. So this is a bullish play
out 3 months in NVIDIA.
Yeah, and if the stock's trading at or near about that 490 level, Kevin, that 540 level is only 10% gain from these levels, or from that price. So I think you take that into consideration. Do you think it's going to go up? But then you start looking at your duration. This is about an 80-day trade or so on that, but everything above that break-even profitability. All right, that's going to do it for us today here on Fast Market. Thanks for joining us in 2023. We're looking forward to 2024 right here on the Schwab Network.
Right. I am back. What's this here say? Commission taxes, transaction costs include these cases. Contact your tax advisor. Schwab does not recommend use of technical analysis as a sole means of investment research. Past performance of a security or strategy does not guarantee future results or success. Man, come on, can you have a little upbeat, Charles? If you ever listen to Washboardjim, he's full of shit. You know what? I want that redacted. I will not tolerate that kind of behavior. Good morning, retail traders. Or good afternoon. Woo, it's getting nippy outside. I probably bought a show shovel and don't need it, but my last one lasted 11 years. And it got so cold last year, we got 40 below temperature that plastic broke. That was a strange day. Plastic broke on the snow shovel, plastic broke on a lid that I keep my towels in, and the plastic broke on my vacuum cleaner. All in the same day because it got so damn cold.
Today, though, I think disruption is actually a great way to just. Disruption is what we see, and then as a result, we see some of these cybersecurity stocks come in and hopefully save the day. And a lot of these names have seen absolute phenomenal 2020.
Amazon's popping.
Palo Alto Networks, Fortinet, just to name a few.
They're really
but
talking
overall,
up Amazon.
The digital evolution has now
We had a double
created
bottom.
this vast need for these cybersecurity companies to perform and to perform
And
quite
again,
well, as AI is
inverse
another
head and
major
shoulders.
threat to cybersecurity. So as that continues to advance quickly, I'd say alarmingly even so, these companies will then have to follow suit. Now, by the end of the coming year, the cost of cybersecurity attacks
Amazon
is expected to top around
broke the 200, so that's got to come back and touch the 9.
It's a major industry. We've seen names like T-Mobile being accused of 2 data breaches back earlier this year. Another major one was MGM, which its website was down for days. I kept checking and I was like, how have they not solved this yet? But that just goes to show the severity of some of these breaches. Clorox is perhaps the one that's seen the most
Nike pulled back today to support.
As it did say back in its first quarter earnings, or its previous earnings, that are
Target's bouncing off the 200,
as a
but
result
not
of the
much.
cybersecurity breach. So it has impacted Clorox, and we've still seen shares sort of suffer as a result of that breach.
And because this is happening in kind of the public light, when these companies are facing these cybersecurity breaches or hacks or whatever terminology you want to use to describe them,
Clorox is
we're
one of my
seeing that
toughest
material
trades
impact.
ever.
We're seeing
Never could get it
names
right.
like, VFC say that this is going to make it so you can't actually get your fulfilled order that you paid for some time. And when you start seeing those impacts, it makes companies that aren't impacted start thinking, do we need to up this cybersecurity budget? Do we need to be worried about this? And it kind of shows how this technology has gone to almost be a staple for businesses and a requirement.
Tesla will hit
for
300
ongoing,
next year.
circumstances. And really the one thing that seemingly has held back any of these publicly traded names has been themselves, because all the names that have been able to execute efficiently and well, they're having blockbuster 2023.
They are, and I remember Palo Alto Networks had earnings
Coin
on
and
Friday
MSTR
afternoon, their biggest day of
overbought.
billings. Everyone was all scared, and it was fine. So Palo Alto Networks actually did recently report a net income increase of 871%, just to speak to the need of this industry and how a lot of these companies are capitalizing fairly well in terms of their performance this year, but also in terms of their growth metrics have just been phenomenal. Zscaler, CrowdStrike were also notable names that saw that nice lift as a result of their exposure to the cybersecurity space. But we'll be looking more at that theme now coming up next, as well as, of course, the EV theme, which is one of Alex and myself's favorite. We'll be diving into some technicals in the overall spaces, looking at some stocks with our chart master, Ricky Cat, coming up next.
Schwab Bank Investor Checking, the checking account built for investors. Named highest in client satisfaction by J.D. Power for 5 years in a row. With Investor Checking, you get the award.
Shut up. So we're watching Baidu into next week. I wonder what they mean by double bottom in force. I don't understand what they mean by that. Double bottom in force. F-O-R-C-E. I mean, that's a whole new terminology for me. LVS, double bottom in force. Starbucks. Now here might be something interesting. I'm getting ready to make me some coffee myself. I don't go to Starbucks. I haven't bought Starbucks since 2004. 2004. I think I said goodbye to Starbucks when I moved to Hawaii. 2004.
Reflects a lot of the interest and enthusiasm for this field here. We're up about 150% off those yearly lows all the way back down near you, and the chart has several interesting things about it. First of all, I wanted to point out one thing here is that we had some highs here around the 214 level. That was a bit of a consolidation point right there where we topped out and bottomed out there. It was another low point here as well. So that's why this type of thing can be useful to look out for.
Show up the head and shoulders, you idiot.
Areas, and now that, once again, is a support point to watch going forward here. Since we hit our yearly highs just shy of 300, just not even a dollar below that point, you can see that we formed a downward sloping channel here.
It's a wedge.
Notably, we had a lot of sideways price action here. We saw our moving averages cluster together. That is a situation that speaks to lack of clear trend. It speaks to directionlessness. And we can see that the low end of our range matches up with our post-gap opening here, and also where we topped out a couple times there as well. Once again, it can be really important to keep track of these gaps.
What a cameraman, come on.
Keep stopping because they can be important down the road. Now you can see that price pushed above the highs that we established with this blue line here about 247.
I'll let him talk and then I'll do my analysis.
Upside. We also broke out of our channel to the upside as well. RSI looks important too. We topped out twice, right around the 60 mark. Then we pushed above it in tandem with our breakout here. So overall, that's the kind of thing you want to look for in your trading. Look for these key areas of resistance or support, and then seek to join in the trend if that's how you plan to trade. That's why we look for these things, because the breakouts can be quite energetic.
Yes. No kidding. I mean, this name did close out the year as one of the best S&P 500 performers, but obviously it wasn't a clean path to get there. As I do think that push and pull between those very polarized bulls and bears is what we're seeing reflected on this chart. But to look at another EV name now, that's Rivian. And Rivian, I can imagine, looks quite different because this name is volatile, and I can also imagine difficult to predict as far as trends go.
You know, in some ways there are some similarities. We have a downward channel starting with the yearly highs, and this one we did have another breakout, but it's just further along. It's been more developed here. But really a chart with lots of highs and lows here, a lot of volatility. You know, look at this area right here. You can see that this was a range that price was in. That's where the volume profile point of control was as well. The thick red line on the right side of our screen of our volume profile study, that's the area of heaviest trading, coming in near 1472. So that was a key bottom that formed. Then up and away, just rocketing to the upside here, straight into those yearly highs just above 28. Then, much like Tesla, downward channel that formed here. Once again, we had a significant area around here in 1970 or so, kind of the same thing. It was a high, then it was a brief consolidation point, then a low, then highs once again. And then it was the point just the other day where price stopped before we had a gap up and another surge to the upside here. Now we're finding ourselves at a point where we match up once again with some old highs near 2450 or so. Haven't quite cleared that point yet. That's an area to be on the lookout for, but overall, you know, we've moved above all three of our moving averages, our yellow 21-day, orange 63-day, purple 252-day exponential moving averages. The moving averages themselves are starting to slope upward. RSI moving into the overbought area, sign of strength typically, moving above that 70 midline here. So it'll be an interesting chart to watch going forward for sure here, especially because you can see we also have formed some volume nodes up at these elevated levels here that suggest conviction on the part of traders and you know, that there are some takers at these elevated levels.
Absolutely, and ending the year well off of those lows. So while it's been volatile, we did end somewhat on a bright spot for Rivian. But now, looking at our next theme today, which is cybersecurity, totally different, although we did see some of the same degree of outperformance, especially in a name like Palo Alto Networks.
Really quite a strong chart once again, up 130% or so from those lows. And it seems like such a long time ago given how much has happened in this chart here. A couple things I wanted to point out. Once again, gap down became a point of support. This was previously a resistance level, price crossed above it, then it became a supportive area here. Then we formed a more shallow sloping trend line here in blue that gave way to a very steep trend line here.
So Rivian is one of my second favorites that's in America, or not America, but I mean it's next to Tesla with XP and Nile. Rivian is number 2. So we called this down here at the bottom, and now we broke out into a new symmetrical flag with a hammer. So this thing's going to go to the upside next year and break 2436, which would be a triple top or more than that. This is Rivian. So I'd expect it to pull back to the 9, catch it off the 9, and then come back up and re-break that resistance. It definitely gapped up off the, I think this is the 300 simple moving average. We busted past the 2 and went to the 3 and landed on the 3. And now we're up here at triple top. So this thing's starting to curve back up. We might get a cup and handle out of this, and we'll take it to the 1 hour time frame and see if we're right. We got a 1, 2, 3 on the bottom. So this is a wedge, which is a bullish flag. And we broke out of it one time. We're getting ready to squeeze. So here within a day or two, we're going to come back up and double top, or whatever top this is. 2430. That's what we got to break on Rivian. Now, if it does not hold that support channel, which is the 100, am I right? Yeah, the 100 EMA, we will drop down to this moving average right here. And we bounced off this way before, and that's the 200 EMA. And we bounced off it here, we hit it here, we bounced off of it here, plus the 200. So that would be your strong place to get in this trade, and it'd be a double bottom in that channel, would be a strong buy. So let's go ahead and put 22.25 for support. and set that alert. And we're going to call this a double bottom. $22.25. We are due for a correction, so I'm not going to really hype up about breaking resistance until we have a pullback. Who's their opinion? JAG officers? Tesla we broke out today out of the trend. We had a head and shoulders right here with two left shoulders here and two right shoulders here, and we broke out of it with an ascending triangle. And then we had an inverse head and shoulders on the bottom of it. So that's an ascending triangle right there. If it pulls back, it'll pull back to support, which is this head. We're going to set an alert right there. I'm pretty much bullish on this here, more than I've been. We got a symmetrical flag on the weekly. And we broke out of that. So we're squeezing out of that too on the weekly time frame. So the resistance levels are going to be 1 tubus and a freebie for now. The first one at support level is going to be on the bottom of the channel for a 1, 2, 3. And we'll put it right above the 50 SMA on the weekly. The 50 SMA is right there, and it'll be a confirmation of that candle right there. So 223.98 or 224. We'll make it 224 for low support. Actually, that's too low almost. Yeah, I'm going to go with the pivot point inside of the flag. And that's at 243.57. We'll make it 55. 243.55. And we're going to type in pivot point in flag. with resistance to break at 286 and 274. And long to 302. Everybody's got a $300 price target on this one right here. So we'll definitely end up back at 400, I think, by next year. At the end of the year, for sure. I really like this channel.
And how that can actually drive growth,
They actually chart
profitability, and that's why there's just this huge rush of flows going into this industry. It's not really probably going to stop anytime soon, but I think the market may get a little bit restless when it comes to seeing top line and bottom line growth because of AI, and that might actually come in the second half of next year. A lot of analysts are hopeful for that, but when you're looking at some of these models that have been implemented, especially from like Meta, the large language model that they've implemented here, Llama 2, it's something that's very
AI
amongst the developing
is at a shoulder line
because it's open source, and that kind of gives the
head and shoulders
space a little bit of a leg up when it comes to trying to implement these strategies for their business, and that's going to be a very key factor here moving forward.
Yeah, Kevin, absolutely. And you did.
So we got to break this
NVIDIA,
moving average right here.
More about that, because I don't recall a time when we saw a company of this scale and this success see this massive of earnings moves, and they just continued to really harp on their advancement in AI, their push in AI, how it's benefiting their business, their data centers. I mean, walk us through that, because NVIDIA has been the stock to watch in the AI arms race.
Yeah, it was around March of this year, actually, where we actually saw the first increase when it came to the forecast for NVIDIA because of these chips that were hitting the marketplace, the H100s, and their ability to actually control price is what really has driven the stock to the upside and provided a premium, because there's nobody else in the landscape that actually has this technology, or at that time had this technology. So that's what really drove the growth. It's not only just the top line, bottom line numbers that they've been able to report in the near term, but also the forecast moving forward. Now, a headwind for NVIDIA for next year, especially in the first half and the next earnings announcement, is going to be their guidance moving forward. The biggest headwind that we have seen is their ability to sell these chips to China and not be blocked by the United States government. Now, the United States government has been putting in some of these restrictions in place in order to try to stop China from utilizing it within their military. But I think that's going to be an issue for them moving forward, and they've already released several different products in order to try to get around that. But if they're not going to be able to really freely sell these high-powered chips to China, that could actually impact them on the top line by around $5 billion by next year, just based on their forecast right now.
Yeah, I think we're all excited for the kind of move forward that some of this AI will bring in terms of efficiency. We've already, I think, all been kind of shocked at some of the things that even some of these chatbots that are already out there, like ChatGPT, can already do. Still a long ways to go in refining those, but impressive strides. I think the proof of concept is out there for many that needed to see it, and that maybe describes why 2023 has been the year of AI. But you mentioned NVIDIA's ability to kind of be in the right place at the right time, having the hardware to meet that demand. As the year rolled on, though, other players took notice. As we go ahead to 2024, what are some other names in this space outside the obvious Microsoft and AMDs and NVIDIAs of the world that we should be focused on in markets when it comes to AI?
God,
I would say the big surprise next year could actually potentially be Intel, and there's a couple of reasons.
Intel.
First, they're the only big major company that is out there that actually has foundries here in the United States.
This thing can really fly. I've already said that.
A little bit of a premium because they can shelter themselves a little bit from any type of geopolitical tensions. Now, they still will have an impact because they do have overseas foundries, but their ability to actually produce domestically, especially in the future with the CHIPS Act and getting into these high
I did a video on Intel.
That could actually be a leg up. And then they're not only working on the GPU strategy or these server-side products, but they're also working on CPUs for personal laptops that could be able to kind of take some
We're
of
looking
the,
at around
the artificial
56
intelligence,
bucks.
some of that technology, and really try to decentralize it. And that's
Support's
going
gonna
to
be off the 200
as well, where
on
we
the
may not
yearly.
have to rely so much on these big GPU clusters. We might be able to do some of these
Or the
AI
weekly.
tasks on our own personal laptops, and they're going to be probably on the forefront of being able to break that market next year.
Yeah, and Kevin, I think really great breakdown on all of the various aspects and components moving AI. We could talk about this all day long because I do find it so
All
fascinating.
day
But there have been
long.
very much the clear winners, and then it's sort of like everybody else. But in terms of ending this year, NVIDIA has definitely been one of them. But we will leave it there. Appreciate the breakdown, as always, Kevin Green, senior markets correspondent for the network. Now, coming up next, it's time to recap how pop culture has influenced the overall economy this year. And yes, we will be talking about Miss Taylor Swift. Renita Young will have more on that breakdown for us
God,
coming
no.
up next.
Spy broke out to double top. Anybody catch that? I would have took a
young lady
put.
who was mid-30s, a couple of kids, recently went through a divorce. So she had a lot of questions when she came in. I watched my mother go through being a single mom. At the end of the day.
Okay, we don't want to listen to your sad story. I mean, you're so obvious. Like this right here. It's all about chart patterns. I know some people don't see what I see, but this is a headed snake. Touch down here, day low, bounce up, create a wedge. You concentrate on the bodies of the candles. So you draw out this wedge. Take it from right there and extend it on down. And then you take it from right here and extend this over, and you got a head and shoulders right here. Then take that body of that candle and run it to the bodies of them, and you got the left shoulder, right. And you got the 1, 2, 3. One bis, two bis, 3B. Boom. So it breaks out of the wedge, and as I've said it over and over again, do not chase it. Let it pull back. They always pull back. Always. So never chase a breakout. Let it pull back, and then take the trade, and you can get it a lot cheaper. I used to take them on the breakout and then have to buy the dip, but I'm not doing that anymore. If you haven't noticed, my cost averaging down is almost minimal because I'm waiting for the pullback after the breakout. So we pull back to a double bottom down here after the snake. And it breaks out, pulls back, double bottom. Boom. So then you get it to trade and you take it and you run it to the 200 or wherever resistance is. And then it pulls back one more time. So you've already established support, 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 boom. Now you're creating another flag, a bull flag. So come back and hit the 200 on the 1, 2, 3. Set your alert right above it. It could go ahead and bounce here, but we broke the higher low and we went down stage, so I think we could pull back one more time maybe. But I ain't gonna chase it here. Nice profit on technical positions. Let's see what he's got here. Ah. Is this a daily? Yep, this is daily candles. So he didn't see the triple. Yeah, I did. He sure did. Aurora call, raise the hedges. Resistance zone. Well, he's above the resistance. So we got a 1, 2, 3. Watch SPY right here. If this thing takes off from here, or we get the put, the 476 put and the 477 call. 476 put and the 477 call. If we break out here, the double top, we'll take the trade to the call side. If we hit the top and stop, we'll buy a put. So this is SPY December 28. The 477 call or the 476 put. Get 10 of them. Nice profits, technical, Apple resets, blah, blah. A lot of watching the tape. I will go get my coffee. Okay, now it's the time. now I'm going to look at the put. This is the 476 at 70 cents. And it did not. This is kind of risky. December 28th. We're at 70 cents. Calls, idiot. What did I type that in there? 476. I got 700 in this trade. I waited till the final minute.
Percent at least on the short-term interest rate standpoint. But just to give you some context of where we were in the last couple of years versus, let's say, going back to 2020 and 2021, in both of those years combined, there were 1,500 IPOs, and many of those were reverse mergers via SPAC. And in fact, 2021 was the biggest one in the last 6 years at over 1,000 IPOs. I think, you know, when money is very cheap and there's a lot of capital flowing through the economy, IPOs are certainly robust. Now, this last year, there were a few large ones to mention, and particularly ARM Technologies is quite a large company. This is a company that effectively sells licensing and generates royalty fees from its technology, which is essentially embedded in about 70% of total mobile and, of course, smartphones and tablet-based devices globally. They essentially have technologies which are integrated in so many different applications across industries like automotive, mobile, if you will, industrial as well. And this was an interesting one. In fact, if you look at the last at the IPO listed price, it's actually trading above that, considering this is a high-flying name that actually has a robust business and global outreach. Now, there were some concerns about it because of its 25% exposure to China. But nonetheless, I think if you look at competitors like Qualcomm and Intel, a lot of these names are picking up, especially as we move into the end of this year.
Yeah, George, ARM, no doubt, somewhat headlining this group. Its exposure to AI, its sort of tangential exposure or relationship with NVIDIA through the years has certainly brought it into focus even before it was public. But George, we got ones on these lists that I think are all fun in their own unique way. You got the long-standing company in Birkenstock. You got Cava, which is sort of a Mediterranean Chipotle kind of new type of business. And then you got Instacart, which is this new take on grocery delivery. So
what's this
about,
Instacart?
Any of these three that you want, or a little bit about all three of them?
Well, I mean, I'll start out with Birkenstocks. I mean, I think this is typical. I mean, this has been an iconic brand both in apparel and footwear for many years, if not decades. And I think they're capitalizing on the market right now, which, if you look at it from a consumer standpoint, discretionary standpoint, things are looking quite favorable across the board. I think Cava is an interesting one because it's really a sort of a fresh, fast casual business. That's a Chipotle competitor.
Goalpost right here.
This company, in fact, if you look at 2016, they only had 22 stores. They've actually increased
big sell-off
by
right there.
12-fold as of their last earnings
Yeah,
report.
they're cutting it out.
As it's starting to pick up, and I think it's becoming more attractive because of the fact that we're seeing some trends in discretionary areas of the market. And I think Instacart, out of the three it mentioned that I talked about just a moment ago, this one is the one that's been underperforming. I think it really has to do with valuation, plus the fact that they're investing quite a bit to expand their business. And I think this is an interesting one because what we're seeing is the buildup of an oligopoly, really, in grocery delivery. There's DoorDash, which is moving in that space. Uber is also moving into that space. And Instacart, which is now, of course, publicly traded alongside the other two, which is utilizing the capital to expand its offerings in delivery. And I think this was a little bit challenged from a price standpoint because they lost $13 a share last year. But nonetheless, I think this is an interesting opportunity for those that are looking for maturation of market share in the delivery space, which is not going away. In fact, I think it's trending quite aggressively higher as you're seeing, Walmart's and the Costco's and the Kroger's of the world try to start to compete with the likes of these mobile apps like Instacart, of course, Uber, which is one of those hidden ones that is encroaching on the other market share as well.
Yeah, George, that was one of Uber's real takeaways of their last earnings call, was that they're offering various forms of delivery, and the street loved that. So you'd have to think that'd also be good news for a name like Instacart, of course. But curious now, as we walk away from 2023, heading into this new year, what does the IPO market look like? Can we see some signs of life continue now in terms of all things IPOs?
Investors.
Yeah, I think we'll probably see some normalized activity. I think if you do consider looking back, I think 2018, there were effectively just about 200 IPOs. So the trend obviously has been down since 2020, 2021. I think if interest rates start to fall, we'll probably see quite a few IPOs in the back half of next year. But overall trends are declining, and I think that's to be expected considering the pretty monumental, if you ask me, interest rate hikes that we've seen in the past couple of years. So it's going to take some time for the IPO market to hit some of those 200 to 400, company-based trends that we've actually seen in the past. But I think right now it comes down to not quantity but quality, because interest rates are still relatively high, and I think that unless companies feel qualified to list their shares, investors are going to be a little bit more choosy, I think, just because of what happened in 2020 and 2021. A lot of the reverse mergers via SPACs ended up going under. So I think there's a little bit more careful selection going forward, at least in the next year or two, especially if we start to see some sluggishness in the overall economy.
So perhaps some patience will be needed in terms of an overall IPO rebound. But SPAC, gosh, that word takes me back to about 2 years ago at this point. But really great breakdown on what has been an overall exciting space to watch into the back half of this year. We will leave it there. George Tillis, Senior Markets Correspondent for the network. Now that does it for our Next Gen Year in Review of 2023. From Alex and myself, we appreciate you watching every single day. Have a wonderful holiday, and we will see you in 2024.
So I still got my put here at 70 cents. We bumped up and down 70, 75, 76. There we go. Now I'm up $100. So you get out of the trade when you're up 10 cents. And we pulled back to the pivot point. I think we can drop down to the third channel here. Maybe even to the 200. So I'm going to hold this just a little bit longer. I want to watch the tape and see how the tape reacts to this knife. And right now is the time to get out of the trade if I wanted to. Anybody take this put with me? I know it's kind of scary. I feel sorry for everybody that's got the flu and the cold. Apple alerted, rallying. Good job, Rob.
Available anytime, anywhere,
on any device for free.
Schwab Network, empowering every investor and trader
Every market day.
I like this company.
All the need-to-know info from every trading day. I'm Renee.
I've not heard one bit of politics at all.
The biggest headlines that move the market, all condensed into a few minutes. Download the Schwab Network app and join in on the latest market trends. Available anytime, anywhere.
CNBC,
any device,
that's all about
for free.
politics.
Recap your trading day with the wrap right here on schwabnetwork.com.
Hey, May, did you hear that?
It's time to look forward.
They think that Intel, which has already had a great bounce, could be the next, not NVIDIA, but it's definitely has a lot of good opportunities in 2024. And I've never said that about Intel.
Only on the Schwab Network.
I've been pumping that thing for a couple months.
every morning, every trade, always live. Expert earnings analysis, in-depth technical insights.
We're at 84 cents now on the SPY.
Available anytime, anywhere.
85.
Any device.
So let's look for the exit.
Welcome to Morning Trade Live on the Schwab Network. I'm Oliver Rennick.
Right now, we could jump down to the 200 and have a nice little inverse head and shoulders, or we get out now at 86 cents.
Schwab Network. Available anytime, anywhere, on any device.
Take your profit. 88. Oh gosh, no, take it here. 96. Bingo. Damn, look at that. 116. Woo! Jim, you took a drastic chance here. Come on. Oh, 127? Now, get out. I mean, shit. I mean, I've got this down to a T. 70 cents to 127. I love trading the SPY. Fuck yeah. I mean, heck yeah. Jim, watch your potty mouth. Anybody take that with Bobo? You can tip me if you want. Give me a grade on that, baby. I don't think you could, an A is good enough. Do 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 do. Dun 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 dun. Jim, how did you do that? Dang, look at it go. Oh, I bet you the SPX really flew. Now I'm trading the SPY because I know there's a few people in here that are having some issues still. And I'm telling you, I've got 20 years experience and I've never seen a stock so easy to trade. Ever. Besides Tesla. And you still got to work on that one. I'll give you almost a 95% winning rate in this trade alone. Now you want to look at calls. We're going to get set up. We got a doji, a long-legged doji. So you look at the call, the 476. It's got 105 contracts at it, and we're in at 95 cents. Damn. Dropped on me there. Okay. This one I might have to add to it. Yeah, we're right on the 50, so this should hold. Let's add to the position. I mean, that's a pivot point right there. That'll be a double bottom from that flag right there. So we're going to add 85 cents. So we got 85 and 95, and our average is 90 cents. This is called a J hook. And I tried to take it off the double bottom here. For people that don't know me, I'm one of the best knife catchers out there. Now we're bearish, we're under the 9. So, when you're bearish and you're up and you're hitting resistance, it could be a good idea to get out of the trade and call it safe. But I'm not out of it yet. I like this hammer at the bottom. I mean, it still don't look too hot, but if we break the 9, it'll be an easy jump up here to the 200. That's where I want to exit the trade. And with TTM is starting to squeeze, we've got divergence in price action, in volume. That keeps me in the trade. Now we break the 9, you watch a big old candle come up here. Technical traders are watching the 9 and the 8. I like the 9. So I like watching the 1 minute time frame because I can see the candles and I can get a real good early indication if we're bullish or not. We got a tweezer bottom on the 5 minute. That's another indicator. Tweezer bottom on the 5 minute. Got a long leg doji, shooting star. That's called a shooting star. Morning star, shooting star. Shooting stars are indicators of a potential price top, so it's a morning star. Oh, she just knifed. This ain't good. Go in there and have another cup of coffee. So we're retesting. Not looking too good right now. Down $100. Expansion pattern. One, two, one, and not a 2 yet. And I got an RSI crossover. I think that's what that is. Yeah, RSI crossover alert. Exit idea, and it's still going to be the VWAP, or 475.60 maybe. Back in the green. Now, I talked about Airbnb yesterday. Dun, 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 dun. Breakout, baby. Breakout, baby. Come to Papa. Come see your Papa.
loving the fact that we are that close. So I think traders are kind of eyeballing that at this point, looking at that 4,700 as the next potential level for what we've received since the flush out in late October. It's been a fantastic move.
Yeah, and you know, Barron's had a great write-up. They had 6 strategists and their targets for 2024. And a lot of them were around 4,800, 4,850, so 4,900, but there was above 5,000. So looking forward to the year 2024 and what that could bring.
Idiots.
In the meantime, MicroStrategy has had some big moves. We think about Bitcoin, which has done well. MicroStrategy, even better.
I love these people.
As you close out 2023, show us the chart and your thoughts.
Sure. What I have for you are a daily chart and then a longer term.
We got a double bottom Randy on SPX.
The reason is that the move we've seen has been so tremendous that we have to look back at the weeklies to understand the strength and the potential opportunity going forward. From the daily chart, I think it's notable. We're up 313% on a year-to-date basis.
Thought I saw 215. I'm going, what?
Since December 30 of last year, so less than 52 weeks, but that's the 52-week low. So the strength here has been tremendous, and a lot of
buy-sell indicator says ready
for Bitcoin. The company here, MicroStrategy, does hold Bitcoin. They accept Bitcoin, and so if you put these charts side by side, you'll see quite a bit of similarities between them. Now, what's great about this chart in the short run is you've had a gap move through a major area of former resistance, and that came in at that white dashed line you see there, right around 535 a share. And since then, that's been
this is Mr.
held up and have not given anything back. And what that's allowed us to do is bring that 20-day moving average up. So a lot of short-term traders are looking at this and saying, well, we've got short-term opportunities based against the 20-day moving average. Those traders in the short run kind of like what we see as long as the 20-day maintains. Now, if we shift over to the weekly chart on this, what you're going to see is where we have previously been. And the thing that's interesting here is that the last level of resistance now takes us all the way up to that potential $800 ledge. Now, that's a substantial move, and no trader is going to tell you that that is on the table or that has to happen. That's not the case. But
there we go, baby.
Give us an opportunity nonetheless to consider
got all the bears out of it.
More upside, given that we've had 3 strong weeks of now holding this breakout level, as you can see, Nicole. So this little period here, the last 3 weeks, looks very notable to the bullish longer run trader and may provide opportunity for even someone who's not just short term, but perhaps looking at this in a longer term window of time.
Yeah. All right. Thank you for that. An exciting group, and that'll be an exciting group for 2024. This is Gary Gensler and all those ETFs, and a lot of talk about those Bitcoin ways to trade Bitcoin, whether you have it in a futures product or Bitcoin itself, and so on. How about Confluent, which gave back most of the 2023 gains?
Told you about showing your boobies.
Yeah, it really did. They had a pretty poorly digested Q3 report back here in the very beginning of November 1. And the chart broke down significantly, and you can see this when we pull up the daily. What's really interesting, though, is that traders who thought this might be their buying opportunity stepped in, did very well. We're 68%, off of that new 52-week low we made at 1469 on November 2. So this is an interesting move because we have rallied so well, and the bullish traders feeling good about things.
Beautiful. Look at that, 104.
2 months here, really. But we are in the interesting area of, I'm going to use a pun here, but confluence, because we've got a lot of things coming together at this price. We have a downtrend line. We have former support, now resistance. So you have a lot happening at this
I love the SPY.
Around 26 or so.
Now,
and it gives
if anybody's new to this, get out.
Better risk versus reward opportunity in the short term. But if this does manage to trade above that downtrend line
Get out.
we're on in here, dating back to the highs at 41 in the summer, well, then now you've got the start of something bigger. And for a lot of traders, they're still going to want to see a recapture of the 200-day moving average. That's up there around 28 bucks. So there's still some work to go on the long side or the bullish side here. However, if we shift over to the long-term chart, I think you'll see what's pretty intriguing on this one. to a lot of traders when we saw it make this 52-week low, and that is that we've been below $16 or to $16 in the past, and we have tested this level a number of times, and that provided an area for longer run traders who may have been prepared, Nicole, to say, hey, this is an excellent opportunity. And as you can see, we got down to that same level, and we have seen buying pressure there. So that's a positive on a longer term window. Now, we can't say, of course, that what we've had in the short run and the 68% off the lows is able to continue, certainly possible, but this might give at least longer run traders a belief that they know pretty well where long run support maintains and provides them an opportunity going forward.
All right, Kevin Horner, it's great to chat with you in 2023. We'll do the same in 2024, where we will see if we see some new records as we go into the new year. Charles Schwab's Kevin Horner is on with us all the time on Technical Tuesday. Coming up, Wedbush's Dan Ives will stop by and recap 2023 for Tesla and for Apple. Big year, big news, and what's ahead? Could Apple really be the very first company with a $4 trillion market cap? 3 trillion is cool, but how about 4 trillion? All right, let's ask Dan Ives if that's coming in 2024. We'll be right back.
Schwab Bank Investor Checking, the checking account built for investors. Named highest in client satisfaction by J.D. Power for 5 years in a row. With Investor Checking, you get the award-winning features of our checking account, plus cash management solutions, all designed for...
We hit the 51. The 51 EMA had an exit idea. Now understand this was a blowhorn from the bottom of a snake. We had real big, we had 3 black crows right here with 2 extensions on that crow. We got a rolling pin with a big hammer right here. You got to look at them candles. That candle's right there's a hammer, and longer leg on the bottom of it. Came back, double bottom off the base of these 2 candles, boom to the 51, exit idea. From now on, this is my go-to station. I'm gonna go get me some coffee. If I knew this was like this all the time, I'd been watching this. They're not depressing, one.
I'm Nicole Petalese at the New York Stock Exchange. We're watching.
They're not talking politics, 2. They're posting charts on every call they make, 3.
Lots to discuss here. So both of these stocks on the move. Dan Ives has been a fan of these names, Managing Director, Equity Research, Wedbush Securities. Thank you so much for being with us. So what did you think of Apple's year that was? And how is it? I mean, 3 trillion's cool. You're looking at 4 trillion maybe. Tell us a little bit about the Apple story and where you think it's headed. So many people hold this name.
Yeah, look, Nicole, I think it was a year of resilience. I mean, if you think about the China issues in terms of the shop.
My issue with these idiots about Apple is that they're so much into China. They have expanded out. I think they moved to India. So they're moving their manufacturing, some of it out of China, and not being so reliant on China. But that's the biggest hesitation when it comes to trading in their market, because you never know what's going to happen with Biden in office. We could have a real nice world war. We already have one, but if it goes to China, we're in deep shit with these companies. There goes a breakout. Fudge. 125. Right to the top of the expansion pattern. Wubbis, Tubi, and a freebie. Did you see that, Randy? Ocean, did you see the expansion pattern? How many times have I showed you this pattern, and how many times have we hit the top of that expansion? I mean, I should have held that. That would have been one heck of a trade. About $700 in how many minutes? Didn't take long. 3, 6, 9, 10, 12 minutes. Three black crows. Three black crows. And then you had a double bottom. Double bottom, the body of that candle and the body of that one. Not the body of this, but the bodies here, that body and that body. That's a tweezer bottom. Then you had the one Tibist and a freebie. And you had a one and a Tubi. And you had three black crows, breakout, pull back, boom. They always pull back. So you see the three black crows and you say, Jim, three black crows. We just broke out. So wait to see if it pulls back to a double bottom off that third crow. And then take the trade. Don't take it up here. Wait for the double bottom. Let it come back and retest that crow. This blowhorn pattern's a pretty successful chart. There's some big blocks coming in to this here CHRS. Now they've had FDA approval today, and I've been watching this. I could have traded it for 20 cents here, but trading pennies is a lot more difficult than trading a SPY by 10, 20-fold, 100-fold. But this had good news. I'm going to go get in there and make me some more coffee here and relax a little bit. And I wanted to go through some scans today, but Google's set up for a good support level right here. And then Airbnb I talked about yesterday. I wanted to look at this. I said, wait, don't get in it yet. And we pulled back. So you don't, when I alert a trade, I'm always looking for a pullback. That means we're getting close to support. And what we have here is another expansion pattern. Inside that pattern's a pivot point at 135. So this is what we're waiting for. And we're going to set, I already got my alert set for 135.34. Now when this thing gets triggered, I got to re-look at everything, because what we had is an extension into an expansion. And that pivot point is the middle of this expansion pattern. Right around 135.19. And your low support will be the bottom of that channel for a double bottom. So I got both my alerts set. And I'll blow it off. I won't look at it anymore. Boeing has had a hellacious run. I called Boeing down at 110, 120. I don't have Boeing on here. You gotta be kidding me. Unpacking for the latest trading trends, watching Boeing, see volume following NVC mention. If you invested, blah, blah, blah. Boeing shorts, whatever. Analyzing the short interest. Boeing short percent float is 11.76. The company recently reported that the 10 million shares sold short, which is 1.65 the regular share of available trading. Somebody had a big short in it. And I don't blame them. when I called this trade out, I said, man, last September, I said, we got a double bottom here, baby. We got 3 black crows. It looked very attractive when we had this sell-off. And we broke out, found resistance at the previous low right here, and it pulled back to a double bottom. And I screamed. I said, this thing gonna fly. And I got in this trade and I held it. And bam, we're back to a double top. So this thing got pulled back. And I love this area right in here. 239.81. And I'm going to actually bring it up to the top of this wick. And bring it to the bottom of that candle right there. To the right. Actually bring it up to the top of the candle. Because we're down so much. So the new support for Boeing will be 244.85. And then we'll set another one right here on the bodies of them candles. RITM. RITM still looking good. Where's my TV at? Oh, hell, I'm missing something here. Time to get educated on the babes.
Swift is helping it's just crazy.
It is.
It's like nothing we ever heard of. It's like nothing
I wonder
we
if they're
ever heard of.
twins.
Even the NFL, to your point, jerseys for Travis Kelce. The Jets game that you're referring to. I'm from New York. I can tell you all the Jets fans were pretty upset because those tickets went up. So it's an exciting time, and what's really the best part of it is it's nice to see folks feeling that they have the power to purchase the tickets for the concerts, the tickets for the games, and let's see what that means for 2024. In the meantime, we'll turn this discussion completely around from something super fun to something pretty serious, and that's about Pfizer and Moderna, stocks that people hold in their portfolios. And after COVID-19 and all those vaccines, different picture. Put some perspective in that, please.
No kidding, and I think that the fallout due to the declining vaccine rates, have weighed on shares all year long, and they have been both fairly disappointing in performance-wise this year, because right now it seems like we need another catalyst to excite us in terms of investing in these names, frankly, given their...
I used to sell vacuum cleaners. It was the first job I had. Well, not the first, but it was the first one that I had. And we went door to door. We went to Pittsburgh, Kansas, and I knocked on the door, and 2 girls answered the door. They were beautiful. They were 2 twins from Germany. They said, yes, we'd like to see your demonstration on your vacuum cleaner. So I gave them the pillow demonstration, where you take a pillow and wrap it in, take one of their pillows and wrap it in a bag, and then take the hose from the Electrolux and suck all their dead skin out of their pillow. And the girls looked at me and said, oh my God, I love you. They couldn't believe it. They sold that vacuum cleaner on that test run.
The study is too small to get that excited about in terms of a boost for shares. Pfizer, on the other hand, I do want to point out, is almost 5 times the size of Moderna as far as its market cap. So it's a much larger, much more diversified company, but that hasn't exactly mattered to its performance this year, which has actually been somewhat amazing. They also have continued to see disappointment and have guided for further disappointment now in fiscal 2024 as they do continue to see weakened growth. They did already say that Seagen, their
No.
acquisition, could add around $3 billion
I should
to
have.
their oncology offerings, but overall, their midpoint of sales next year, we are expecting just modest 4% year-over-year growth.
I should have.
But at least that's something. So at least we are expecting.
I didn't think
further
about it.
reduced
I wasn't a
guidance,
pervert back
some
then.
degree of growth. So I think moderating and sort of seeing
I was a
things
sex idol.
normalize here in a more normalized world post-COVID was always going to be a factor that weighed on these shares. And now we've assessed that.
Now I
we're
probably
in
would,
a
though.
more hopefully normalized world where these vaccines aren't as necessary.
This
So
Moderna
these
is really,
companies have to get
Pfizer's
busy,
really
and
took a
trials,
big
I
hit.
think, are at least something to get investors excited about both Moderna and Pfizer again.
I mean, this is
Thank you.
ridiculous.
Important stories and themes of 2023, and we'll have a good look ahead to 2024. Jenny Horn, thanks.
Oh, yeah. This is beautiful.
Despite multiple macro
Pay
headwinds,
attention to this.
was so resilient, so
I'm
strong
going to
in
educate you.
2023, driving economic growth, setting retailers up for a holiday shopping season. Was it?
We're at a 20-year pivot point on Pfizer. Now, I do believe this is oversold. This thing had an uphill climb for Ubis, Tubi, Freebie, Forbes, 5, 6, 7, 8, 9, 10 years. And it only took 1 year to bring this sucker down. That's irrational exuberance. This stock will run. We've got so many touches on the 10-year time frame right here. I do believe this thing will be a good investment. Moderna, I don't know much about, but I do know Pfizer. Now, Moderna had a pivot point on the so Moderna ain't been around that long. 1, 2, 3, 4, 5 years. The pivot point on Moderna is right here. That's your channel of pivot point channel. So I'm saying if we break 104, we could probably take this back up at least midway. Which would be a good pivot point inside of that channel. That price. Okay, what happened here? It didn't go down. God, darn it. Ah. There we go. Yeah, I think Moderna, if we break 104.53, we're going to 118. Or maybe just a little bit lower. Around 116, 115.50. But I like the 118.
money has been groceries, and that has actually come down. So that's easing the consumer a little bit to spend elsewhere, and those discounts are definitely helping. In fact, the discounts are the highest level we've seen since pre-pandemic. Almost half of all the merchandise at retailers is on sale, 48%, which is unseen. We haven't, even pre-pandemic, it was at 42%. So retailers have become extremely promotional going into 2024, and that's also conditioning the consumer to only open up their wallets if they feel that they're getting a good promotion into the next year.
Right. We saw Macy's with an offer. Nothing was sealed on that. You know, it's not done, obviously. But do you expect to see more collaborations or mergers and acquisitions or things like that so these retailers can survive?
Collaborations for sure. Those are crucial for, especially for the department stores. They've been out of favor for some time, but we have noticed in the past that when the department stores do particular collaborations with different brands that are more popular on social media, they tend to get a boost on their sales. Even Target in the past has been popular for doing so. We see a spike in their revenue. So it will be crucial for them, even necessary in 2024, to stay afloat, as a lot of them have been out of favor this year.
So some inside the other ones, right?
Yes.
What would be an example of that?
An example of that could be, for example, Skims have become very popular with the Kardashians. If they were to do a pop-up, that could actually boost sales, especially if they have like a promotion going on. If you come into the store that day, yes, absolutely.
All right, it's amazing. So I guess people are still shopped till they drop.
Yes.
And forget it, you pay later. It's free now. Sharon Martis of LSEG, thank you so much.
Why is it not doing that?
2023, and look, it seems like we're going to see a lot more in 2024, just like this. For example, she said surprises for Amazon on the upside. All right, coming up, our panel is ready to take
Why ain't it doing it?
Sector. It's been volatile. A lot of stories move this group and the commodities. What happens for oil and gasoline? Coming up.
It's on there. Get it. SPY pulled back to support. I'll be right back.
Is at noon on the Schwab Network.
Cut the cord on the way you get market news. It's Market on Close.
You got an inverse head and shoulders
Oliver Rennick for the biggest earnings
on SPY.
Insights from the smartest minds on Wall Street. Monday through Friday, 3 p.m. Eastern. Available anytime, anywhere, on any device for free. Only on the Schwab Network.
So it broke out, pulled back, created a shoulder. We're going to pull back. If we pull back one more time,
No politics, no
I'll
noise.
take the
From
trade.
Bell to Bell and beyond. Available anytime, anywhere, on any device for free. Schwab Network.
it says it's ready.
Missed out on today's market headlines? Get caught up and catch the wrap at schwabnetwork.com. Available anytime, anywhere, on any device for free.
Then we wait for it to pull back. And I'm going to take this trade. $476 strike. Okay, you ready? Right about now. had the pullback. Okay, 92 cents. One more. There we go, right now. Just a little risky here. In at 92. I want to see if we can get it, keep the higher low here. This is for December 28. You remember me calling a double bottom on Pfizer.
Obviously, the pipelines are good, but I think when you look at the fact Exxon is the fourth largest producer of oil in the world, just behind Saudi Arabia. So I think these are dominant players, and I think they're going to do very well as integrated oils throughout the year. So we like both those names.
Yeah, and Stuart, a quick thought on Eaton. That's a name you like, right, for 2024?
So Eaton's an industrial company, but it does have overlap into the energy markets. But I would say that if you're thinking about where to position yourself in energy, in a view that oil prices probably do well in 24 relative to 23, I would also be on the side of the integrated oils and the E&P. So take Exxon and Chevron, like Dryden mentioned, and then on the E&P side, I would say EOG Resources. Certainly is a standout, Diamondback Energy. I think FANG is an attractive buyout candidate. It's in the Permian Basin as a pure play. That I think is going to be the source of a lot of incremental M&A in coming years. It was obviously a target in late 23.
Yeah. Dryden Pence of Pence Capital Management and Stuart Glickman of CFRA. Always great to see you all year long, and I'll see you into 2024. Looking forward to those discussions. Thank you for joining us here on the watch list. I'm Nicole Petalides. Always appreciate that we can be together. I look forward to more in 2024 and wishing you and your families and loved ones all
There we go, finally. Oh yeah. So I got this at 92 and we're at 99. So these are 3 white soldiers. That's an indicator that we could have a good run. It's also an indicator to get out of the trade. We're going to take it to this moving average. That's the VWAP. Or to the bottom of the channel. Boom, there you go. Now you're up $100 on this trade and you only got 920 in it. So you take profit if you're new. But I'm going to try to get it to the VWAP. Why? This is a head and shoulders. So you want to draw your trend line across the head and shoulders. That would be your exit idea. It takes you right to the VWAP. This is the head, this is the left shoulder, and this is the right. Or get out now. I mean, any kind of hesitation, this is an exit idea. 3 white soldiers. Three white soldiers is a continuation pattern. They like to consolidate, and a lot of times they'll pull back to the bottom of that first soldier. But for a rookie, and you see him, you want to get out of that trade. Three white soldier candlestick pattern is a bullish candlestick pattern that is used to predict the reversal of a current downtrend in a pricing chart. The pattern consists of 3 white soldiers. So we go back to the chart, and I guarantee it, we pulled back. It happens every time. So when you see 3 white soldiers, you're at 104, and you're in at 92, that's a $120 trade, and that's pretty good money in a matter of 3 minutes. We had 3 white soldiers right here. We had a continuation pattern, but as you get closer into the day, the strategy changes. You have new traders coming in at 2 o'clock or 3 o'clock making decisions for tomorrow. You have a totally different schedule as you do when you have the first hour of the day, to where you have the lunch hour when the fat cats come back to where you have now. So you want to get out of that trade while you're in the heat. Before anybody else thinks about it. Now this thing is a continuation pattern, and you will see this maybe go to the upside and hit that VWAP as called. Or you could come up here to a double top and hit that pivot point inside of that channel that we saw earlier. Same thing that I showed you on that chart. is a continuation pattern. 3 white soldiers, she'll go sideways or she'll pull back and hit that first one, and then you stay bullish. Boom. Now you hit the VWAP. So that's an exit idea. I'm going to take a couple of aspirin. I'll get that coffee made. That's the wrong time frame. Come on. Oh my God. No.
VIX perhaps not the best measure of it. VIX creep here in the last few days. Something to keep in mind as stocks have continued firming. I'm
This is
also
a much better channel.
watching very closely Bitcoin to see how it finishes the year, because BTC, after its big run over the last 9 months in the year, it's kind of fizzled out actually, since the Fed lived up to what many of the coiners were early in predicting, which is that they would cut rates. Of course, that's kind of what coiners always predict too, though, so there is that. Watching BTC around the ETFs, of course, as well. It's got its own separate story before it that should make for quite a bit of fun going into 2024. So let's talk big picture for the year with Jim Bianco, the president at Bianco Research. Jim, I feel like we've had like 5 years in one, at least just measuring by the yield curve, right? We went through like 3 different cycles.
Oh, absolutely, yeah. The volatility of the bond market is that way, you know, that you blink and you miss a decent year here, but don't worry, there'll be another year next week as well that you can either capture.
So where should we like weight our discussion then? Because if we go back in the first quarter, you know, the expectations that we were going to head off an economic cliff, you know, some would argue that's why we're now getting rate cuts priced in, but that never really happened, and we're pricing them in anyway. So which part of the year is really the most determining factor for what we talk about next year?
Yeah, you're right. There is a bit of deja vu when it comes to the economic forecast and the bond, at least the bond market outlook. Where have we seen this before about a slowdown and lots of rate cuts? A year ago, and everybody put out their 2023 forecast. It was actually far more pessimistic than what we're seeing right now, because there they were calling for a recession, but now they've kind of upgraded it to that mythical soft landing. But I do think that 2024 is really going to come down to the case of whether or not the economy does slow. Now, I say that recognizing it's a $30 trillion economy. You could always give me an antidote here, antidote there, of somewhere where there's problems. But if you look at the top line data, it doesn't look like there's really any major issue with the economy right now. Initial claims are very low. The unemployment rate has been under 4% now for 22 months, the longest in 53 years. The GDP trackers are saying that the fourth quarter might be at 2.5%, if not higher. Remembering the third quarter was 5%, and that was a smoking quarter. To come down to average the quarter after that means that we're in very good shape. And the question then becomes, does that lead to a stronger economy than we think in 24 and potentially a reacceleration of inflation? Now, I'm talking about 3.5% type of acceleration of inflation, in which case all of this hope of lower interest rates in 24 might be dead.
I guess it depends on when that growth kicks in. The Fed right now, rather I should say Atlanta Fed, is pushing up their expectations to the high 2s. We had that big nice juicy print for Q3 GDP. When do you suspect some of these forces might start to support inflation a little bit more strongly?
I think they are right now because, you know, if you look at the inflation data, as we've seen, it bottomed in June. I know on a year-over-year basis, we hit 3.0% in June. For November, we're at 3.1%, and that should probably uptick for the December number, which will get reported in middle of January. So it's looking like the inflation rate might be bottoming. We're at around 4% on core inflation. That should come down into the 3s. But I'm not so sure that we're going to make that next step into the 2s unless we get a hard landing, an actual slowdown in the economy that creates unemployment, creates earnings losses, and creates misery. But short of that, even with the soft landing, I think that the story is going to remain that inflation is going to stay sticky. And I know that that is a call that I've had now. I've had this call for a couple of years, but I also know it's a call that has not been working for the last 6 months or so. But as I look at the data, I don't see a reason to say, no, something has changed in the last 2 months to suggest that the economy is really in a different trajectory than where it was in the early part of the fall.
I like the transparency on the views. I will add by saying that, again, this year was like so many mini cycles that while the last 3-4 months has not gone the way of that sticky inflation, hey, we are ending the year with the 10-year just slightly above where it began because of all the upside in the first half. So it really kind of depends on one's perspective here. Jim, what do you think would constitute surprise enough on the inflation front at this point for the Fed to rethink some of their more relaxed commentary as of late?
I think it would probably take a couple of months for the Fed to really,
So here, we called the double bottom higher low. This thing went to 110. The 200 SMA on the 1 minute time frame is an exit idea.
But I don't think it's going to be the way he thinks it's going to be. We're going to focus back on employment. We're going to say, man, the employment market is really strong. And wage inflation is going to be, sticky in the 4 and 3% range.
Boom,
Remember,
112.
If you're getting a 4% raise,
now look at that.
3 or 4% inflation.
In at 92, out at 104, could have had another.
And I think that's what we might
$80
more in 24 than the opposite. Look, again, I'll also point out, my call is premised on this bigger picture idea that the cycles changed in 2020 and that we are in a different cycle. So when people say, but in 1990 to 2000, I always say, stop, that was a different cycle. I think that between work from home, deglobalization, the impact of completely shutting down and restarting the globalist economy, that we're in a bit of a different cycle right now, and that different cycle is... I did
say when I called this trade out that we would get to that pivot point area on that red line, and bam. So this was a double bottom snake. I talked about this for 2.5, 3 years now, this trading strategy. This is where it started at. Snake. Let's just clean this up. It's a really good pattern to learn. So you draw in your snake. Break out. Pull back to the support line, which is on the snake. High or low. And when I took this trade, I said I wanted to keep a high or low. Boom, to double top exit idea. Mwah. Perfect. Snake, breakout, pull back, high or low, boom. Double top. This is probably the 8th trade I've done, or the 7th trade I've done on the SPY today. I'm telling you, I'm going to turn $1,500 into $100,000 with just this trade alone in 2024. And it doesn't matter what kind of condition the market's in. Double bottom, what the hell? That's a double top. Oh, Jim. Did you do anything right? And this is a double bottom, high or low out of a snake. $116, baby.
My dad was a hard worker. He used to do side jobs, installing windows, charging something like a
I love this channel.
With the
You can't get CNBC to post a chart up. All they do is gossip, talk about politics, give outlandish forecasts. These guys are to the penny. They tell you exactly where they think the support is and the resistance. They're not pumping the stock at all. They're giving reason behind their ideas. I used to get so furious with CNBC. I still do. The NVIDIA thing, I can't get over that. And they're always bashing Tesla and Elon. I haven't heard one bash on this channel. I haven't heard anything about politics. And that makes me so much happier. As a trader. Because I don't get frustrated.
I'm Renita Young. Download the Schwab Network app and join in on the latest market trends right here on schwabnetwork.com.
This is called a diamond-shaped pattern right here.
Binge watch the market with the Schwab Network. Tune in 24 hours a day, 7 days a week on schwabnetwork.com and on all of your favorite streaming services. Schwab Network, available anytime, anywhere, on any device for free. Binge watch the market with the Schwab Network.
Missed out on today's market headlines? Get caught up and catch the rest at Schwab Network.
Yep. Watching the market. Do what again? Oh, really? No, I don't really like driving this car around without the plates on it. Are you okay? Okay, well, I'm sorry I can't help you right now. Okay.
You just look at numbers. Tesla's the highest PE stock that we own, really, in the sense of, you know, what are they supposed to earn? Bloomberg says $3.90 is a compilation of all their analysts for 24, and that puts that PE ratio well above 60. And when you look at a forward PE of a great company company in our fund, GK, called NVIDIA, with a forward PE of 24, and literally the hardware leader in the AI revolution that even Tesla, Elon buying chips from left and right. It seems like on a relative valuation, NVIDIA is a much better investment than Tesla. So I think Tesla's biggest issue is simply its valuation, irrelevant of Musk and all the other things that he's doing to compress the PE.
Yeah, all right. So the valuation here has some growing into to be done. The Cybertruck verdict, when do you think that'll get rendered? Next year's calendar. I mean, I would imagine a year from now we should have, we should be seeing all the trucks lined up ready to deliver.
Yeah, I mean, I think, you know, ramping this is going to be very difficult for Tesla as a new vehicle, as they've struggled with every new vehicle they've launched, and this is a new type of metal and stamping process and new technology. So I'm really excited for what's in the Cybertruck and for what that means for Tesla long term. But the addressable market for this vehicle is somewhat limited in its design. Its production, we hope for next year to do at least 50,000 vehicles, but this doesn't really move the needle for Tesla on profits and revenue when you look at selling 2 million plus, you know, Model Ys and 3s. So I think the Cybertruck is really just a cool vehicle and really meant to help sell other Teslas and really give you an idea of what's in store technology-wise for the future. But as far as for the stock, I think it's already priced in.
You almost view it as like a loss lead.
How dare you have a guitar hanging up and talk bad about my Tesla?
Okay, you know, they're
with
actually
a smile.
the opposite. They're, you know, the people buying these first Cybertrucks are making a nice $20,000 donation to Tesla. So it's not a loss leader at all. In fact, I would argue the opposite. This is where they're trying to make some margin.
Right. Okay. When we look at products,
Jimmy called 259.13.
What do you think we'll be viewing as a bigger success, Cybertruck or the Apple headset?
Always clean as Jim.
You know, we're having a bet in my office right now who's going to sell more Apple Vision Pros or Cybertrucks, and I took Apple. I think Apple's going to make more Vision Pros than Tesla's going to make Cybertrucks. But you know, now I might be wrong, so we'll see. But I think they're about the same. You know, I think we'll see about the same types of units. I think when you talk about impact from technology on the future, I think both products are incredibly cool and impactful in their unique ways. And I think they're, you know, they're two of my top. They're in my top 5 holdings, you know, Apple and Tesla, and they're long-term investments for us that we plan on keeping for a long time, despite Musk's desire to, I guess, compress the PE. But, you know, I think over time, these are two of the most impactful products we'll see over the next 5 years.
Okay. For Apple,
very good. Thank you very much.
What do you think
yes, ma'am.
The impact of this watch decision will be? I mean, it's kind of interesting, the news coming out this week, because arguably, I mean, look,
I saved myself $150.
Seems like there might have been
My accountant tried to overcharge me.
breach of patent here when they hired people working for this company, Mosimo. I mean, that's pretty frowned upon in the tech world.
Yeah, I mean, just because they pulled the watch itself makes me think they're guilty.
That's exactly what that's what I'm thinking.
And so they don't want to increase the damages by continuing to sell the watch that they're now going to have to pay a royalty on per, you know, watch. I don't know where this goes. It's obviously non-Apple-like to have this kind of thing happen. That said, I don't want to jump to any conclusions, and these are really just issues about money in the end more than the product. But the fact that they've pulled the product, you know, is not a great thing. I don't know if it moves the needle a ton, but once again, Apple's got a lot of...
Okay, we got a hammer?
For sure. It's a big, mature company. Tim's done a great job over the last decade, but he certainly played out anything Jobs.
We got a one-bits, two-bits, and a freebie.
They launch new products and deal with China and deal with the challenges of a very mature product.
You're fired.
You know, Apple's going to have to pull some new things out of their hat, and I think Vision Pro...
Did you have anything nice to say about anybody?
All right. I know you like that, so it'll be fun to see which one has a more successful...
Yeah, hopefully I'll have both, right? I'll have a Cybertruck.
Did you used to work for CNBC?
Okay, yeah, we're gonna be hitting you from the road.
You.
All right, let's try, because you put Tesla in auto, you know, pilot, and you put on the Apple headset, and you're just locked in, baby. You can crush
just can't watch
mileage
Disney
that
now.
way. Right, like Disney. All right.
Yeah.
Thanks, Ross. Appreciate it. Happy holidays.
Yeah, thank you.
Ross Gerber, Kawasaki Wealth and Investment Management coming up. Let's talk some volatility and options and the explosion of zero-day expiration options. That was the big story of 2023. Tom joins me next. Binge watch the market with Schwab Network. Tune in 24 hours a day, 7 days a week on schwabnetwork.com on all your streaming devices. Schwab Network is available anytime, anywhere, on any device for free. No place better than the Schwab Network.
Accelerate your market knowledge and shift your perspective into full gear. Real-time example trades, a full hour of trading.
I'm Tom White.
I'm Kevin Hicks. Catch me on Fast Market, weekdays at noon on the Schwab Network.
This makes my job a lot more funner. Now, as everybody knows, this is a lesson to learn. When you have a new strategy, or new, I've traded with a scanner for years. I've got so accustomed of it telling me and giving me alerts without me actually searching and looking for them for myself. As a trader, we all have to have mentors, people around us that are good traders. You could sit here and do it all on your own, be by yourself, trade just as well. But when you're like I said, I've traded with scanners all my life. I had the one from Canada, which I really liked that one because it always gave me the share, how many shares were traded that day. And I actually forgot how I used to work that. It would tell me the low float size and all that stuff. Now Ameritrade has the same kind of thing. If I remember right, it's called let me see. Share. And just type it in. Shares. And we'll put this column in here. That's the float. This would tell me how much the float is. Now, Ameritrade's not accurate when it comes to the float size. It's always overestimated. So if you pull up FinViz, is that a Z? I think it's a Z. And you type in Tesla. The shares float is 2.76. Ameritrade has 3.178 billion. So they're hardly ever accurate. I'd rather be on FinViz than with Ameritrade on the float size. Nile. Nile says we have 1.7 billion. Let's go to AMD. So AMD has 1.615 on the float size. AMD has, well, it's pretty close, 1.6 billion. Here's one with 100,000, K-Web. They don't say. Airbnb has 640 million. And this says we have 413 million. So I used to go in here when I first started and I'd go to the lowest float possible. Now if I change this watch list, this is my 2024 watch list, by the way, that I'm using next year so far. And I'll put we formed this out yesterday. So if I go in here to I thought I had a low float scan somewhere in here. So this is my scan from 90 cents to $2 when I go to trade pennies. I always look at the volume first, see who has the most volume. William Tell with 634 million. Then when I'm scalping with the pumpers, I'll take the low floats and look at them and go through them. So we've got T-Rex or V-Rex, and I'm going to go to the 20-day 1 hour. This thing's had a huge pop, probably on a reverse float or a split. Yeah, 1 for 10 share split. I can tell when something's had a split, so I'm not interested. This one has 502.2 million. Why share lifestyle shares are trading higher by 45%. What was this stock here again? This is PTPI. Always got to look at the news before I take any trade. So this one here, pre-market trading. Petrol's Pharma recently completed a human factor study to assess the technology component developed by facilitate patients' access to Stendra. Fell to 114. This is definitely a double bottom play. We got a cup and handle. So I'm going to set an alert right here on top of them bodies here. I never buy at resistance. I'm going to look for a support to get in the trade. I'm going to take this and move this up above the 50. That's on the daily time frame. We've got Hoth. Haw Therapeutics gets University of Miami approval to enroll patients in skin toxicities treatment trial. Shares rise. They came out today, so that's good news. Received university approval. This university was the third site to approve the trial. Nice little pop on that one. So I'm going to set a support off this peak right here, off this one right here, off the body of that candle. I'm going to start trading a few pennies more this year. FT's a good one I used to trade. This got a 14 million float. This one's very active. I used to trade this a lot. If you go back, what, 4 or 5 years. This is a Bitcoin play. We had a hell of a run on this one. It pokes out every once in a while. Now we're down here at a solid support. We're at the 51, so that'll become a resistance. So it needs to pull back. I'm going to put an alert right off the 9 on this weekly time frame. And that 9 had hit before. So let's take it right at the body of that candle at 117. It's a little bit shy. I'm going to make it 120. $124. That way I get this here candle here too. So that's equilibrium. It's a tweezer top and bottom. There's another chart.
Gas, but gold is the one winner, up about 11% so far this year, and holding actually just below all-time highs.
Yeah, the record that we touched for gold that we quickly backed off from, kind of one of the big head fakes of the year, I suppose.
20-year high.
Absolutely, yeah.
On slash GC.
Above 2100 intraday briefly as we had to close the prior session of just shy of 2090, which was an all-time closing high.
Yes, it was.
That provided a catalyst for kind of a blow-off top, but some lower price action through the month of December. But overall, Oliver still holding just below those all-time highs and has been able to recover some here after testing that 2000 level. And it does appear to me,
Can't set an alert.
2024, that gold is in a position, particularly if rates continue to moderate or continue to the trajectory is lower, that there's enough other confluence of events out there and other items as far as data and central bank activity that benefits, I think, the trends in gold. And I do think that we will see a new high for gold in 2024.
Gosh.
I think rates need to cooperate. Dollar, what is the linchpin upon which higher gold prices depend?
Well, the dollar would be one of them, and again, you and I have been discussing this for the last several months. That I still feel that the dollar is going to break parity as we move to 2024, and if that's the case, then I would suspect that would be the catalyst for gold. Yeah, interest rates is a short-term influence. When we did see last fall the idea that rates maybe could stay higher for longer, that's when gold came under some pressure before recovering very sharply once the Fed kind of pivoted, I guess, to some degree, and other central banks as well. So I think that's going to be a theme as we move into 2024, Oliver. But current conditions, just the current pricing structure within the interest rate environment, even if it doesn't shift too much from where it is right now, I still think that favors gold moving forward.
Okay. Let's flip it around here. I like to take on gold, Dan, and I think it makes a lot of sense.
You ready for a 1, 2, 3?
where gold kind of has those key
too late.
relationships with other macros.
I mean, we could have a double
Crude's
bottom
been
trade
tricky,
here.
Very tricky, and you can talk to two different crude experts, and they'll tell you the opposite thing.
That they will. The one consistent though, Oliver, even though it's had a pretty big price range this year, from a low around 64 to a high of 130.
The SPY 476. We got a double bottom with a shooting star, morning star of the hammer. It's 476 at 86. Two-headed snake. We had three black crows right here and it bounced. We got two engulfing candles to the bottom of that fourth crow. And we've got a 1, 2, 3 right here. Damn it. I knew not to do that. Oh, I know what to do. Undo, remove trend line. Yeah. We've got more buyers than sellers. Well, now we've got more sellers than buyers. Average volume 73 million. And we've got 47 million, so we're down 35 million. And I'm now in the red. What time is it? Okay, I still got time. It says it's ready.
their lens and invest accordingly. You can call us Christmas Eve at 4 o'clock in the morning. We're gonna always make sure that you have all of the finance.
Mr. It's a damn good call. Yes, they are. Mister's got resistance up here right around $800.
Taking a big picture look at the year that was and ahead, of course. Colin Martin, Director and Fixed Income Strategist at Schwab Center for Financial Research, joins us alongside Kevin Gordon, Senior Investment Strategist at Charles Schwab. Great to have you guys both here to take a little retrospective and look forward here. We're so close to ending this year with all-time index records, Kevin. We got for the futures in the NASDAQ, but what's holding us back here? Just a thread away from the index highs.
Yeah, I mean, it depends on which index you're looking at. If you look at something like the S&P, yeah, you're bumping up against that new all-time high. If you go down the cap scale, you look at the Russell 2000, you're actually, still bumping up towards similar ceilings that you've seen, earlier in the year. And that was sort of the theme for 2023 was, sort of numerous attempts for the market to try to, get sort of find its footing and find those sources of participation and then move higher. And that was kind of the main theme, was that they weren't able to. So key theme that we're watching for next year, obviously, whether you do start to see a broadening out in breadth and better participation under the surface, not at the expense, hopefully, of key contributors of the market this year, but hopefully that broadens out and you do get a little bit more of what would be, I guess, considered somewhat of a normal environment.
All right. Normal as defined by rates, Colin, what is that at this point?
I think I'm going to get out of this trade even.
Once the Fed starts to cut rates, which we expect sometime next year.
There we go.
We've seen a lot of volatility lately with the Treasury market, but as it stands now, coming into 2024, it looks like the next move will be a rate cut. We think 3 is a little less aggressive than what the market is pricing in. Markets are pricing in 5 or 6
I don't like
cuts,
you.
which just seems too aggressive given what we see with the economy. Yes, inflation is moving in the right direction, but admittedly, it's still above the Fed's 2% target. But if you take a step back and look at the economy, while we do expect it to slow down,
I just don't see that.
Such an aggressive rate hike cycle, as it stands now, it's still.
There's got to be fuzzy math involved in this shit.
Strong households still have liquid assets. So until we see, a sharp slowdown maybe on the retail consumer side of the equation, rate cuts might not come as early as some of the markets are expecting. When we do look at the potential for those cuts, we think it's more of a way to.
I want to get out of this trade.
In the same level of restrictive, as opposed to the need to stimulate the economy, because
I'm going to put in a fake sell.
To trend lower, that means real interest rates can continue to rise. So rate cuts.
We're squeezing between the 9 and the 21.
Maintain, as opposed to stimulate.
Okay.
There we go.
So having a little lever that goes both ways, perhaps, that seems like it would be a little bit more reasonable than the huge binary pricing of a massive cut series before we get some more information on the economy. The conclusions from both your teams, bonds and stocks, seem to be to stay stay up in quality for credit and for equity. Kevin, and that seems to come back to your point about the relative performance of quality versus some of those unprofitable small caps and such, because there is still a pretty big difference in how the market has treated quality companies.
Yeah, and it really has to do a lot with the unique nature of this cycle.
Got out at 93 at the 51.
Through a bear market, some form of a recession, you get a reset in the labor market, and you go through that whole sort of washout phase for the economy, and then you start to see a pretty durable recovery. It's not as clear cut this time because you still have significant weakness in certain parts of the economy, offset by significant strength in other parts of the economy, and sort of the overarching theme or the overarching umbrella for all of that this year has been a relatively resilient labor market. So I mention all that because typically when you do see that bigger reset for economic growth after you come out of a recession, that's typically the time when you've got significant easing on monetary policy and to some extent easing in fiscal policy, and that's when you can move down the quality spectrum because those are the kind of more high beta cyclical parts that are more leveraged to the economy itself. That's not really the case this time, so that's why we've been in this sort of stay up in quality camp, mostly because the expectation, as Colin was sort of mentioning earlier, is not really that the Fed just pivots and cuts aggressively to zero. If we're going to be more in this sort of range of higher interest rates relative to what was the norm pre-pandemic, that's a very different scenario than what many of the younger companies or smaller companies or both have been used to. So that's why the quality trade has worked throughout the past, not just year, but past couple of years, and probably will continue to work as long as you stay in this kind of murkier economic environment.
Okay, like that, because there is still a little bit of murk for us to sift through.
Man,
here.
97.
When you look at rates and credit, Colin, the credit market seems very much confident, judging by spreads. Are you even getting rewarded then for going out far on the risk spectrum? How does that look right now in your mind?
We don't think investors are really being rewarded enough to take on those risks, and that's why our theme going into 2024 is that up in quality.
Dadgummit.
When we take a look back and when we look at the various parts
106.
of the market, whether it's investment grade, whether it's high yield, whether it's bank loans, how much we as investors earn in additional yield or spread matters for our outlook. And if we look at pretty much all parts of the market, those spreads are relatively low.
1, 2, 3, boom.
With the likelihood of a soft landing becoming more likely every day as we get stronger economic releases. But the more those spreads tighten, that means there's just less wiggle room in case growth does slow more than expected, because the lower those spreads go means it just doesn't take much of a spread increase to basically wipe out that spread for the entire course of the year. So for example, if we look at the investment grade corporate bond market, you get an average spread of around 1 percentage point, give or take a few basis points. But with spreads so it's tight and the average duration of the index, if that spread rises by just 15 or 20 basis points over the next 12 months, which is certainly in the realm of possibilities if growth does slow, then that can wipe out that spread for the year, and investment grade corporate bonds can underperform treasuries. So as we look ahead, we think positive total returns are likely, but we think it's going to be difficult to actually outperform treasuries, especially if growth slows more than we expect.
Okay, love that description. Kevin, close this out. Give me an idea of the timeline of when you look ahead, when some of our biggest questions might be answered. Do they kind of coalesce around that expectation for a March cut?
Well, it depends on which question you're looking for. I think that the bigger question in an economic sense is probably whether you do, whether it's different this time in terms of the labor market and the reaction function on the part of the Fed, and whether monetary policy, is actually going to cause material weakening in labor. And you have to, keep in mind, and we've mentioned this a lot, over the past year, you're really not past the expiration date for when you're supposed to start to see labor weakness in response to a Fed tightening cycle. And not to say that you get some sort of recessionary spike akin to, a drastic recession that we've seen in the past, but it's just whether you see more of an uptick, more than what we've seen in the past few months, with the exception of a little bit of a, rolling over. But I think that that's going to be the main question. Whether it happens in the first or the second quarter, I don't know. But if you get throughout 2024 and you don't get any kind of recessionary spike in labor or in the unemployment rate, then I think, you could probably start to say that the cycle looked entirely different. And despite all of the tightening from the Fed, and global central bank tightening, it didn't lead to what has historically been.
Well, we'll see if they have the ding, ding, ding.
Nice. That's indeed the question, whether or not we get that big final crack in the labor market. Appreciate the commentary, guys. As always, pleasure working with you this year. Always fun getting your guys' big picture analysis. It's always very useful and helpful. Colin Martin, Kevin Gordon, the Schwab Center for Financial Research. All right, when we come back, we're going to talk about a fun sector, a theme, one of my favorites. Gaming, not the sports kind, the gambling kind. But yeah, it's sports too, so it's all the same. Pretty big year for one company in particular, DraftKings, but the whole sector was not short of drama.
Golly.
Young lady who was a couple of kids, recently went through a divorce. She had a lot of
The expansion pattern.
I wasn't being a single mom.
Went to a 29.
My mom raised 3 children, including myself. And so once the client
Not good job.
we were able to help her move forward.
It went to 29, Ocean.
How much you know until they know how much you care.
Look. 138.
Schwab Network app and join in on the latest market events. Anytime, anywhere.
148.
Any device for free. Network.
Jesus hickory smoke. I'm really enjoying this. You're going to have to, I don't know. I got so dependent upon that scanner. I mean, there's nothing wrong with it. But it eliminates, not having it, eliminates a lot of tickers that probably wouldn't be tradable. So we're going to stick with the 2024 watch list. What the hell are they doing up there? I'm going to put this in the room. And if you want to have a copy of my watch list, and for the people that are on I'm gonna go ahead and put this on my Twitter account, YouTubers. I'm gonna give you the link in YouTube. Not a bad day. I'm gonna go ahead and kick back. We'll catch y'all YouTube later. That was incredible.